years, the earnings headwinds remain. Now, the question is, what multiple do you want to pay on that? If you look over the last 10 to 15 years, going back to the GFC, the forward earnings multiples for Indian IT services companies are still above where they troughed in previous down cycles. So even though they have underperformed, our focus is on prospective earnings. Also, what I should add is, as a long only, as a team that is always fully deployed, if we want to buy something new, we need to sell something. And relative to reducing the underweight materially in IT services, we don't see reasons for that yet, to take away from existing holdings that we prefer even more.
Okay, Vikas, great chatting with you. Thank you very much for joining in. Moving on now, let's tell our viewers the interactions that we've lined up on the show today. So first up, coming up at 8:35, the management of J&K Bank will join in to discuss the bank's fundraise and the outlook. 9 a.m., Bernstein's Pranav Gundapale will join in for a banking sector outlook. 9:20, Sailesh Rajbhan of Nippon India Mutual Fund will be our market master for the day. 9:35, the management of Happiest Minds will join in to discuss their H2 outlook. And following that, the management of IGI India will be chatting with us at 9:45. Well, we've got an action-packed show coming up on the show.
Well, that's right. Time to slip into a quick break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. But I'll run you through the list. Wipro, Lodha, Voltam Transformers, Reflex Industries, Bandhan Bank, they'll all be reacting to positive news flow. Add to the list Zydus Life as well as Car Trade Tech. On the flip side, GAIL, MQ Pharma and MTAR Tech will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. We told you about the macro setup. It's time now to tell you about the stocks which should be on your radar this Friday morning. Our research team is joining in. Sonal, the big one is going to be GAIL, where the increase in the tariff seems to be less than what the management was aiming for.
Finally, the tariff order has come by and it has been months of wait. The PNGRB, they have gone ahead and approved a tariff hike of around 12%. This was versus what GAIL had asked, 33% revision, and also lower than what the street was estimating of around 20%. So this has come in as a disappointment. To give you the numbers, the tariffs are now at 65.69 rupees per MMBTU versus earlier levels of 58.6 rupees per MMBTU. Now, there are a couple of adjustments to this because PNGRB has not considered future OPEX or CAPEX considerations in their working for this tariff. They say they do not want to increase tariff at one go, but want to smoothen the process, and that's why there will be another revision that will take place for tariffs in FY28. And that is something which ICICI Securities thinks will be a window for further revision, which will be an upside risk for GAIL. So yes, the current tariff is lower than what the street was estimating, but there is the possibility of further upside from current levels, and that is what brokerages are positive on. But going with red today because street had largely factored in at least a 20% tariff hike, so that stock will be on our radar.
Okay, all right. Sonal, thanks a lot for that. Well, let's hop across to Vinny. She's here to tell us about some stocks that are on the news.
Hi, good morning, Nigel. So first up, we'll start with Wipro. We're expecting green here after the company has entered into a multi-year agreement with Odido Netherlands BV. This is to transform IT landscape as well as enhance the customer experience across the board. So that is why we'll see some bit of a positive move, mild positive here for Wipro. Lodha developers could expect green here as well. The company has received a 521 crore refund from the Supreme Court, and the order actually mentioning that Lodha developers' position on a bona fide successful resolution application, and this was in relation to the V Hotel, where they have legitimate interest in the property. So concerns around that also goes off, and they'll get that refund which they put in at 521 crores. Voltam Transformers, that also green is what we could see here. The company has won an order of around 85 crores. This is a domestic order from Gujarat Energy Transmission Corporation, mainly for designing, manufacturing, testing and supplying of power transformers. Lastly, Reflex Industries, that's also something that we'll keep an eye out on. 100 crore order is what the company has gotten for excavation, loading and transportation of pond ash as well as bottom ash. The time period of this project is 4 months, so we'll keep an eye out on that as well. Green expected here.
Okay, all right, got it, Vinny. Thank you very much for all of those stocks. But we're not done because Hormaz has a couple up his sleeve as well. Hormaz, which names are you looking out for today?
Morning, Survi. Definitely more than a couple for sure. Bandhan Bank, start off with that. The lender has decided that they are going to sell a part of their NPAs and written off loans portfolio through a bidding process that will be involving some asset reconstruction companies. The NPA portfolio is worth over 3,200 crore rupees and the written off portfolio is worth around 3,700 crore rupees. So loans worth close to 7,000 crores will be on sale for Bandhan Bank. So expecting some positive move here. Another positive news for Zydus Life because they have received a tentative approval from the US FDA for a tablet that is used to treat the type 2 diabetes, and the tablet for which they have received the approval, which is the empagliflozin and the linagliptin tablets, they have a market size of around $215 million. Some negative news flow for Emcure Pharma. They have mentioned that there were search operations conducted by the GST Mumbai authorities between the 24th to the 26th of this month. So some negative reaction there. Cartrade Tech, the stock was down yesterday because of a negative news development with regards to a potential acquisition, but Goldman Sachs used this opportunity to sell some shares through multiple funds, and those shares were bought by the Small Cap World Fund. So you can expect some positive moves here because a big fund has been a buyer here. And MTAR Tech is a negative development here, but despite funds like Motilal Oswal and Bajaj Finserv being buyers, the promoter entity having sold stake might just turn out to be a bit of an overhang on the stock.
Okay, all right, got it. Thank you very much for that, Hormaz. Let's quickly recap our list of stocks to watch this Friday morning. The ones that have positive news flow are Wipro, Lodha Developers, Voltam Transformers, Reflex Industries, Bandhan Bank, Zydus Life and Cartrade. While stocks with negative news flow would be GAIL, Emcure Pharma and MTAR Tech. Okay, GAIL, we need to watch. Some of the brokers are not that negative with this 10% hike. We'll see how it goes, and more on GAIL coming up in just a bit. But for the time being, let's go across to Manisha Gupta for a roundup of all the commodity action overnight. Not too many cues because of the Thanksgiving holiday. Manisha, what are you tracking?
Oh, yes. The volumes have been quite lackluster there. But, the markets still are waiting for the U.S. Fed meeting with 85% probability of a rate cut coming in there. We're looking at a lot of action in sense of prices here. So when you look at gold, it has been on the stronger side. This is the fourth straight month that we're looking at gains come in here, the best yearly gain since 1979 as well. The silver prices, in the meanwhile, overnight have gained up more than a percentage point. We are $0.50 away from its all-time highs, with markets believing that perhaps the absence of U.S. market could lead to exaggerated moves coming in for this space. So $0.50 away from all-time highs when it comes to silver. The only thing that I see declining is the crude oil prices, headed for a fourth monthly loss. This is ahead of the OPEC Plus meeting on Sunday, and also Russia's president's statement saying that U.S. peace proposals with Ukraine could lead to future agreements. That has led to some bearish tone in energy space.
Thanks a lot for that, Manisha. Well, let's hop across to Sudarshan, as always, joining in to give us all the brokerage calls of the day. Sir, good morning.
Good morning, Nigel. So I'll start with Jefferies has written on real estate companies believes that new launches have improved after the festival period, and now listed companies or its coverage company are likely to post pre-sales growth of 25% in FY26. And amongst preferred picks, Godrej Properties and Lodha, which these two companies are expected to have a strong growth, especially in H2 FY26. And remember, the realty index is down almost 20% from the 2024 peak. Now coming to the next one, Jefferies has written on Lenskart. It has initiated coverage with a buy call and target here is 500 per share. It says it's India's largest tech-driven eyewear retailer with market share of just 5%, and it offers strong growth potential. Its vertically integrated omni-channel model ensures cost efficiency, rapid delivery, and superior customer experience. India serves as a bedrock with more than 85% contribution to EBITDA, and as per Jefferies, attractive unit economics and fast paybacks should drive 50% adjusted EBITDA CAGR over FY25-28. Nomura has initiated coverage on Anthem Bio with a buy call and target here is 740. It says company is well positioned to capitalize on CRDMO opportunity and expects sales growth of in the range of 14 to 20% and earnings growth of 26 to 27% over FY26-28. While the growth might be muted in the near term, but it might accelerate from FY27, and also steady growth of key molecules and new launches are the key catalysts as per Nomura.
Okay, all right. Thanks, Sud, for that. We are going to keep a lot of these stocks on the radar. Need to take a break, but then we come back with the big story of the day. There is a hike in tariffs for GAIL, pipeline tariffs, but it's not as much as what the company had been asking for. So what does this mean for GAIL, for the overall, tariff sort of feasibility in the country? We'll connect with Mr. A.K. Tiwari, member PNGRB, on the other side.
Welcome back. As promised, let's focus on the big story. PNGRB, well, they have gone ahead and approved a revision order for GAIL's transmission tariff, but the street will be disappointed because it's lower than what is expected and it's lower than what GAIL had asked for as well. What are the factors they considered? What are the factors they didn't consider? We have with us Mr. A.K. Tiwari, the member of PNGRB. Good morning, Mr. Tiwari. Thanks a lot for joining in, sir. Tell us what are the factors you consider and didn't consider. Street was anticipating a much higher tariff. You have come in much lower. Tell us more.
Yeah, very good morning. First of all, thank you very much for inviting me on this channel.
Thank you, sir, for coming in.
And I would like to say a couple of things on this, that the entire board, after detailed deliberations, has concluded this tariff, interim tariff of GAIL, in the interest of the consumer as well as in the interest of the GAIL. I would say how. The primary reason, normally the tariff is to be revised with a period of 5 years. So, in fact, the tariff could have been due there after 5 years. That means last revision was there in the year from 1st April 2023.
Okay.
And normally it could have been done in the year 2028.
Okay.
Now there are the two reasons for tariff revision. One is the capacity determination, which has been done by Engineers India Limited, and second is the deallocation of gas, of APM gas by the ministry. So these are the two basic reasons, and wherein we have determined the tariff of 65.69, considering all the three factors. Actual SUG we have given, future SUG we have partially given, and the capacity determination hike we have totally given. So this interim relief is in the interest of GAIL. How it is so? Normally, if we could have revised the tariff, then the next review could have been done in the year 2031. Now, if you see the order, we are going to revise the tariff of GAIL from 1st April 2028. So this is the only interim relief, and wherein we have given 7 rupees hike, and will prove all the factors of SUG, actual COPEX,
Mr. Tiwari,
everything will true up in from which will be effective from 1st April 2028. So one factor I would like to say, if market expectation could have been 2 or 3 rupees more, now we are going to then the tariff could have been concluded in the year 2031. So we have given interim relief, and partly this will affect the unified tariff also. We are going to conclude the two-zone tariff in the interest of the PNG.
Mr. Tiwari, sir, I think what people are trying to understand, what the street and GAIL's shareholders will also want to understand, is that GAIL had asked for a 20% hike. You, as you mentioned, you've taken some parameters. You've taken this SUG, the system usage gas, and one more parameter. But I believe you've not considered the actual total capex and opex that GAIL will have to undertake. Why is that, and why are you breaking it down? Why are you staggering it out? You're saying you've given 12% relief now, the remaining will come in FY28. Why stagger it?
This is primarily basic reason is that we have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll do up everything.
So you're saying that now, instead of in the previous sort of system was that pipeline tariffs were being revised every 5 years, you're saying that now you'll be doing it a little more frequently, but in parts. Is that the right way to look at it?
This tariff, this revision we have done partly as interim relief, but normally it has to be done in the year 2000 after 5 years.
Correct.
So that is the reason.
But there will be another round of relief in 28 that you've already stated.
Yes, it is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein will all the factors, capex, opex,
You will take all of them into account. Sir, just to understand, what was the thinking? Because when GAIL applied for the tariff revision, GAIL was seeking, tariff somewhere around, I think, 78 rupees per unit, right? So was the board in agreement with their arithmetic, largely? Maybe you've not assumed all the parameters right now, like you explained. But did GAIL's arithmetic seeking a tariff of 78 rupees per unit, did that make sense to the board?
Yeah, but 78 rupees was too much. Our calculation was in around 70 rupees, 69 rupees, like that. So 2 or 3 rupees reduction is there. But the positive part is that we are going to revise again after 2.5 years.
Okay.
So that will give total relief to GAIL.
Okay. All right. Mr. Tiwari, just to clear a couple of aspects, you're clearly saying 2028 is when the revision is there. But from an investor perspective, they were hoping for a much higher increase. You're saying you gave 12%. GAIL asked for 33%. Street was in that vicinity, I think, of around 15 to around 20%. So a couple of clarifications. Is there some hope now GAIL can, can ask you all, can request you all to have a relook at this? Or this is done and dusted? You're not going to have a relook in 2026 or 2027. The next date comes up only in 2028. Is that correct? Or is there still hope in the next 2 years that something can happen?
See, two things I would like to clarify. This is the interim relief.
Yes.
And we are not going to review anything again. Okay. Second is that from 1st April 2028, we'll review and give all the parameters which are due to GAIL.
Okay, all right. Just one more thing, sir. There's a zonal tariff change as well that's expected, right?
Yeah.
Could you tell us when do we see that and a rough quantum that you could look at?
After this GAIL's tariff, one more tariff of pipeline infrastructure is due, which is going to be concluded very soon. And we are going to this zonal tariff of CNG, PNG for 1 zone and 2 zones, other things. I think we are planning to be effective from 1st January 2026.
So we'll hear about that in December then, the zonal tariff.
Yeah,
right?
yeah, we are going to conclude everything.
Final question, sir. Since you've arrived at this tariff without considering GAIL's capex and opex, requirements, could they have any sort of a recourse? I mean,
no recourse. Okay. Just, I would like to clarify here. The last revision, as I have told, was done in from 1st April 2023. Normally, it could have been, the board could have taken a call and continue the tariff of 58 rupees till 2028 only. But we have given the relief of 7 rupees, and further we have given in the clarity in the order that we are going to review from 1st April 2028. Okay. So there is no confusion. I think markets should take it as very positive.
Fair point.
We have taken in the interest of consumer also, because these reduced tariff are going to give relief to the in terms of the unified tariff to the consumer also. So we have balanced everything.
No, fair point, sir. I mean, the next relief, like you're saying, would have otherwise been due only in FY28 after the 23 revision. So at least there's some interim relief coming in. We take that point, and earlier when, this was doing the rounds, there was some sense that even a 10% relief, which is now it's 12%, even a 10% relief does add to GAIL's EBITDA and to GAIL's profitability. So we'll see how the market reacts. But for now, thank you very much for explaining the stance.
And Mr. Tiwari, I like the way you say the market should take it positively. The market has a mind of its own, sir. They wanted a much higher tariff increase. For the time being, you have stated that this is what you believe you should be giving, and the next 2 years there will be no relook. But in 2028, they have a date again, and hopefully at that point of time, it increases as much as what the market expects.
Yeah, one thing more, that as a PNGRB and regulator and entire board, we take a considered view in the interest of the consumer and also entity.
Got it, sir.
Absolutely,
Thank
sir. You have consumers to look after, not just the shareholders of the entities that you regulate. We take that point. Thank you very much for joining us early in the morning and explaining how the tariff hike has been arrived at. Thanks very much. So that's the word coming in from PNGRB, the regulatory board itself. Siddharth Khemka is with us. Siddharth, we have to discuss a lot of stocks, but GAIL first up. Are you convinced 12% is better than 0%, but 12% is not 20%? Your thoughts?
Good morning. I think that debate can continue even in our morning meeting. We had a lengthy discussion. So our analyst has not had not built in any price hikes for this revision. So to that extent, our numbers will get revised upwards by 10%. Definitely, I think the street was factoring in a 15 to 20% hike. So there is a disappointment. But again, I would say it's a 10% hike, which is much better than a 0% hike. Overall, we believe that if you look at GAIL's performance operationally has been pretty steady. Even Q2 numbers, the strong operating, strong marketing gains, the gas transmission volume that has been steady. And we continue to remain positive. Yes, I think today there could be some dip because of the disappointment, but from a long-term perspective, we remain positive given the healthy growth prospects, attractive dividend yield, as well as the supportive valuations.
Okay, Sid, stay on. Like I said, we have lots of other stocks to discuss as well, but we'll quickly get into our first corporate conversation of the morning before we continue with Siddharth Khemka. And our focus is on J&K Bank. Amitav Chatterjee, MD and CEO of the bank, is with us now. And we have lots to discuss, including the bank's fundraising plans. So three key points, just to put it in perspective for our viewers. We want to understand the fundraise, whether this is just an enabling resolution, what are they thinking in terms of the equity part of it. And then, of course, we want to understand the credit growth trends as well. What is the bank's expectation for the second half? And then look at, the outlook on the other metrics like ROA as well. Thank you so much, sir, for joining in. So first things first, you're looking to raise up to 1,250 crore rupees. And I believe 750 crores would be via the equity route. Just run us through the thought process. Is it to boost your capital? Do you have concrete equity plans and a timeline in mind?
Very good morning. Thank you for having me here. Yes, definitely. We had, for the bank, we expect the CRAR overall to be somewhere around 18.5% going forward. Without factoring in the internal accruals, we now believe that this will take us to somewhere around 18%. The very reason why we are trying to raise this capital, fund, is that we have very strong pipeline and a sense of credit growth going forward in the next quarter and a half. So I believe we should be adequately capitalized so that we can go ahead with our growth strategy.
All right. Hi, Mr. Chatterjee. Good morning. Good to see you in. Just a quick question, sir. There's so much of interest in Indian banking system. Are you in touch with any large fund, any big PE? Because the appetite for smaller banks in particular has been very, very large. And we have already seen a few deals that have taken place, both in the banking as well as in the financial system. So is J&K Bank in talks with any particular investor or a clutch of investors?
No, at the moment, I cannot say that I am in touch with anybody specific. But to be very honest, I have had very good interest shown by many people. So what you said, the interest in Indian banking and especially small size or mid-sized banks, it's pretty much there. So I believe that the conditions are conducive enough for any capital raising for a bank like us. It's only a matter of time when we feel that we are adequately valued to go to the market that we will start the process. We have already taken the approval from the board. So we will be going ahead with the process only when we feel exactly the correct time has come.
Give us some clarity, sir. Where is it coming from? From the Middle East? Is it from overseas funds that are showing interest? Are they willing to write those big checks? Is the money, coming in from overseas, domestic funds? Give us a sense on that, sir, because you're saying there's a fair bit of interest, even in J&K Bank.
Yes. Overseas interest is there. I would not deny. But at the moment, since I do not have anything specific to mention, so I would prefer not to go into any kind of details. But the interest is there.
I think the alarm is going off as well. The clock is ticking, sir. We could hear something soon.
Sorry for that.
But sir, you said you'll go to the market when you're ready. Give us some sense, some timelines. Is it going to be the current fiscal year? Could it take longer?
So it could be the final quarter of this financial year, or maybe the next quarter. If you look at our value of the price of the shares, the PB ratio is quite low. It's one of the most undervalued shares at the moment in the banking sector, in all the listed entities. And if you look at the financials, I believe that they are pretty strong. And going forward, in fact, every aspect I see, it's only improving every day. So there is every possibility, and I believe that when we feel that I can actually give a good value to the prospective and the existing investors, it will be the time when we go to the market. The initial thought is maybe to go in the fourth quarter of this financial year, but I am not at the moment absolutely sure that we will do that, to be very honest.
Well, fair enough. You'll do it when you feel you're fully ready, and when you will get maximum bang for the buck, as they say, the maximum value creation. Could be fourth quarter, could be first quarter of next year. But let's talk about that value creation, right? And the market values growth more than anything else. So let's talk about that. Your credit growth guidance for the current year is about, I think, 12%. Just tell us what you're seeing around you in the second half, which segments, and I mean, do you think it will be 12%? Is there an outer chance that it will be better than 12%? And what will drive it?
See, I told you last time, the expectation that I had for the end of third quarter, we got it in the second quarter itself. The growth in the sectors within Jammu and Kashmir, especially the agriculture, we had a fantastic growth in agriculture during the first two quarters. The retail growth has been steady. And as far as the corporate loan book is concerned, we have a very strong pipeline at the moment. So the guidance was 12% for the year. We had reached around 9% by the end of second quarter. The reason I said that what I expected in the second quarter, third quarter came in the second quarter is that we had undergone certain process changes where we introduced the end-to-end digital loan journeys for even the corporate loan book. So all these things are in place now. So fortunately, the growth started happening right in the second quarter itself. I had kept some buffer for the processes to be streamlined. So now, since the processes are streamlined and the loan book is, the prospective loan book is very strong, I believe that we can actually exceed the guidance that we had given in the loan book.
All right. So loan growth of more than 12% is possible. NIMS guidance at around 3.7 to 3.8%. That's something that you're heading for, right?
You would have seen the NIMS went slightly down during the second
but for the year, that's the guidance you're putting out,
yes,
right?
Yes.
Got it. And final question, sir, with regard to your return ratios, the ROE, I think the guidance was reduced a little bit, 15 to 16% from what you started the year at. Confident that you'll achieve this, and I think ROE of around 1.25%. Both those two return ratios in check?
Definitely.
Always a pleasure, sir.
Thank you.
Always a pleasure, sir, talking to you. You're sounding confident. We're going to be waiting by to hear from you with regard to that fundraise, if at all. Wishing you a good day ahead, and we'll chat up soon.
Thank you very much.
Well, time to slip into a short break. Come back. We have our technical experts, Siddharth as well as Mitesh. They are waiting for us. They'll tell us their call on the markets and individual stocks as well.
Welcome back. Well, we are just about 10 minutes away from the pre-open rates. Hormaz is joining in with some interesting data on yesterday's big movers. Hormaz.
Good morning, Surbhi. And Saregama is the first one in the list today. The stock was up over 5% in yesterday's trade. The third straight day of gains for the stock is the biggest single day gain that the stock had seen since February of this year. The volumes on Thursday were the highest since January of this year. So significant volumes as well. Over 90 lakh shares were traded compared to a 20-day average of around 4 lakh shares. And out of those 90 lakh shares, close to 30 lakh shares were marked for delivery compared to a 20-day average of just around 2.5 lakh shares. The stock, well, it's down almost 35% from its 52-week high levels. So seeing some buying interest coming in at lower levels. Ashok Leyland, we spoke about it in closing yesterday, and I just spoke about it in the FNO bit as well. Third straight day of gains here as well. The stock is at a 52-week high. The volumes were the highest since July of last year, and 9 crore shares were traded on Ashok Leyland yesterday. The 20-day average is 1.5 crore, and out of those 9 crore shares, close to 3 crore were marked for delivery, and the 20-day average was around 70 lakh shares. The delivery volumes yesterday were the highest in the last 4 months for Ashok Leyland, and the stock at around 45% higher this year is set for its best calendar year performance since 2017. Gillette, some buying seen in that stock as well. The stock ended off the lows of the day, off the highs of the day, but still ended around 3.5%, 4% higher. It was only the 18th instance in the last one full year, which is around 250 sessions, that over 1 lakh shares were traded on the stock yesterday, and Thursday's volumes were the highest since May, close to 3.5 lakh shares traded. The 20-day average is only close to 40,000 shares, and out of those 3.5 lakh shares, only 37,000 were marked for delivery. The 20-day average here is only 17,500, and the stock, this one too, is down over 25% from its 52-week high levels. And lastly, the new listing, Prostam Infosystems, the stock, it was the third best day since its listing, listed only in June of this year, and over 2 crore shares traded. 20 lakh shares were marked for delivery. The turnover was close to 400 crore yesterday, which was well above its free float market cap, which is close to 250 crore. And the stock is up over 70% from its IPO price, which was around 105 rupees. Also remains in focus because a big lock-in ends in the month of December.
Okay. All right. Interesting as always. Hormaz, thanks very much. We'll keep these stocks on our radar as well. Let's go back to Siddharth Khemka for some questions. Sir, I don't know if you could hear our conversation with J&K Bank, but these tier 2, tier 3 banks, they've generated so much interest in the market, right? They're all getting aggressive, raising capital, striking deals. So thoughts on J&K, if you have any. And then there is Bandhan in news today. Bandhan is looking to sell down some of its bad loans. Again, I'm asking because of the huge interest in tier 2 banks.
Yeah, Shulvi, I think I definitely heard the entire conversation with J&K Bank. I think what is happening is, clearly the balance sheet cleanup as well as the growth pickup in the tier 2 or the mid-tier banks, both private as well as PSUs, that is clearly visible. What has also changed is that the regulator is far more comfortable allowing investments, private investments, specifically if you look at some of the foreign investments in these mid-sized banks, and that has kind of picked up the street's interest in some of these names. So by J&K, we don't have an official coverage, but if you look at some of the other names, be it a federal bank, which has done consistently very well, they have also managed to get a 10% stake, strategic stake from Blackstone. That is pretty positive. AU Small Finance Bank, that has been consistently doing very well. Among the few, or I would say the first small finance bank to get a full commercial banking license. Again, I think after the consolidation, the valuations look attractive. The growth opportunities is pretty strong. PSU banks, mid-sized PSU banks, be it a Canara Bank, be it an Indian bank, be it a Union Bank. I think, again, there is a case for a re-rating along with the fundraise plans that the government allows to do some of them. So pretty positive on the entire banking space, yeah.
Okay. All right, Siddharth, thanks very much. Shorter conversation today, but thank you for being with us. You have a good Friday, and we'll catch up soon. Right now, a very quick break. Back on the other side, we'll have the pre-opening rates and also get a conversation going on the BFSI space. Bernstein's Pranav Gundapalli will join in. Welcome back. 14 minutes to go before we kickstart today's trading action. And the top story continues to be the tariff hike that has come through for GAIL, Gas Authority of India. In fact, we have Mr. Rakesh Kumar Jain, Director of Finance at GAIL, now joining in, because as we all know by now, and we just heard from Mr. Tiwari of the PNGRB as well, the hike is not at what the company was seeking. It was not as much. Mr. Jain, thanks for joining in. Your first reactions, you were seeking 78 rupees a unit. But what has been agreed is closer to 69.
Good morning, ma'am. Yes, we submitted our tariff of 78 rupees way back in August 24. And if you see in terms of net present value, it should have been around 81, 82 rupees. Yesterday night, PNGRB has issued tariff order, which says tariff approved as 65.69 rupees. However, it's on interim relief basis. Actually, it's not a regular tariff order they are saying. They are saying interim relief, and regular tariff order will be issued in April 28. Actually, tariff orders are normally issued in a block of 5 years, but regulation also says if there are significant change in the principles of parameter based on which the tariff was revised, we can, or PNGRB can ask us to submit, or we can approach PNGRB. So in this case, PNGRB asked us to file the midterm review, and we filed it. Normally, whenever tariff is reviewed, all the parameters based on which tariff is reviewed is allowed, but this time PNGRB has allowed only those two parameters with respect to system use, gas and pipeline capacity, and order says that everything else certainly will be allowed. The order itself is saying, and in April 28.
But you have to wait a little longer. So let's break this down. That's the thing. They've only taken two parameters into consideration. A lot of the other parameters, including capex and opex, in this order, they've not been taken into consideration. Now, the current tariff is set at 65 rupees 69, 65.69 per MMBTU. At this kind of a tariff, to what extent do you get a help to your EBITDAs? There are some estimates on the street. Brokers are saying it could be boosting your EBITDA by 10-12%. But you tell us.
It will increase by 1,200 crore rupees per annum based on existing volume. And next year, we are also expecting at least 8 to 10% volume hike. So therefore, it will be around 1,300 to 1,350 crore rupees.
Okay. So this year, your EBITDA gets a boost of about 1,200. Next year, the EBITDA boost could be 1,300 to 1,400 rupees. Is that right?
Yes.
Okay. So the question is now, PNGRB told us that you don't have any recourse. I don't know if you can approach any other appellate or anything like that. Or is it that you just wait it out and now wait for the next leg of an increase, which will come in FY28?
Certainly, we will go through the tariff order first because it has been issued last night. In terms of recourse are available. If we feel that there are concerns in the tariff order, so we can approach PNGR if there are some issues in errors, and then recourse are available. But we have not gone through the order, so therefore difficult to comment on this moment. But there is one positive line in the tariff order that it's an interim relief. So we are reviewing it, whether the interim relief is also having some issues or then we need to take up. I only can say the delay in tariff order only impacts customers. As a pipeline entity, we are eligible for 15% pre-tax return because the tariff is calculated on discounted cash flow methodology where net present value will be considered. So any delay in tariff does not hurt us. It can be delayed available, but it will be available at 15% pre-tax return basis.
So the reason I'm asking is that you just told us that if you go by net present value, then with the current operating environment, you would have actually wanted 81 rupees, not even 78 rupees, looking at the current. So there's a lot of gaps. There is a 15 to 16 rupee gap in what you've received and what you think you need. So how will you adjust for this?
No, actually, 8 rupees, and since it was delayed, our submission, if we would have submitted right now 81 rupees. Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and true up in next revision. So we were expecting the tariff based on those revisions should be 70-72 rupees, but it has come down to 65 rupees, 69. But there is a gap from our expectations of around 5-6 rupees. Okay. And since we are yet to go through the tariff order, we'll see what are those parameters based on this tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably.
Okay, all right. And that's an important clarification that if you just go by the parameters that PNGRB has used, which are 2 parameters right now, then you think that between your expectations and the current order, the gap is about 5 rupees or so, not as much as 15 rupees.
Just to clear the air, sir, you'll be passing on these higher tariffs to your customers, right?
Actually, we do not have any choice. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
Okay. Sir, by when do you think you'll go back to the board, if at all, once you go through the order? Should we expect something? Can we connect with you maybe next week?
Yeah.
Because your investors need to know.
Let us go through it.
Yeah.
Hopefully next week we should be able to tell you.
Okay. Okay. All right. Fair enough, sir. So I think we'll give it a couple of days and then GAIL will decide if it is indeed accepting the current order in the current form or whether it needs maybe a round of conversations and negotiations with the board itself. Thank you very much, Mr. Jain, for joining in. That's very helpful. It does clear the air. So there we have it. The whole arithmetic and the math of the order. They had originally asked for 78 rupees per unit. They've got around 65 rupees per unit. They're saying there's a mismatch of about 5 rupees from their expectation. Going by the current parameters that the board has used, the board has only used 2 parameters. It has not considered capex and opex in arriving at this order. It's an interim relief. And I think, the stock right now is reacting down about 6%.
Yeah, I'll be interested to see whether or not there is some buying interest at lower levels, actually, Surbhi, because, some part of the street believed that they hadn't factored in this increase itself.
They were getting nothing.
Yeah, some part of that. So, a large part of them also were factoring in something. So, let's see whether or not that 170 odd level does hold out on GAIL. But let's get back to Siddharth Rai Mangala of Stock Box Technologies, as well as Mitesh Thakkar. Hi, gentlemen. First up, Mitesh, just give us a quick call on GAIL, if at all, on the charts. How's it looking?
Good morning, Nigel. I think GAIL, if you look at the last few days, it's been basically in a very tight and a narrow range. And today, I think, with the gap down, it will possibly, break that range on the downside. I think it should head towards 170, 172, which is also most likely very close to the opening price. That is where the stock had bottomed out in September, October. And if it starts trading below that, then I think I'll pencil in another 8 to 9% decline to about levels of 155.
A very crucial support zones. Got that. That's why I said that 170 odd mark was an important mark. But Mitesh, let's get your call first on the Nifty then. Yesterday we went to a fresh all-time highs, but quickly it got rejected. You think we're good for more?
Eventually, we should be Nigel, but the idea is that we cannot ignore the earlier highs as an important pivot. So I think now if somebody wants to take a fresh position, either you wait for a dip or a closing about 26,300. I think in both these cases, it will present you a good entry point. Break about 26,300 will allow you to buy with the 80-90 point kind of a stop loss, while in case that doesn't happen, most likely we'll have a dip to about 25, 800, 850 zones, which is a welcome buying zone.
Okay. Mitesh, also give us your picks then for the day.
I have 2 buys and 2 sells. On the buying side is ICICI Bank with a stop at 1378 for targets of 1420. KPIT Tech is a buy with a stop at 1194 for targets of 1270. A couple of sell calls. HL sell with a stop at 4515 for targets of 4420, and Oil India is a sell with a stop at 423 for targets of 405.
Got it. All right. Thanks, Mitesh, for that. Siddharth, happy Friday to you. Tell us what's the individual calls as well as a quick range on the Nifty.
Hi, Nigel. Good morning and happy Friday to you as well, first of all. See, if we talk about Nifty, Nigel, I actually think that yesterday's move in Nifty was quite impressive, actually, because after the sharp rally in the index on Wednesday, there was some profit booking pressure around the all-time highs, just like you said, but still Nifty very nicely managed to come back above 26,200 towards the second half and close above 26,200, which tells us that the supports now in Nifty are very strong. So the strategy should be very simple in Nifty. From here, as long as the index is above this 26,200, 26,100 range, this is a very strong support zone. Our view should be bullish for the targets trade in the range of 26,500 and 26,600, because the momentum in Nifty should definitely continue to be strong from here. Yeah.
All right. What about stocks?
Yeah, sure. Now you'll see 2 stocks. First one is from the FMCG space. I do think that the FMCG space has underperformed for a long time, but there are some early signs of a turnaround, especially in this counter. The stock's name is HUL, Hindustan Unilever. See, the stock was in a consolidation from probably the last 20 sessions, but yesterday we did see it coming out of that consolidation. So HUL can be one of the outperformers. Right now, the spot is around 2450. We can buy it here. The stop loss will be at 2425, and our targets being the first target 2500 and the second target being 2520. The second stock is Glenmark Pharma. See, for the last 3 sessions, there has been a turnaround in this counter, and I do think that this turnaround is going to continue because now the stock has come above 1900, which was a very important mark for this counter. So now the next targets are straight away in around the 2000 mark. So Glenmark Pharma can also be bought here. Right now, the spot is around 1950-ish. You can buy it here. The stop loss will be at 1920, and the targets being just like I said. The first target is 1995 and the second target 2010.
Okay. All right. Got that. Thanks very much, gentlemen. Let's quickly get to Pranav Gundapalli, Senior Analyst, India Financials at Bernstein. Pranav, apologies for the delay. We just had some breaking news with Gail. But here's the question and why we wanted to talk to you. Second quarter earnings season is over. And in this move to the all-time high, the best performing sector has, of course, been banks and financials. From here on, which are the big bank names that look most promising to you, both in terms of earnings and growth, and perhaps some valuation comfort as well?
Good morning. So I think the overall sector is in a very nice position, right? So you have growth, which is picking up. We saw this quarter that on a sequential basis, the growth rate improve, and then margins are set for an improvement as well. Even if we get a rate cut or two, we should see a steady improvement, or at least no further downside on margins. And we also have asset quality, which does not look like to be a sector-wide issue. So I would say top down, the sector does look interesting. In terms of the names, to us, amongst the private sector banks, HDFC and Axis look extremely interesting. HDFC, given that it will see its profitability trajectory slightly better than peers, thanks to some of its idiosyncratic factors, whereas Axis has the cheap valuation on its side. But the public sector banks also should continue to do well. What we see is that they are able to grow almost on par, if not faster than the private sector peers, while maintaining their 1% ROA, which means across the board, you should see steady compounding for most of the large banks that we see.
That's interesting. Okay, in terms of factors, we'll come to tier 2 banks in just a minute, but just in terms of factors that will be the biggest trigger for stock prices from here, will it be second half growth? Will it be margins not falling, maybe even expanding? What should we watch out in Q3 and Q4?
The growth would be the key. Margins is reasonably priced in that they will start improving from 4Q, if not 3Q itself. And that's not a big surprise. Growth will be key. An improvement to 13-14% growth for the sector would be a big catalyst for the entire set.
Okay, Pranav, just stay on. We'll quickly get through market opening, and then we'll come back because we need to discuss tier 2 banks as well. I mean, we just had a conversation with J&K, and some of the tier 2 banks are getting very, very aggressive with their capital raising plans. But for the time being, it's looking extremely quiet. I mean, the Nifty just about 20 points. What do you think? Will bulls charge ahead today, Nigel?
Well, I think the overall structure actually is positive. And I think the near-term support at around the 26,000 odd mark is going to be important. But the broader market, that one needs to participate because for the time being, those portfolios ain't feeling anywhere close to those all-time highs that we have been talking about. The start is more or less flattish. I don't think we have too many stocks that are moving around too much. Gale, for one, that's a stock that's taking a hard hit, but interesting to see whether or not there is buying at lower levels because technically that 170 odd mark is important. I think from the broader markets, there are a few stocks that are moving around. Voltam, I think they've got an LOI, so that stock is a little bit higher, and a couple of other names as well. But I think we're counting down a few seconds to go before we get the initial rates that come out, Surabhi. So let's brace for that.
Yeah.
Flattish start with a mild positive bias.
Absolutely. So here we go, and it's going to be about a 20-point up move. Now, can the bulls build on? That's the question. We'll start a little quiet. Will this be a big day? Or whether we'll see more of the consolidation. Right now, it's about 6-7 points up. Ticking red and green, actually. Bank Nifty is negative. Nifty's flashed a little bit of negative. So the profit taking that we saw yesterday That continues into the opening moves this morning. Let's see what's down. On the downside, Asian Paints, HDFC Bank, Axis Bank, Kotak Mahindra Bank, actually financials are weak. ICICI Bank is also slightly red this morning. Then there's Grasim, there's some profit taking on IT names like Infosys as well. Lever is down. So it's a bit all over the place, you'd have to say. The Nifty is now taken a more decisive move, 30 to 40 points on the lower side. A lot of IT seems to be seeing profit taking. HCL Tech, Tech Mahindra. Banks are a little soft. That's what's going on for the time being. On the upside, Wipro is a bit of an exception with the announcements that they've made, 1% up. M&M is seeing some traction, 0.5% on the upside. And some of the metal stocks, Nigel's favorites, they've had a good week actually. And some of that continues this morning as well. Hindalco, for instance, is still up about 0.5%. But hard to say. I mean, there's a nice tussle between the bulls and the bears. Right now, the Nifty is flat, just 10 points lower.
Well, that's right. There should be, a few stocks that are calling for attention. Ashoka, Bilcon, that they have been temporarily suspended from participating in the ongoing and future NHAI bids for 1 month. They've got a show cause notice for construction of the 6-lane elevated corridor in Kerala. So that one's taking a hard hit. That's down in today's trading session. One of the top losers, GAIL. Well, it's trading 5% lower, but it's seeing some kind of support at lower levels. So we'll keep an eye out on that one. The other few stocks that are moving up, Lenskart. There's a Jefferies note that's come in, initiating coverage on Lenskart, and they have a target price of around 500 rupees. They believe the company is well placed. The stock, in fact, is up close to around 2.5%, and it's moving on rather good volumes. Another one that's doing well is Nectar Life. I think they're going to be considering a buyback, so the street likes that. That stock is up and about in today's trading session. Varun Beverages as well is up close to around 2.5%, and on decent volumes as well. So that one, in fact, is up and about. MTAR Tech, let's pull up that stock. The promoter entity, Kavita Reddy, sold close to around 2.5 lakh shares. But you had Bajaj Finserv, Motilal Oswal, both of them were good buyers in trade. And Whirlpool, yesterday you saw some large names buying from the promoters. Promoters sold close to around 11.5% stake. And some high pedigree names came in there. HDFC Mutual Fund, Kotak Mutual Fund, ICICI Pru, among others that, did participate in that. So net, it's a flattish start. But broader markets, you have plenty of stocks that are dancing away.
No, absolutely. GAIL is still down about 5%. MCX is seeing some profit taking. Ashok Leyland yesterday, both Tata Motors, CV and Ashok Leyland, the commercial vehicle players, both these stocks were up and about. There's some profit taking this morning on Ashok. Let's pull up Tata Motors CV as well. Yeah, that's also down about 2% as we see. So Sammy Hotels, you heard the management on the show yesterday, sounding very, very optimistic about their second half plans. Sammy did a nice jig yesterday, was up 5-6%. There's some profit taking on the stock this morning. Let's see what is managing to buck the trend. Varun Beverages, like Nigel mentioned. VST Tillers and Tractors, there's about a 3% up move over there. So this is what we have. Early trends. Hudson Agro, 3% up here as well. The Nifty, by the way, has turned positive. So the bulls are trying to fight back. Tata Motors PV and M&M are interesting stocks to watch. And some of the financials seem to be, turning a corner. Financials, Reliance, and some IT names. So this is looking very interesting. Lever is now positive. Reliance is now positive. SBI is positive. ICICI Bank is positive. So this is an interesting start. Volatile, but we'll see. Bulls versus bears. The fight is well and truly on. Okay, since we're discussing financials, let's quickly round up that conversation with Pranav. Pranav, let's move on now to Tier 2 banks. So much happening, so much deal activity. J&K Bank just told us that they also are, very keen to come to the market for an equity fundraise, maybe by Q4. In the Tier 2 space, what will you watch out for and what do you like?
Yeah, I think in the broader Tier 2 space, we are seeing activity given that it's clearly a benign environment. So if somebody wants to push for growth, this becomes a very nice setup. But most of them are fairly valued at this point. We don't see something that is strikingly cheap. And a big re-rating for some of these will require a strategic shift. Now, large investments would help, but you would need more than investments to pull off some of those strategic shifts. So we'll wait and see if someone can start delivering meaningfully higher ROAs than where they are today. But otherwise, most of these mid-tier banks are relatively well priced. So nothing that screams out as a buy for us.
Okay, all right. Hi, Pranav. Good to see you. And Pranav, for the sector on the whole, credit growth has been lacking. Are you seeing signs that there is some kind of uptake out there? And for the second half of the year, what are you factoring in terms of credit growth for the industry on the whole? And what would that mean for FY26?
Let's see, FY26, we expect about 13% growth. Two, three things will help. One is we have seen some uptick from all the consumption boosting measures of the government, be it the GST cuts and rate cuts and tax cuts. So that has started to show up in the latest quarter numbers. So that's number one. Number two, you also have a favorable base effect because last FY25, the real slowdown happened towards the second half. So the base effect starts to look a lot better. And third, we have some of the regulatory relief as well. So for example, the bank lending to NBFC is slowly starting to come back. And that again had come off last year because of that increase in risk weight, which has now been reversed. So put all of these factors in, we do expect about a 13% growth towards the end of FY26.
Okay. All right, Pranav, we'll leave it on that note for this morning. Thank you so much for joining in. Good to have that conversation, that perspective. You have a great Friday, and we look forward to talking again soon. With that, let's move on and welcome our market master on the show today. Shailesh Raj Bhan, CIO Equity Investments at Nippon India Mutual Fund, is with us. Shailesh, what a pleasure to have you in. We haven't spoken in a while, so good to see you back on the show. And you're coming in at an interesting time where, yes, it's an all-time high, but it's a bit of a hated all-time high, or I call it the all-time high of disbelief. Doesn't feel like an all-time high. You know, people are not dancing. There's no pom-poms out and all that. So what's your sense when you look at the market now? Slow grind, last 12 months, not been easy. What do you think? What's coming up ahead?
Yeah, hi, good morning. See, it's if you look at the internals of the market, right, and you've seen different segments of the market actually have suffered fairly significantly. So YTD, if you look at it, there has been correction in small caps and consolidation in, say, large caps and mid caps broadly. And the differential between small cap indices and the large Nifty indices is close to 17-18%. So there has been a substantial under the radar kind of correction happening, especially in the frothier markets of the past, which, you know, we had seen last time 12-18 months back. So I think that excesses are being given away as results are in a lot of small cap businesses. The results are not have not been great, and where valuations were expecting a lot more, I think we have seen corrections. However, many good things are happening, right? I mean, from a point of view of earnings getting better. Now it's after 8 quarters, we have heard some reasonable improvement in earnings. And I think early double-digit earnings are clearly possible as we get along from here, which I think is a very good sign. Wherever there are excesses in the market, I think they still have a long way to correct because maybe 20-30% of correction in small caps has happened or some pockets has happened. But wherever there are large excesses, still I think over a period of time, if earnings disappoint there, you will have corrections coming through. So I think it's a mixed market in that sense, but getting better.
Okay, all right. Hi, Shailesh. Good to see you, Ben. It's been a while since we chatted, and you're sounding reasonably optimistic on the markets from here on. In terms of, policy support, we've seen quite a bit, right? Both from the center as well as from the RBI. Anything more you're factoring in terms of, support from the center? Because now it seems that, their headroom is limited out there. Going by the kind of freebies that are going to be doled out, the revenue collections haven't been as much as expected, and the capex spend has been higher. So your view with regard to actions from the center as well as from the RBI towards the end of this year?
I think there have been multiple action points which have happened. I think there is very little left to be done. I think it has got to do with the fact that now corporates start investing and general volume growth revive. See, a lot of challenge has been that large volume growth revival has not been there for the last 8 quarters. And when we see that happening or that kind of a revival happening, I think automatically the whole cycle will turn. So the GST cuts have been phenomenal. In my opinion, they will have 3-4 years of 5 years of benefit because it's not going to be just 1 year bump.
Right.
And even income tax cuts actually benefit for 2 to 3 years. So I think a lot of good things have happened and laid into play. I think the only problem was our markets were expensive. The money which had flown was significantly taken higher risk in pockets of the market, and which led to mispricing or excessive pricing, which is actually getting corrected. I think fundamentally a lot of things are in play, especially in the large cap side of the market. And in the small cap and mid cap, earnings will revive over the next few quarters. But more importantly, some valuation challenges still remain there. So you have to be selective there. I mean, that's the way.
Okay, all right. And, the 2 big beneficiaries with regard to the GST cut have been autos as well as consumption. Your view on both those two sectors?
So auto is clearly the single biggest beneficiary of this GST change, because I think that is visible in the first round itself. And more importantly, I think this will be visible for a 2-3 year period. I don't think these cuts only will help today, because they have repriced a lot of things and allowed a lot more consumers to come into the participation space. So I think auto clearly remains a very, very strong opportunity, especially the passenger four-wheeler space, right? Because there has been slow growth for the last several years there. Coming to the consumption side, right? See, consumption side has been suffering more from lower volume growth because of the real slowdown in the urban as well as the rural side of the market for last 8 quarters now. I think there is less optimism there, but I think where there is zero optimism, even if there are small changes in terms of earnings and all, I think there is opportunity for returns to be made. A lot of these companies have derated now for 5 years, 7 years, right? And it's now we have seen some of them now talking about pushing volumes at the cost of margins, driving growth. I think when the direction changes like this, in all probability, next 3 years will be good for consumption.
Got it. Okay. All right. Sailesh, let's talk about, this RBI cuts and a lot of attention on the NBFCs. The cost of borrowing goes down and there's hope that credit growth continues to pick up from here on. How are you all placed on that space? Because, we talk about FI selling and not participating too much. There'll be that split argument that they participate in the primary market, maybe they're selling in the secondary market. But the sector that's got a lot of interest and has got an earnings tailwind as well is the banks and financials. How are you all placed there and what do you like?
Yeah. Clearly, large banks and large NBFCs are still far better priced than most pockets of the market.
Okay.
They have seen their challenges and, a lot of FI selling has also been in these pockets till the last few months, right? And hence the prices and valuations are still sensible compared to most parts of the market. If you look at some large banks haven't delivered even single-digit return in the last 12-18 months. So I think the valuation comfort is significantly there. And the whole upside from a point of view of credit growth coming back and margins stabilizing and improving, I think it's lies still ahead of us. So within the available spaces which are there today, banks and insurance in these spaces are far better priced, especially large banks and large financials seem to be very sensibly priced there.
Okay. The other debatable topic has been on tech.
Yeah.
The bearish argument is no growth, why to give it a multiple? The bullish argument is, if you look at the cash flow yield, it's very good. Maybe the worst is in the price. Underperform, under-owned. Which camp are you in, Sailesh?
So clearly, I think there are, the challenges which are there, right? They are visible to everyone now. I think so. It's a visible challenge, low growth, but I think valuations are far more sensible than they have ever been, I think, in the last 5 years. So I think we are more towards looking at it as at least a market participant. And I think if there are surprises in terms of growth continuing to be maybe early single digit or rising to 7-8% over the next 2 or 3 years, I think you can find reasonable returns to be made. See, growth is a little slow everywhere. So it's like relative growth is possibly likely to turn here and expectations are very, very low. Like in consumers, the expectation of recovery is virtually not there. Even in IT service, expectations are running very low. Most people will talk about 5%, 6% kind of growth expectations. But end of the day, in their minds, I think they have believed that IT services cannot grow at all from here. But I think the pricing for that and the valuations for that, most of them would be at 4-5% dividend yield and throwing significant cash and can re-engineer. It's possible they re-engineer. So we are more on the positive side from here on than, possibly last year, because there is enough and more derating in that space.
Okay. All right. Final word before we let you go with regard to returns. Getting into 2026, it's been a challenging year, actually. The Nifty to get away even with a close to double-digit return is very, very heartening. Do you think investors should brace on an average for the next few years of low single-digit returns? Would that be a fair ask? Because I'll tell you what, the period post-COVID spoiled a lot of investors. People got used to saying 20-25% is par for the course. That's not par for the course. Do you think low teens returns from here on is something that we can expect in the coming few years?
Low teens is a best case scenario for returns, I think, is what we see for the next 3 years, unless there is some explosive growth recovery. See, a few things which we are not in full control is what's happening in this global geopolitical side. If things stabilize, their growth recovers for some reason, those could be surprises, but you can't go in with those assumptions being in your favor. So I think earning-led returns is what is possible, and earnings generally can trend between 10 to 13% is what we see. And if you have this kind of a outlook and this kind of multiples as a starting point, I think P multiple re-rating is maybe a very small probability event from here. So I think it's more earning-led, and hence returns would also possibly follow and track earnings. I mean, that is where I think the base case is for us.
Shailesh, the other trend of the year has been the red-hot IPO market and the underperformance of the broader market. I mean, this has largely been a rally about big banks, the larger stocks, right? So two different questions. One is on mid-caps. I'm sure you get asked this all the time, that from here on, now the Nifties are at an all-time high, broader market hasn't performed. So do you expect a better recovery in mid-caps and small caps? That's one part. And secondly, what do you think of the super hot IPO market?
The recovery in earnings has to be there to drive the recovery in small and mid caps, right? So if you look at both small and mid caps separately, mid caps still trade at fairly expensive valuations. So they have not corrected so much. They've actually done well versus what expectations were last year. And these are very high quality businesses between 30,000 crore to 1 lakh crore market caps, and they have done reasonably well, and they have not corrected so much. So there is no easy money lying there. Only earning rate return possibilities exist there. In small caps and more in smaller small caps, the corrections have been sharp. If you look at corrections below 10,000 crore market caps has been very sharp, and generally between 10 to 30 have been okay. So I think there also internal markets are a little too different there, So where there are substantial derating already happening, I think maybe there are some opportunities which are coming about. We have seen some in QSR space, some in some other areas. But in most places, there is still either a valuation correction or large earning positive surprises have to come for us to make good returns out of it. So we think still a SIP-based approach to these categories is still a better way for at least the next 12 months, and then possibly either earning uptick happens sharper than what we are anticipating, which can lead to possibly better returns. On the IPO market, I think it's the most debated. So clearly there's a lot of supply. There's a lot of FOMO, and we've seen a lot of participation by a lot of investors. And we think given just the flurry of IPOs and generally the pricing of IPOs, you would find that because there is very limited time in evaluating these businesses, and these guys don't have a governance track record because they've not been in public markets till now. So at least the public market governance track record is not there. I think this market will have or can potentially have challenges in the next 3 years. So investors looking at this market and investing and choosing have to be extremely, extremely careful in terms of, one, what valuations are paying and what type of managements and businesses are being backed. So I think clearly there is significant supply, and also the fact that the supply is not at very attractive prices. So typically a company without a 5-10 year public track record should actually come at substantial discounts to listed companies. And when we are finding listed companies themselves expensive, then you would expect that the IPO company should trade or come at far lower valuations than that. But because of the demand and because of the significant interest there, we are not finding valuations cheap there at all.
Oh, okay. Well, it is a red-hot market, so I guess the message is tread with caution. Yeah. Take that on board, Shailesh. Thank you very much for joining in. Great conversation. We look forward to connecting again soon. You have a good rest of the day. Well, with that, let's move on. We have Nimesh joining in with today's standout brokerage report of the morning. Nimesh, which one have you picked out?
Hi, sir. Today's standout is on Paytm. In fact, the stock is reacting as well. The biggest F&O gainer. We missed out highlighting in pre-open, but nevertheless, there's a big upgrade coming in from Goldman Sachs and Paytm. So they've upgraded the stock to a buy, and they've raised the target price sharply to 1570 versus their earlier target price of 705. Now, they believe that the regulatory environment, which has been the biggest drag on the stock in the past, that is incrementally getting better. In fact, Goldman believes that this is going to translate into an early signs of recovery for Paytm's payments business, as well as the earnings visibility. So Goldman is now saying that the company can sustain 20% plus revenue growth in the foreseeable future. Additionally, there could be more upside to the earnings if there is any positive changes in the intervention of the payments market. Basically, they mean if there is any increase in the MDR, and that would mean there could be further market share gain as well. On back of all this, Goldman Sachs expects that the EBITDA margin can double for Paytm in the next 3 to 4 years, and at this price, the risk reward is quite favorable according to the Goldman. So hence, a big upgrade to a buy now on Paytm, and Goldman has sharply raised the target price now to 1570.
Okay, all right. We'll keep this on the radar. Stock's doing well right now. Thank you for highlighting that, Nimesh. Well, with that, let's move on to another corporate conversation. And we're putting the spotlight on the IT space. And the company on our radar is Happiest Minds. Now, you would have seen that over the past couple of weeks, several brokers, including CLSA and Motilal Oswal, they have upgraded the IT sector. And they're expecting a better performance going ahead. So is there something really shifting on the whole AI front? Is the second half going to be stronger for Indian IT companies? Well, let's put those questions to Venkatraman Narayanan, MD at Happiest Minds. Venkatraman, thank you very much for joining in. And I really want to start right there. We're all trying to understand the implications of this great AI moment for India. And I'll tell you what has shifted. A lot of these brokers whom we spoke with, their argument is that the AI build-out stage is probably peaking now. You know, the billions and billions of dollars of infrastructure that the likes of NVIDIA and the others are putting up. But as we move deeper into the AI adoption stage, that is when Indian service providers will make a comeback. And the use of AI in the delivery of services, that's where the numbers and the growth and the deals will start coming back on stream. Now, you tell us, you're a participant, so I'm sure you'll have, to that extent, you'll have a slightly biased view. If you all want to believe this. But can this really happen? What are we in for as we're looking at AI and Indian IT in 2026?
I think you got it absolutely right. Just like any capex cycle, you have a capex build out, and then the revenue cycle starts after that. If you look at the AI boom or what's been happening across the world, it's been billions and billions of dollars being poured into the infrastructure part. But for anything in the tech or technology space to really take off, you need to create ecosystem. You need to take up. There has to be adoption, and both of these happen only through what you call a social media effect, or what you talk about adoption by people who want to use it for furthering their business. So until now, what's happened? The infrastructure build out is happening. You have got the large tech companies pouring billions into it. Now, to make sense of this for the enterprises or for application service providers, you need the services to be built around it. And then you have service partners like us help that build out. And this has been how it has been, let's say, many years back when the ERP boom happened, where the software services, people coming out with big bang approach on the ERP, but you then need the consultants to do the re-engineering, remapping, and implementation. And that's where the consulting services companies and the tech services companies really came into to the fold.
But Venkatraman, if you could dive a little deeper, what makes you confident then that Indian IT service providers will be able to capitalize on this opportunity the most? I mean, there will be competition from the likes of Accenture and the other big, consultants as well. So, and till now, we don't have very definitive numbers for the industry as a whole, even for individual Indian companies, that, what will the AI part of the revenue be? So for the street, it's also a little hard to map this. If you could give us some more light.
Yeah, I think we have been one of the very few companies that have set out ourselves the goal of, setting out the numbers that we get from AI. We started out by making it a segment for ourselves. Yeah. So right now, 2.7% of our revenues comes from AI. The difficult thing out here is almost all the work that we do today is AI-led. How do we differentiate between what is core AI versus what is AI-led? But that's a challenge that we'll come up to later. But as of now, the way we are identifying core AI business is about 2.7% of our total revenues. And we are looking at that growing to about $7 to $8 million by the year and grow to 5% very quickly. And we have also put out the points that we have got 22 use cases right now, replicable sales or replicable use cases, which help enterprises adopt and make the most out of the AI infrastructure that's being built out. So that's something that we have set out, and we have also said that the revenue potential for somebody like us is about $30 to $50 million from there. We have signed up 30 new customers, and almost all the customer signups, I would say 28 or 29 out of the new customer signups that we have been AI-led. So you're seeing how we are becoming, the approach of being an AI-first, AI-led company is helping us. And all of this on the services front. Let me say that as well. Because, we are not doing anything on the infra side or setting up infrastructure side. Yesterday, for example, we have launched our own agentic AI support AI platform called Elera. We have released a press release on that. Shows that we are getting ready to even tackle the L1, L2 part of services side from with agentic AI support. So this is where we are coming from. And the Indian IT services company, when we say we have done 22, I'm sure the other companies are also building out similar use cases, and they are also.
This Venkat, this $30 million of an expected pipeline, AI pipeline. This is over how many quarters? By when?
No, we have not given. We have said over the next couple of years. That's what we have said. Because you have 22 use cases. We have started seeing traction with our existing customers, and then you do an arithmetic of how you will sell this into existing and the new customers in the prospect database, and have come to a number that's how we have come up with this $30 to $50 million.
All right.
Just like the 30 signups will likely lead up to $50 million is what we have said. Because what's the kind of run rates that we have today? You have the run rate multiplier, and then that comes to about $30 to $50 million. You have to build it piece by piece.
All right. Hi, Mr. Narayan. Good to see you again, sir. Give us a few more details. Sneak peek into Q3. How have deal wins been? How have logos been? And if you could give us a sense on furloughs for Q3, a broad sense.
We have not seen that high numbers in terms of furloughs as of now, or at least we have not got any indications of that. Because in our business, as we have said in the past, we do have furloughs with a couple of clients, but it's not something that's uniform. Yes, Q3 for the industry typically is slightly on the weaker side, but we have been confident. We have said that we'll do our double-digit growth for the year. We have done 11.8% half year over half year in dollar terms, and about 2.3 QOQ and 6.7 half year over half year. So what we are saying is we'll see a similar kind of growth continuing in Q3. We will have some small impacts of furloughs, but then we missed out some growth in Q2 thanks to pushing out of the product, the Artha banking product revenues going into the next quarter. So that should help us set off. That's how the numbers stack up for us in Q3.
Okay, and you're rather confident, right? Next few years, double-digit revenue growth is there for the taking.
That's right. That's right.
And all
in fact, I had the opportunity of hearing the gentleman just before me from Nippon. He was talking about how the expectation is very muted from the tech sector. So I would say, compared to that, happy to say that we are still keeping our numbers high at about double-digit growth, and hopeful that we'll continue to perform on that basis while capitalizing a lot on the AI flood that's happening currently.
Any inorganic growth is what you're looking at?
Yeah, that's something that's consistently on our radar. When we have something more solid, absolutely, you'll be the first to hear from us.
Venkatraman, what will this AI expansion, what will it mean for margins? In the past, you've said that you'll probably be maintaining margins at the current level of around 20%. But what's going into those conversations on pricing, on upskilling the workforce? Tell us more.
Yeah, so on the margins front, I think it's only going to improve because the AI business of ours has started breaking even. I would think at least 6 months ahead of what I thought it would. I'm happy to say that from Q1, Q2, we have started breaking even. And it's starting to pull in margins into the company. So that's something that's been helpful. The new sales engine, which is where we were pouring money in or investing, that's also beginning to show results. Like I said, we have got 30 new logos, and it's that with potential of $50 million over the next couple of years. So investments that you make are beginning to show results and help margins. On the pricing side, yes, AI, the pricing for AI capabilities or AI services is slightly a notch higher than what we do in the digital side. So that's something that's helping us. But yes, continued investments into new technologies, retraining people, making sure that utilization continues to be high. Because that's a challenge. You have to retrain, repurpose, get people adapting and adopting the new technology. So for that, we will be making investments. Also, compensation levels could be slightly higher. So those things will continue. It's something that we have to do.
So to go back to the timeline that you shared, by the time that you are pulling in $50 million from AI, and you said that's over the next couple of years. I mean, what is the margin trajectory? Will it be slightly higher? But then you were saying that obviously you have to pay more to these.
It should be higher. It should be higher. Today we are at an operating margin of about 17.2%. And this is, I don't want to use the way slide down, but it has come down from the 18.5, 19% in the earlier part of, let's say, early part of last year, primarily because of the investments that we made. So these investments, when they start paying off, you have to start gravitating towards the 18% operating margin. So the thought is always to grow with margins, protecting margins and growing margins.
Final question, sir, before we let you go. What about your investors? They have been hanging in there. Those that got in the IPO will still be happy. But some who have bought in the last few years, they'll be wondering what's happening to the stock price. Management sounding optimistic. Yes, the sector has gone in a bit of a tizzy, but the stock price has come down dramatically. If you had to give them a message, what would it be?
Stay strong. Again, I'll go back to the conversation the gentleman was talking about before me from Nippon Mutual Fund. He was saying that, an IPO is only start of the journey. We are 5 years into the journey, and we have not, caused despair to our investors, at least from the performance, the company's fundamental performance. Pricing is something, which is relative, which has got quite a bit of sentiment attached to it. Many of them beyond our control sometimes, and that's what seems to have happened. But as an industry, we stand tall, we stand strong, and I think the AI, there was a little bit of angst with AI, but I think the industry will continue to grow, will continue to take up every opportunity to go deeper, work for our customers, and make sure that we really pay back our shareholders and stakeholders.
Well, I think those shareholders are happy listening to you right now, Venkatraman. Stocks up 6-7 rupees over the course of this conversation. So we wish you, your teams, all the very best as you move forward. But there you go. I mean, you have an industry player basically verifying what some of the analysts have been saying, and that's the point that we've been making, highlighting some of the brokers like CLSA, like Motilal, all of them saying that you have to move past the build-out stage. That's where India wasn't present. We don't have billions of dollars pouring into AI build-outs, the chips and the data centers, etc. But when it comes to using AI to deliver services, that's when the Indian companies will make a big comeback, something that Mr. Venkatraman has also agreed with. With that, let's take a very quick break, but we'll come back on the other side. The corporate conversations continue, and we'll be in touch with the management of IGI, International Gemological Institute, and we'll figure out how the second half trends are looking like for the diamond certification business.
Welcome back. Well, just a quick check on some of those metal-related stocks. You know, as our ticker team was telling us, silver prices are moving to fresh all-time highs, and that's why Hindustan Zinc is seeing very, very high volumes for the first 30 minutes odd, because that's the only play on, on silver. So that's up close to around 1.5%. Very, very volatile moves is what we see on Hindustan Zinc, so keep that in mind. And Imphal is the other stock actually that's higher because ferrochrome capacity is globally, there's been a bit of a shutdown owing to the high cost of production. The recent shutdown overnight is the Samankor chrome, smelter that we saw. So the overall cost of production is going up. That's resulting in higher ferrochrome prices. And in turn, Imphal is gaining because they're backward integrated. So explains why a stock like Imphal is up close to around 5% or thereabouts. That said, let's move on to IGI. We have Ishwar Iyer, the CFO, who joins us on the show. Hi, sir. Good morning. Good to see you in, Mr. Iyer. Tell us, how are you seeing business prospects shape up? And, what's the outlook like towards the end of this year and for the next year as well? If you could quantify the kind of growth and profitability you're looking at.
Well, good morning, Nigel, and thanks for having us back on the call. Yeah, it's been some time since we last met. I think the Q3 performance was in sync with whatever we have actually been speaking over the last 2 quarters prior to that. We grew around 26% on volumes and around 20% from a revenue standpoint for Q3. So YTD, in line with what we had given as the guidance at the beginning of the year in terms of 15% revenue growth and 20% EBITDA growth, YTD we are at around 16% of certification revenue growth, and EBITDA growth is around 22%. So I think we've been on, in terms of whatever guidance we had given at the beginning of the year, we seem to be, being able to deliver that during the course of the first 3 quarters.
Okay.
I think the business continues to be robust. Obviously, we're expecting some headwinds because of the tariff, etc., but that haven't played out, at least in Q3. So we continue to remain very optimistic about the business performance for the Q4 and again for the next year.
All right. So you're saying, 15 to 20% revenue growth is something that you should be growing from year on, and margins holding in the mid-60s. Is that correct?
That's right.
Tell us about growth, vertical wise. How do you see the revenue mix shape up? Because last quarter we saw the natural diamonds out there, that segment growth was even higher than lab growns. Is this, a bit of a turn, a bit of a pivot that's taking place? Do you expect more of the same?
Yeah, I think, Nigel, I think while the lab-grown segment has enabled us to propel our volumes over the last 3-4 years, I think our focus remains on certifying diamonds. So we have separate verticals to manage natural diamond, the business, a separate vertical to manage the lab-grown diamond business. So each of the functions are delivering in terms of, what is the expectation as far as either gaining market share or holding fort where we have high share. So I think all the levers have worked in Q3, and also it coincided to be the Diwali quarter, right? So we have obviously natural diamond and natural diamond jewelry also shaping up pretty well. So yes, natural diamond had an exceptional quarter. We grew some 29% in this quarter, and YTD again we are at around 14%. So I guess this is a combination of being extremely focused on the key revenue segments for us, which is both natural diamond as well as lab-grown diamond sector. So from that context, I think we've seen some extremely strong performance across all the 4 segments during this quarter.
So, Ishwar, however, this trend that we've seen with the natural diamonds doing better for you this quarter, was this just a festive season phenomena, you think, or is there something more to it? Is there something more changing?
See, I think we're making significant investments as far as building capability around this vertical as well, because the natural diamond segment is an important segment for us. So, from that context, we continue to be extremely focused on this segment as well. So what we are seeing, I think YTD we are at 14%, and I think it's in line with what we've been expecting from this vertical in terms of 14-15% year-on-year growth. So from that context, nothing out of line. I think it's in line with what we've set ourselves internally as the target that we have to focus on for the natural diamond segment during this year.
So your average realized price, looking at the data that I have before me, that showed a year-on-year decline to about 854, if I'm looking at the right numbers. I'm guessing this is the average price of certification, right? Can you walk us through what's going into the mix now? Because you're doing, across segments, lab-grown diamond, natural diamond, lab-grown jewelry, diamond jewelry. So how is the pricing shifting for each of these segments?
See, in line with what we've spoken in the past, I think over the last 14, 15 months, we've seen extreme stability as far as the lab-grown pricing is concerned. Obviously, natural diamond or the jewelry segment, those pricing have been pretty stable over the last 2-3 years. But yeah, importantly, the lab-grown businesses remain stable since the pricing correction that we took up last May, which is April, May of 2024. So from that context, pricing has remained stable. Obviously, a slight up and down on the average realization in each quarter is consequent to the mix shift that happens between segments. So from that standpoint, I think we've been extremely stable. Nothing structurally that has changed over the last 3 quarters.
But certification of lab-grown diamond jewelry, again, I'm sure it's a growing business, will be a high-volume business for obvious reasons. But in terms of just the pricing, I don't think this would be too margin accretive at this point, would it?
See, for us, both be it natural diamond or lab-grown jewelry, I think the pricing has been around $3 to $5 per report. I think we are expecting that volume to really help us build up the revenues and the margins. We are not looking at it solely from an average sales price realization standpoint. I think it's an emerging segment for us. We expect the India market, the India consumers to come into the fray. So this this vertical is just starting to build some scale. So I think the focus will be for us from a volume standpoint. We're not too perturbed about what the average realization is going to be as far as lab-grown jewelry is concerned. It's an emerging market. I think we have to participate in it in its fullest form. And with the way the gold prices have behaved, the silver prices have behaved over the last 3-4 months, I think it's an emerging market which has the potential to really leapfrog other segments, because with the combination of lab-grown diamonds and the high pricing for gold and jewelry, we expect this vertical to really dramatically scale up over the next 2-3 years.
And lab-grown, I think, is around $15 per certificate, right?
That's
roughly.
Right. Yeah.
And natural is approximately double of that, if I got that.
Around 3 times, around $40-$45.
40 or closer to 2.5 to 3 times at least. Got it. Final question: what about market share?
Okay, again, I think the growth that you're seeing in natural diamond, I think that is consequent to some market share gains that we are seeing in India. Lab-grown will continue to do pretty well. I think we are a significant player in the India market as well as in the global market. So I think market shares continue to remain stable for other segments, and we are actually seeing some market share gains in natural diamond, which is what is propelling the growth in that segment.
Okay. All right, Ishwar, we'll leave it on that note. Thank you very much for joining in and giving us some perspective on the business. That's IGI as the trends shape up for the second half of the year. Let's look at how trends are shaping up in the market. The good news is that some of the big boys are fighting and fighting really well. Reliance is up a whole 1%. There's a broker note. I think it's a Jefferies note, if I'm not mistaken. It's quite optimistic on Reliance, and we'll get to that in just a bit. And then you have Lever pitching in, L&T pitching in, SBI pitching in. Some of the big boys, they have started contributing on the upside. Nagaraj Shetty is with us, so let's ask him what the trading approach should be for today. Nagaraj, good morning. So once again, getting close to yesterday's highs. We're 50 points away from that. What's your plan for today?
Good morning, Survi. Yes, certainly market is in a strong uptrend. Current consolidation after a sharp up move is indicating the uptrend continuation pattern. I'm not expecting any bigger hindrance from here on out, so though there is a slight resistance around 26,300 odd levels. For me, the upside target would come around 26,600 or something, where the Fibonacci extension would cluster in at the higher levels. That is going to be the target for the Nifty in the near term. And on any dips, on any consolidation, 26,000 to be watched as a support level for the market to bounce back. Okay. All right. Hi, Nagaraj. What about individual stock calls? Hi, Nigel. I have 2 stocks, one from IT side, one from chemical side. IT side, LTI Mindtree, chartically has been in a good uptrend. Higher tops and bottoms on the chart is indicating a positive bias, and currently trading around somewhere around 6,050 levels. I'm expecting it to move up further from here onwards. One can look to buy around this level 6050, and the immediate upside target would be around the 6350 levels. One can place a stop loss at 5850. Second one is from SRF. SRF, after a decline, seems to have formed an important bottom reversal just below the 200-day EMA, I think looks like the worst seems to be over for SRF. Currently trading around 2922 levels. One can look to buy at current market price, and the upside target would be around 3,150 for the stocks, and one can place a stop loss at 2825.
Okay, all right, Nagaraj, we'll leave it there. Thank you very much for joining in. Let's take a quick break. Coming back on the other side, all the commodity cues with Manisha Gupta. So both the notes that have come out from Jefferies are seeing stock reactions today. Lenskart is one. Lenskart is at 414. Jefferies thinks the stock can go to 500. They are identifying some levers there. And the other one is Reliance. I'm just checking the price target on Reliance, 1785. That's what Jefferies thinks Reliance can do. It's basically highlighting, the brokerage is highlighting that all of Reliance's businesses are firing and are all set to deliver double-digit growth this year. And they think that with the Jio IPO happening, perhaps there will be another round of tariff hikes. So those are some of the triggers because of which Jefferies feels that Reliance is all set for higher levels. And it's definitely helping the market's case as well today, taking things up and higher. We'll have Manisha join in the next couple of minutes. By the way, look at GAIL. GAIL has still not recovered. Despite, all the assurances from the PNGRB that this is only an interim relief and more will happen in FY28, the fact is it's been disappointing for the market. The market expected 20%. The company was seeking a 33% hike. What has been delivered is 12%. And that disappointment still visible on GAIL. But Nigel, the rest of the market has moved on. 50 points up on the Nifty now. So it's perked up.
Well, that's right. And the stock that we just highlighted, Hindustan Zinc, the only way to play silver, because I think close to 45-50% of the EBIT comes in from the silver business. That's moved to the high point of the day as we speak. Volumes fairly high as well. But on that note, let's hop across to Manisha. She's here to tell us what's going on in the commodities market. Manisha, take it away.
Well, taking cue from what you were just talking, Nigel, I'm talking about silver, by the way, because we're just $0.50 away from all-time highs yet again. So 54.5 is an all-time high, and we seem to be trading around that $54 ounce mark right now. For the year, prices have gained up by 87%. And, the silver rally started from mid-October in 2023. So when you look at the prices from there on, it has gained 165%. That's the kind of return that silver has given you in last 2 years itself. In the month of October, 2023, silver was trading at around $18 to $20 an ounce, and it's trading at 54 right now. All-time high has been 54.5. We started this year with 29.5, and it constantly has been gaining since then. We did 45.5 by the month of September, and from there till time, it has been $10 an ounce of a jump up coming in. Silver has seen some profit taking since the time we saw all-time highs there. It did go down to 47 as well, but the rebound that we have seen in the month of November clearly has been quite strong, giving us nearly 15% of gains for the month of November itself. Well, 85% probability of a Fed rate cut in the month of December is something that has been supportive. And then the street is counting in that you might perhaps be looking at 3 more Fed rate cuts by the end of 2026. And that is the whole of next year is also supportive for prices. Take a look at the kind of silver demand that we are looking at. Well, the industrial demand, we did see an all-time high of around 689 million ounces last year. And the expectation is that you could be looking at that number or slightly higher, up to 700 million ounces of a record number in sense of industrial demand for this year as well. Within the industrial demand, it is the solar panels which really are giving us a very, very strong numbers coming in there. And that is what you should be looking at, because 2020, the solar panel demand was at around 94 million ounces. Last year was 243 million ounces, with an anticipation that way the industries are going towards solar panels, not just India, but various other global markets as well. You could be looking at some more support continuing there. Take a look at the silver market deficit as well, and that has continued to be on the stronger side as well. This is going to be a 5th straight year that you're looking at a deficit in silver space, and that has been supportive. And then, of course, we are looking at strong physical, ETF, institutional buying. All of that has been very, very supportive. A lot of people bought physical silver in India, and that has led to a lot of premium coming in for the markets as well. Well, where is silver headed going forward from here? Macquarie, for one, is the most bearish of the lot. They expect that silver could be looking at an average of $35 an ounce of a price in this year. Everybody else is into 40s and then in 50s as well. World Bank, Citi, Deutsche Bank believe that $41 to $45 of an average price is what you could be looking at in case of silver. Target prices for silver on the higher side could be as high as 65. There have been targets of 70, 75 as well. But most bullish clearly seem to be Bank of America and Goldman Sachs. We're giving up $65 an ounce of higher side targets. So while we are very, very close to all-time highs for silver right now, the expectation is that you could be looking at this outperformance continuing in next year, and much higher highs is what you could perhaps look at.
Okay, all right. Thanks a lot for that, Manisha. By the way, some comments coming in from the HAL chief clarifying that there's absolutely no problem in Tejas, and saying that that export potential does continue. Some initial comments that are coming in there. Keep an eye out on the bottom of the screen. Post those comments. We are seeing that the stock has perked up a little bit on the screen. But talking about stocks that are perking up today, Lenskart. Jefferies has taken a closer look. The lens is on Lenskart. They believe that the stock could head higher from here. Vinny joins us to give us details on that particular report. Vinny?
Hi, good morning. So Jefferies has initiated coverage on Lenskart, buy rating, target price of 500 rupees per share. And do not forget, it is India's largest tech-driven eyewear retail holder with 5% market share. Now, what will do well? One, they believe that offers are quite strong in terms of the growth potential that is there, that comes in from Lenskart's point of view. Other than that, they believe verticals They're quite integrated, omni-channel model that is working out. So cost efficiencies there, rapid deliveries there, superior customer experiences there. And India serves as a bedrock with more than 85% contribution to EBITDA coming in there. Also, they are seeing that there is good unit economics, which are quite attractive, fast payback is there, and that should be something that will drive a 50+% adjusted EBITDA CAGR growth. So they're quite positive on the growth for the company in the next 3 years as well. And do not forget, the company will be reporting their numbers tomorrow, so we'll keep an eye out on that as well.
Okay, all right, Vinny, thank you very much for that. We'll take a quick break on that note. We'll come back on the other side and get you excerpts from our exclusive conversation that we had with Jonathan Garner of Morgan Stanley. Okay, keep your eye on the IT index carefully, because what has just come through is a very, very, very long, elaborate Thanksgiving post from the US president. What is important for us is that he is calling out for, immigration and how there needs to be reverse immigration out of the US once again. And for the benefit of our viewers, I'll just read this out. Some of the flashes are all on your screen. He goes on to say that, the goal will be pursued with the aim of achieving a major reduction in illegal and disruptive populations, included those admitted through an unauthorized and illegal approval process. And then he's saying that we will permanently pause migration from all third world countries. So, I mean, and then he goes on to say that we will pause migration from for immigrants who are not in sync with the Western way. So some of this is fully open for all kinds of interpretation. Not quite sure, what the specifics of this will be, but it's something that's really important. Even as we have progressed technologically, immigration policy has eroded those gains and living conditions for many. I will permanently pause migration from all third world countries to allow the US system to fully recover, terminate all the millions of Biden illegal admissions, including those signed by sleepy Joe Biden's auto pen, and remove anyone who is not a net asset to the United States or is incapable of loving our country, and end all federal benefits. Now, again, like I said, it's very, very loosely worded. How do you define who is not a net asset to the US? Short point is, from a market perspective, we need to keep this on the radar. The Nifty IT index is not just the best performer this week, it is among the best performing indices this month. And some profit taking is getting triggered. Some of this could just become excuse to take profits. And you just heard that conversation with Happiest Minds. Off late, the street has started taking a more favorable view on IT stocks, seeking, some value buying at lower levels after long underperformance. So if you look at a one-year chart on the Nifty IT, it hasn't done much. It's still about 18-19% off the peak. But the last 1 month has been very positive for IT. But now these comments on immigration come in, and they have led to some caution. Now look at that. A very sharp profit taking on the IT index. Let's pull up individual IT stocks. Let me quickly check if some of the bigger names, whether they are seeing any reactions as well. Pull up Infosys, it's down about 0.5% right now. Wipro is also losing some of the morning gains. HCL Tech is slightly lower, and TCS will come up on your screen as well. So IT becomes a watch point given all this commentary that's coming in from the US president. We'll get you more on this as it transpires, but actually there is no more. He has simply said that anyone who is not fitting in with the Western way of living, anyone who's not a net asset for the US should not be allowed to stay in America. But it's also in contradiction with a lot of the commentary that he said on immigration in the past, specifically when he was talking about all the investment, for instance, that South Korea is going to be making in the US, where he says that we do need smart workers to run those factories, which are being put up with the help of investment coming in from some of these Asian giants. So let's see. Many times Mr. Trump ends up contradicting himself. We'll have to wait for the fine print on this one. In the meantime, let's get you a special conversation. As the Nifty scaled new all-time highs on Thursday, we caught up with Morgan Stanley's Jonathan Garner about the Indian market. And we began by asking Garner, who still remains very overweight on India, by the way, whether he thinks that the Indian market is once again looking attractive to foreign investors.
Yeah, so India outperformed 4 straight years, 21, 22, 23, 24. So you're right, there's been somewhat of a give back in performance relative this year, though obviously the absolute returns have been there to some extent. As that's happened, the valuation relative has fallen substantially from about 1 standard deviation above long run average versus other emerging markets to about 1 standard deviation below. And I think the reason that relative derating happened is that relative earnings growth momentum slowed. So we had a marked pickup, particularly in North Asia, in markets like Korea and Taiwan, which are very rich in terms of semiconductors, tech, hardware plays on AI, and to some extent, some limited extent in China. Nominal GDP growth slowed in India, slowed probably more than we thought at the beginning of this year. But as we look forward, our economists are resolute, and certainly, as you just mentioned, the market's starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. I think on the other part of your question, I think often when I've been on your shows, you've asked about the foreign investor, the FIIs. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year.
What's the overarching view on Asia and emerging markets? As we were discussing,
Emerging markets have come off an exceptionally strong year, particularly say a Kospi. That's up 66%. But the gains are concentrated. It's led by AI, semis, all the technology plays. So first, if you could tell us the big view on emerging markets going into 2026, what do you like, what do you not like, and why? And secondly, if the AI frenzy were to cool, not a bubble, pricking or bursting, but just some moderation in the optimism, then how does it affect the dynamics?
Thank you. That was another two-part question. So I'll try my best to remember both parts of the questions. So I think the first part of it about emerging markets overall, I mean, this year we had a tailwind from a weak dollar, particularly in the first half, and that eases financial conditions in emerging markets. We had a lot of multipolar world dynamics, as we call it, the whole trade and tariff debate. And that certainly around April, May caused almost all markets to fall. When we actually, sorry, I can hear some feedback. When we actually go through the second half of the year, it's right, that dispersion in performance was very significant. But going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small. And most of our other market calls are relatively contained. And we're just arguing that to have a robust approach, investors need to focus on stock picking and they need to be quite nimble. We're not done with macro volatility globally. We're living in very uncertain times. So it's not a sort of a bang the table opportunity on any individual larger market here for us. Thank you.
Jonathan, coming to India itself, before I get into macros and the sectors that you like, Maruti, that is one stock that is on your focus list, right? I wanted to understand what do you like about it right now? You called it a potential beneficiary of the GST reform and product pipeline strength. So what differentiates Maruti today versus 2 years back when we were talking about it suffering from the EV threat? What makes you so bullish on this one?
Yes, I mean, in terms of talking about individual stocks, I don't tend to do that on these because we have analysts that cover them. But what I would say is that it's in the right space in terms of GST, it's a consumer discretionary. So when you get these cyclical upswings in activity, it's the kind of thing that tends to work well. And obviously, it's a stock that our analysts cover and that we know well.
What about sectors in general? You have highlighted more upside in, say, financials, industrials, and consumer discretionary. What is the strongest bottom-up signals that you're getting from these three sectors that make you bullish here?
Yeah, we're overweight financials, consumer discretionaries, under industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
Jonathan, you mentioned we are living in uncertain times and the fact that the macro instability is not over yet. But India as a economy in general has had relatively stable macros, right? Because the first quarter GDP print was fairly robust, almost close to 8%. Polls for the second quarter GDP are also indicating a similar sort of print at around 7.5%. Do you see this economic stability as an outlier compared to a lot of the other global markets, or will this uncertainty around this trade tariff deal with the US be a bit of a dampener going into the second half?
Yeah, so actually the drop-off in inflation in India is important. I mentioned in answer to your earlier question, nominal GDP growth, which matters much more for corporate top line than real GDP growth. And I think that's where the negative surprise came in. I think effectively the decline in inflation is telling us that policy was too tight. And likewise, credit growth actually falling to low single digits. This is not what one should be expecting from an economy that is still developing very rapidly. So what we're anticipating, hopefully, is that with the policy easing measures that we've had, the nominal GDP growth environment will accelerate, as I said, from kind of mid-high single digits to mid-low teens in the course of next year, and that will reignite the corporate earnings profile, which softened relative to those markets we talked about earlier that had a very strong year, the AI, tech, semi-capex kind of markets. They, by the way, are likely to continue to post strong earnings growth next year, maybe decelerating somewhat, but they will still be growing earnings next year.
Jonathan, we have been talking about how global markets have been faring, a lot of macros as well. You are seeing some upside for Japan as well. But, there's some nervousness around yen carry trade. We are talking about yen strengthening, yields are jumping. Do you think this is something which could impact markets globally and Asia as well?
In a word, not really. In a sense, what we're seeing is a normalization of yields in Japan from very low levels, consequent upon the BOJ intervening less in the government bond markets, which is a very healthy development, and the fact that reflation is ongoing. If you look at Japanese 10-year yields, they're about 1.8%. That's still less than a half 10-year yields in the US, for example. And if you look at the underlying situation vis-a-vis the yen, it's actually strengthened this week after we got the details of the fiscal package. And the fiscal package itself is entirely financeable. Japan is amongst the G7 almost unique in running essentially a balanced fiscal position relative to GDP. It's less than 1% of GDP fiscal deficit. So it's more than able to expand its fiscal impetus here. So the yen is undervalued. We think it will strengthen back towards the mid-140s over the next few months. And I think that process began in the last few days.
The PNGRB hikes gas transmission tariff to 65 rupees per MMBTU, lower than the 78 rupee figure sought by GAIL. The stock slumps 6%, even as the management tells CNBC-TV18 they will pass on tariff hikes to customers. The PNGRB also tells us that there is no recourse available for GAIL.
Mahindra & Mahindra is the top gainer. The stock rises after brokerages issue bullish calls after the company's new SUV launch. Morgan Stanley is overweight with a target price of 4,407, while Nomura sets a target at around 4,355 rupees a share.
Reliance Industry rally continues. The stock is up by about 1% as Jefferies issues a buy rating with a target of 1,785 rupees. All businesses of the company continue to deliver double-digit growth.
Shares of Paytm surged 3%. Goldman Sachs upgrades the stock to buy rating with a target price 1,570 rupees. They're expecting an improving regulatory environment to help the company sustain growth.
Shares of Ashoka Buildcon, they are under pressure, down about 3% after the company gets barred from bidding for NHAI projects for a period of 1 month.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, it's a good start for the bulls to the Friday morning. We have most of the indices that are trading in the green. Hey, Mangalam.
Hi, Nigel. Understandable moves that we're seeing, post the record high that we hit yesterday. Some consolidation on the Nifty bank in the Midcap index, as Nifty holds around that 26,250 mark. Good time to get in Manas Jaiswal for a quick technical check on the market. Manas, record high has been ticked off. Where do we go from here on? Do you expect some consolidation or do you expect a big move as we move towards the end of the calendar year?
Good morning, Mangalam. So, see, I am expecting a big move from current levels because, yes, we have seen some profit booking yesterday. But again, if you're talking about the trend is very strong. I believe that Nifty has potential to test 26,600 soon. So even from current levels, you can see almost 400 points rally in Nifty. So if you can keep the stop loss a little deeper near 26,100, then you can buy Nifty at current levels also. Keep your stop loss below 26,100 and target would be around 26,600. Even Bank Nifty is looking very strong. We have seen some consolidation, but again, here also till Bank Nifty is trading above 59,300. I think here also the trend is bullish. Even at current levels, one can take a long position. The stop loss should be around 59,300 and target would be around 60,500.
All right, 60,500 for the Nifty bank. And the Nifty target you said was what?
26,600.
Okay, all right. What about individual stocks?
So, Nigel, two stocks are looking very strong on the charts. First is M&M because we have seen some correction. But again, I think today the rally has already resumed. So, take a long position in M&M. Stop loss should be around 37.10 and target would be around 38.60. And second is a buy call on SRF where stock has regained its 200-day moving average. So here one can create long position. Stop loss should be around 28.80 and target would be around 3,025.
All right, take that point. Just before we let you go, Manas, do you have a view on GAIL? The stock has seen a big cut. This is on some news that has come in, fundamentally back. But is there something chartically that speaks about it being tradable right now?
I don't think so. I think one should just avoid it. But if you're talking about the trend, I think if it breaks 171, then you may see more downside. And in that case, stock can go down and test 160. So just avoid GAIL.
All right. Take that point. Thank you so much, Manas, for that. Let's get an idea for profit coming in from our colleagues at Money Control Pro. As always, Kanchi Shah today joins in with a stock.
So today's stock idea is Ashok Leyland, which is a pure play commercial vehicle company. So let me briefly touch upon its Q2 performance. In Q2, Ashok Leyland delivered a steady performance with revenue growing by 9.3% YOY, which was supported by a 7% of volume growth. So what really stood out was the exports. So they grew by 45% in the quarter. The company is targeting 18,000 exports unit by FY26 and is aiming for 25,000 units over the longer term. So this part of the business is clearly gaining traction. After a soft 2024 and a slow start to 2025, we are finally seeing early signs of recovery in the commercial vehicle cycle. And management is also sounding quite confident about the second half, mainly because they expect the replacement cycle to pick up because of the recent GST cut, or is also going to support the demand. Another interesting piece is the defense business, which continues to do well with a 25% growth in Q2 and a solid order book. Plus, the overall revenue mix is slowly shifting away from trucks towards higher margin segments like power solutions, defense, and spare parts. So this makes the business structurally stronger. Company is also expanding the network aggressively, adding new dealerships and service points across the regions. At about 19 times its FY27 earnings, the valuation still looks very reasonable to us. So overall, I would recommend a buy on Ashok Leyland.
Thanks a lot for that, Kanchi. Well, on to a quick programming note then as we slip into a break. If you're looking for the big bets and market themes for 2026, CNBC-TV18 Access gives you direct access to White Oak Capital's AMC, Ashish Somaya and Prashad Khemka, as they share their winning market themes and actionable investment strategies. Ask your questions live today at 1:30 p.m. Become a member today on CNBC TV18 app or log on to cnbctv18.com/access/plans.
Welcome back. You're watching us here on Chartbusters. Let's talk about the building product space, because lately we got a note coming in from Motilal Oswal which initiated coverage on this entire space with a positive bias on Century ply. They have a target of 958 rupees a share, and they believe that, you know, the jump in real estate registrations, commercial projects which are coming under implementation, and rise in private capex along with a shift into branded should help the cause of Century Plyboards and a lot of the other players in the company, in the sector as well. Keshav Bhajanka, the executive director at Century Plyboards, joins us now. Keshav, you know, all these factors that brokerages are talking about aren't new. We've been speaking about this for last many years, that there is accelerated shift towards organized players, the housing demand is coming back, and you guys have a premium offering out there along with the distribution brand, all of that. But the last 2 or 3 years have not been particularly good for your industry. Let's look ahead. What Motilal Oswal is expecting is a 15% revenue compounding with a 51% profit compounding over the next 3 years, which implies an EBITDA compounding of over 30% as well. Do you think these are realistic numbers, and do you think you guys can actually achieve that?
Good morning. Thank you so much for having me on the show. I think that while the industry has suffered to a certain extent, over the past couple of years, we have done reasonably well. If you look at our performance in the plywood and the MDF division, they have been fairly strong. I think growth has been in double digits. And in MDF in particular, it has been 20% plus. In plywood as well, we have been close to 15%. So with the new capex that we have done, whether it is in particle board, laminate, MDF, or the capex that we are about to take up in plywood, I think that this 15% plus CAGR does definitely look realistic. Our objective will always be to beat the same. And the majority of the large capex that we had done is behind us. As such, now debt is going to be coming down quarter after quarter. Operating leverage is going to give us better profitability. So I think that the guidance that we have given for the current year, we are well within range for the same. And going forward, I think 15% profitable growth, that does not seem to be a challenge.
They are talking about, Keshav, Motilal Oswal is talking about 15% revenue growth, and they're talking about 51% PAT CAGR over the next 3 years.
They just flip the digits, 15 and 51.
Yeah. What do you think? Doable?
No, I agree. And that is what I was saying. 15% plus profitable growth. Because now with growth, as you know, fixed overheads, they tend to remain fixed. They don't increase in the same percentage. As alongside that, the depreciation and interest, when you're on lower operational leverage, then they tend to hurt profitability substantially. So with our operating leverage increasing with higher capacity utilization, I think it is a realistic ask.
That's a realistic ask. Let's talk about the margin levers for you as well. You know, what are the growth drivers? You've spoken about capacity utilization as one, increased revenue flowing through the margins as well. If you could put numbers to that, when we're looking at, say, your business 2 or 3 years from now, you've given us an FY26 guidance. Last year, you were 10.7%. You had said it'll improve from here on. This year, first half, you're around 12%. Where do margins go from here on? Do we see them around mid-teens, low teens, or do they sustain at these levels itself with the revenue ballooning?
I think over the next couple of years, we will comfortably be back at 15% plus EBITDA margins for the company as a whole. And that is the target. For the current year, as you're well aware, we have given margins of 12 to 14% for plywood, 10% for laminates, 15% for MDF, and steady state margins of 15% for particle board. Once we ramp up capacity, I think we're well in line to achieve all of those.
So you will achieve all of that, and say by FY28, you will have 15% plus margins for the entire business.
Yes.
All right, Keshav, you know, in plywood, I was looking at it, your volume growth actually is far superior than any of your peers in the industry as well. What are you doing so right? What's going on there?
I think that, you know, it is about consistency. In terms of quality, we have been the highest quality manufacturer of plywood in the country for 4 decades now. And I think that the customer's confidence in us is showing through. Like you had mentioned at the start of the interview, that there is a trend towards more branding, towards people preferring branded products as opposed to unorganized products. So that definitely plays into our hands. Alongside that, we have done a lot of work on efficiency, operating efficiency on the ground to increase our margins. And branding has been a very sustained effort on our part. So I think that all of these things have culminated in strong growth backed by profitable growth.
Okay, all right. Keshav, also give us an updated market share. on the different verticals, plywood, laminates as well. If you could help us out.
So I think that, it's difficult to give you any sort of authenticated numbers because in our industry, in plywood, even in laminates to a large extent, there's a large component of the unorganized sector. But what I can say is that in plywood, we have definitely gained market share. In laminates, I believe that we might have lost a certain amount of market share because of some operational reasons, because of some deferments and some decisions that did not pan out well. We are now looking to regain that lost market share. In MDF, we have gained substantial amount of market share, and in particle board, with the commencement of our new capacity, you will see us rapidly gaining market share.
Right. So the last known number that we had from you was 6% in laminates, 7% in plywoods. This was the overall market, I believe. And in organized, you were targeting more than 25% share in the plywood business. Where are those numbers at right now?
I think in plywood, we'll comfortably be at close to 9% of market share.
Got it. And the others, laminates, you said you've lost. Last number was 6%, so are you around 5?
Be slightly, I think it'll be range bound, maybe 5.5 to 6.
Okay, all right. Keshav, what about the timber cost? How are the trends out there? Is there some softening? And softening of timber cost could be good for the business, but there could be a risk as well. The unorganized market as well could start coming back. How do you see things pan out?
I think one strategic advantage that we have is that we have 3 port-based factories and we have 3 factories that are dependent on domestic timber. As such, we have a wonderful mix. So even if domestic timber prices fall, the cost of imports, that gets negated only as far as the 3 port-based factories are concerned. So the decrease in domestic timber prices will be beneficial for us. And I think with the operating efficiency, that is not going to lead to any sort of a fall in prices or a fall in margins. Having said that, currently what we are witnessing is that while timber prices seem to have peaked out, it isn't that they have fallen drastically. They are hovering close to where they were, say, one and a half years ago.
And what about chemicals?
Chemical prices have seen a certain bit of a jump, but it is volatile. It depends on a number of factors. Right now, I believe with the entire stalemate with regards to the US and India and sanctions on Russia and so on and so forth, they might be volatile for a bit, but we haven't seen any major spike. There were slight spikes. I think these will also fall in line shortly.
Just a couple of questions before we let you go, Keshav. One is on the particle board utilization. You have expected about a 40% jump this year with steady state margins of 15%. First year would be low single digit margin. So just wanted to understand FY26, what's the utilization and revenue target along with margins on the particle board business? And the second part, you were looking to increase your capacity in South India MDF by about 25% by debottlenecking. You said you will mull over that in the second half of this year. Have you had any clarity?
Yes, on both. So as far as particle board is concerned, I think next year we'll be at 60% plus in terms of capacity utilization and double-digit margins or close to double-digit margins. As far as MDF is concerned, it was a good problem to have because we want to take the extension earlier. We are seeing great demand traction on the ground, which reflects in our numbers, of course. So in line with the same, considering that the demand for our products normally is slightly subdued during the monsoon season, we have planned to take our extension, our capacity expansion in the month of April next year. So yes, it is a firm decision. And going forward, current year, I don't think, would have been very pertinent because we are seeing a lot of demand traction. We couldn't lose out on the market, but April should give us an opportunity to do the expansion, which will have a downtime of about 30 to 40 days for the South plant.
Things looking up for you appears, Keshav, and we wish you well. Final question, what about the CFS business? You're looking to sell it, right? Is there an update? Should we expect something before the end of this fiscal year?
So currently, we are very happy that the new port terminal operation that we have undertaken, that is likely to start within the current quarter itself. And this is going to be a major boost to the CFS business. It will lead to a complete change in the logistic business in terms of margins and in terms of growth trajectory. And post that, yes, there is a plan to monetize that asset. We'll keep you posted as and when we take a decision.
All right, so you're waiting for some regulatory improvement to come by to make that business look a lot more plumper before you go ahead and unlock value out there. We take that point, Keshav, and we'll obviously keep having a conversation with you and keep pressing you on these numbers and the plan for the CFS business going forward as well. Thank you. As always, a pleasure speaking with you. With that, let's take a short break. And as we do that, here's some good news for all you viewers. India's business news leader is now just a click away, which is the CNBC-TV18 all-new app, which gives you instant access to breaking news, in-depth articles, and financial world updates. All of them at your fingertips. You can see them. You can download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or all you can do is just scan that QR code, which is there for you on the screen.
Investing.
Welcome back. You're tuned in to Chartbusters here on CNBC TV18. Well, let's hop across to Hormuz. He's joining in to tell us about a couple of big movers, Reflex Industries as well as Ashoka Buildcon. Hormuz?
Yes, Nigel, Reflex Industry is doing well for itself in today's session, and the stock is doing well on very high volumes as well, with more than 1 crore shares that have been traded already on Reflex Industries. The stock has won an order and it is reacting to that order win as well, among the top gainers on the small cap index in today's session. Ashoka Buildcon, of course, it is a negative development that has come in for the stock. It is temporarily suspended from participating in ongoing and future NHAI bids for a period of 1 month or until the inquiry against it is completed as well. They have received a show cause notice for construction of that 6-lane elevated corridor in Kerala, which the incident over there, which involved the fall of 2 precast PSC girders, one of which led to a death of an individual during this place. The company has clarified as well about this being an unfortunate incident and the circumstances in which the incident took place as well. They said they're assessing the financial implications of this, and they would make suitable announcements in due course of time. But the stock at one point was down around 6 to 7%, has recovered from those lows, still down around 3% in today's trade.
All right, take that point, Hormaz. Thank you so much for that, explaining both these stocks to us, seeing divergent moves. But as we speak, when we started the show, the Nifty Bank was marginally in the red. Now it's marginally in the green. Let's hope the Midcap Index, there you have it, even the Midcap Index, as we wrap up, will show that it's moved into the green as that screen updates for you. We'll take your leave on this edition of Chartbusters, but stay tuned. Trading Hour comes up next.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Reema Tendulkar and Hormuz Patakia. Hey guys, good morning. Finally Friday. That's the most important cue for today. Apart from the fact that after touching those record high levels yesterday, we came off sharply. Today, there is an attempt for recovery, but we've again, after recovering from the lows of the day, the low today was 26,172. We are, of course, 82 points off the lows of the day. But again, there is some attempt of a sell-off from the highs of the day. So we have come off around 30 points from there. The mid-caps, they are underperforming yet again. So there is, it is in the red. It's been quite volatile since the start of the trading day. The advance decline ratio, though, in favor of advances right now, but we'll keep tracking the market bread because that is an important cue to track for the broader markets. Look at those lines. It's been a zigzag through the course of the trading day today. Autos doing well. Metals, again, batting it for the bulls. But we have some losses coming in from realty, small caps, and the CPSE index. Hey, Reema.
Hi, autos is going to be important because over the weekend we'll get the auto sales numbers for the month of November, and after the festive season boost that we got in the prior month, everyone's going to watch whether that demand sustains and will continue. So autos in focus, and particularly M&M continues to gain ground. Remember yesterday Sudarshan was talking about their new launch. Feature loaded is what he said, at an aggressive price, I think close to about 20 lakh. And the launcher, the official sales will begin only in January, but the street quite likes what they've seen, and that stock continues to gain ground. And the other one is Reliance Industries. This week, we've seen the second bullish note on Reliance Industries. On Tuesday, it was JP Morgan, and today it is Jefferies with a target price of 1785 on Reliance, and that's helping the bulls today. But, Hormuz, what else?
You know, there are broader markets they have remained choppy all through the week, to be very honest. But then there have been stock-specific actions on both sides of the spectrum. Start with all cargo logistics today. The stock has snapped a 5-day losing streak, the biggest single-day gain that the stock has seen since November of 2021 in today's session. And it has reversed that entire 21% decline that it saw in the last 5 trading sessions. The stock today has seen close to 45 lakh shares that have been traded, 20-day average of just around 20 lakh shares, and it's trading above its key moving averages, somewhere between the 12 rupees to the 13 rupees mark. Now, Reflex Industries is an order win reaction, the 12% higher on the stock, the biggest single day gain in 3 months. Volumes are the highest in nearly 4 months. Over 1 crore shares have been traded already on Reflex Industries. The 20-day average is only 1 lakh, and the stock has moved above its 50-day moving average of 356. It was below all of its key moving averages before this. The stock is down around 25% this year, but had more than quadrupled in 2024. And lastly, GAIL, of course, a news flow driven reaction in today's session, has declined in 5 out of the last 6 sessions already. The volumes are already the highest in 5 months. We have had close to 3 crore shares on GAIL that have been traded in the first couple of hours of today's trade. The 20-day average is only 18 lakh shares, and the stock has slipped below its key moving averages, and so far down around 10% year to date, and set to be the first negative year since 2019.
Okay, all right. So that is about GAIL, and let's continue that story and talk about GAIL in greater detail. Of course, this is the big story that we are tracking for the day. The news is that there is an announcement on tariffs for GAIL's transmission pipeline. It has come in lower than what the street was anticipating. So the new tariff has come in at 65.69 rupees per MMBTU, which is a 12% increase from the current levels. However, it is lower. The ask from GAIL was a 33% hike to 78 rupees, and the analyst community believe that maybe not around 33% hike, but there could be at least a 20% hike which will be on the cards, and that is what everyone baked in their estimates as well. So 12% is much lower than both these parameters, which was expected by the street. However, this is just an interim relief, as the order says, and as GAIL and PNGRB also told us. Regulator has not considered adjustments for future and actual operating expenditure and capital expenditure in this particular calculation that came by. They only made these calculation basis 2 things: the capacity and also the deallocation of APM gas that took place. Such adjustments, all of the other factors, will be taken up in 2028. That is when the next leg leg of revision for tariffs will come by for GAIL, and the estimate is by PNGRB as well that is when they will get full benefit of a tariff hike. PNGRB also indicated they wanted to make this process very smooth and now not go at one go for tariff hike because that will impact customers as well. What are brokerages making of this? UBS has a buy with a target price of 215 rupees a share. They say that tariff hike disappointed and increase in realized tariffs could even be lower. 12% does not increase announced tariffs does not mean the realized tariffs will be equivalent because other costs will be taken into consideration as well. However, regulator has deferred review of other parameters from FY28, and this is something that would lead to material increase in tariff and can place unexpected financial pressure on customers. So this is something that we'll be tracking very closely. Citi has a buy. They also have a similar target price. They say this is below 15% that had built into forecast and well below 33% hike that GAIL was seeking. This should now set in motion implementation of new unified tariff regime, which is material positive for IGL. Jeffrey says because of this tariff hike, they say it is largely in line. They had expected around 15%. They say they build a new tariff and raise both FY27 and FY28 estimates by 7% each. Tariff hike is in line with expectation. They have a buy rating with a target price of 230 rupees a share. So this is what the brokerage view is in terms of GAIL. In fact, we spoke to PNGRB earlier today. They told us that this is just an interim relief and that tariffs will be revised in 2028 again. Listen into what they had to say and their reasoning as well on this number.
We have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll do up everything. It is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein we'll all true up all the factors, capex, opex, relief, everything we will give. Two reasons for tariff revision. One is the capacity determination, which has been done by Engineers India Limited, and second is the deallocation of gas, of APM gas by the ministry. So these are the two basic reasons, and wherein we have determined the tariff of 65.69, considering all the three factors. Actual SUG we have given, future SUG we have partially given, and the capacity determination hike we have totally given. So this interim relief is in the interest of GAIL.
To understand the impact further, we also spoke to Rakesh Kumar Jain, the Director of Finance at GAIL, and the company, and we asked him that this has been lower than what the company was seeking. So how do they feel about it? What will be the impact? Listen to what they had to say.
We submitted our tariff of 78 rupees way back in August 24. And if you see in terms of net present value, it should have been around 81, 82 rupees. Yesterday night, PNGRB has issued tariff order, which says tariff approved as 65.69 rupees. However, it's on interim relief basis. Actually, it's not a regular tariff order they are saying. They are saying interim relief, and regular tariff order will be issued in April 28. Actually, tariff orders are normally issued in a block of 5 years, but regulation also says if there are significant change in the principles of parameter based on which the tariff was revised, we can, or PNGRB can ask us to submit, or we can approach PNGRB. So this time, in this case, PNGRB asked us to file the midterm review, and we filed it. It will increase by 1,200 crore rupees per annum based on existing volume. And next year, we are also expecting at least 8 to 10% volume hike. So therefore, it will be around 1,300 to 1,350 crore rupees per annum. Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and true up in next revision. So we were expecting the tariff based on those revisions should be 70, 72 rupees, but it has come down to 65 rupees, 69 rupees. There is a gap from our expectations of around 5, 6 rupees. And since we are yet to go through the tariff order, we'll see what are those parameters based on which tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
Take a short break, but just as we do that, here's a quick programming note. If you're looking for the big bets and market themes for 2026, CNBC TV18 Access gives you direct access to White Oak Capital AMC's Ashish Somaya and Prashant Khemka as they share their winning market themes and actionable investment strategies. You can ask your questions live today at 1:30 p.m. by becoming a member on the CNBC TV18 app or logging on to cnbctv18.com/access/plans. Welcome back. Shifting focus to the crypto markets now. Manisha is here with all the updates. Manisha.
Well, thank you for that. Today, I'm taking you with the journey and sense of Bitcoin. Remember, it was launched way back in 2009, and that is when we had started talking about it as well. The Genesis block was actually mined on 3rd of January 2009, and that is what marked the birth of the world's first cryptocurrency therein. Well, it was not established yet then, and the prices started being marked only in 2010. But initially, when the cryptocurrency came along, it was informally traded between early adopters there. There was no established market prices, and there was no established market platform to begin with as well. Well, you also know that the protocol limits the supply of Bitcoin to just about 21 million coins, and is the reason that there is support that continues into that space as well. When you look at Bitcoin, really, we've seen a low of 83,000. From there, we've seen a rebound up to 91,000 as well within that last 1 week. So strong gains coming back into that cryptocurrency there. There have been major reasons for the movement that we've seen in Bitcoin in many last years. First of all is the investor interest, the adoptional interest. We also have seen retail, institutions, banks, corporates, even governments start to adopt it, and that is where the support comes in from. The cryptocurrencies also have macroeconomic conditions that they have started to react to, whether it is about the dollar, the US Fed interest rates, the equity markets, etc. All of that impact the Bitcoin. The mining difficulty adjustments that we have seen continue to grow in last many years have been yet another reason that you are looking at support come in for Bitcoin there. And then it also has been about competition from other altcoins. Bitcoin halving events also have led to a lot of gains there. And the friendly regulations within the US markets that we saw in this year clearly have led to Bitcoin hitting yet another all-time highs there. I want to take you through prices on how the journey really began. So that was 2009 when the Bitcoin was at 0.004. And as I said, in 2009, nobody was trading cryptos except only the enthusiasts. And it was informal trading within the system itself. 2010 is when the first Bitcoin was traded, and this also is the year that you saw those 2 pizzas being bought by 10,000 Bitcoins. At that point in time in 2010, the low was 0.004 and at 0.5. So it didn't cross $0.50 in that year. And very interestingly, when you look at 2010 to 2013, so if you count 2010 as the year 1, so 1, 2, 3, and the 4th year is when you have seen the Bitcoin hit an all-time highs. And as you can see, the 4-year range has been very, very big. But this is something that Bitcoin clearly has been replicating every 4 years is when you see very strong gains come in for Bitcoin. And as you will see in this year as well, this is 2014, 15, 16, and then 17. Look at that. So every 4 years, the 4th year is the year that Bitcoin gives you very, very strong returns there. But take a look at the kind of volatility that we have been looking at in all of those markets there. Yet again, that 4-year thing is replicating here. So 1, 2, 3, and then 4th. So Bitcoin has traded anywhere between 13,000 to 28,000 in the last 4 years. But by the time it was 2021, we saw 68,000 therein. And this is yet again replicating. So 1, 2, 3, and 4. And you have 1,26,000 there. So when you look at the last 4 years, it basically traded anywhere between $40,000 to $50,000 therein. But 126,000 is what we've seen. 106,000 also Bitcoin hit in December 2024. That is when we almost absolutely knew that the US President Trump was coming in. And that is where the euphoria came in from.
It follows its own leap year, right? By the way, Manisha, what were you doing in 2009? That seems like long ago. What was everyone doing here back in 2009?
I was in school.
Oh, okay, we shall then not continue this conversation from here. But thank you, Manisha, for taking us through that Bitcoin journey. It's very interesting to know what levels it used to trade at and where it is right now. So that's the Crypto Corner update. With that, we'll slip into a short break. When we return, we'll discuss market technicals with Mehul Kothari from Anand Rathi Shares.
Welcome back. Sudeep, Pharma has had quite the stellar debut on day one. The stock is up 32%, 787. Very strong up move. This is a pharma company which basically manufactures specialty ingredients which go into pharmaceuticals, nutraceuticals, and personal cares. So their core business revolves around high purity minerals and excipients, that's the word they've used, that go into tablets, syrups, supplements, and fortified foods. So that's pretty strong. We'll try and get you more on that. For now, let's talk about market technicals. Mehul Kothari from Anand Rathi Share and Stockbrokers is now joining in. Mehul, 26,250 after yesterday's high. Markets are just consolidating. What's the near term looking like, the trade that you would take, and then tell us your stock calls.
First of all, thanks, Rima, for having me on the show. And if we talk about Nifty, we have a short-term as well as medium-term view. So for short-term, our view remains positive. As long as Nifty hold on to 25,800, which is the recent swing low, right? The market continues to stay in buy on dips environment. On the upside, we anticipate a move towards 26,500 once we are about 26,300 on spot or a bit slightly higher. However, once this zone is reached, we feel that a decent corrective phase or a healthy pullback is likely in the markets. But most heavyweights, if we talk about, appear to be in the final leg of their up move. But despite that, we remain strongly bullish on the broader markets as of now. It's time for mid caps and small caps, Rima, to begin showing noticeable outperformance, and one should position accordingly from here on. Now, with regards to Bank Nifty, also 60,000 to 61,000 zone may prove very challenging for the bulls due to a major trend and resistance placed there. So, along with Nifty, even Bank Nifty hints for a final leg of upside in the short term.
What about specific stocks, Mehul?
A couple of stocks which we are liking from the heavyweights, we are liking M&M. It is on the verge of breakout and can be considered at current levels of around 37.50 with a stop loss of 3650. The upside potential is towards 3900 to 3950. From the mid-cap space, we are liking data patterns. The stock recently witnessed a strong breakout rally followed by a healthy pullback, so which presents a fresh buying opportunity in the stock. It can be bought somewhere around 3010 to 3020 with a stop loss of 2920 and upside target of 3150 followed by 3200.
Okay, all right. Thank you, Mehul, for joining in today. So those are some technical bets and important levels to watch out for on the Nifty as well. Paytm, that is one stock on our radar amongst one of the top F&O gainers. Nimesh is here with his standout brokerage report of the day. Nimesh, what does the note say?
Hi, Sonal. So the stock is reacting to the big upgrade coming in from Goldman Sachs. So they've upgraded the stock to a buy, and they've sharply raised the target price on Paytm to 1570 versus the earlier target price of 705. So big price upgrade there. Now they believe that the regulatory environment, which was a big drag for the stock in the recent past, that is incrementally getting better, and hence that is going to translate into an early signs of recovery in the Paytm's payments business, market share, as well as the earnings stability as well. So they are expecting that the company to sustain 20% plus revenue growth in the very near foreseeable future. Additionally, they expect further incremental positives for Paytm if there are any further regulatory changes with regards to the MDR or for that matter further market share gain. So that is why Goldman Sachs expects that the company's EBITDA margin is likely to double over the next 2 to 3 years, and hence the risk reward is favorable. So that's the reason why a big upgrade to a buy, and Goldman Sachs has now raised the target price to 1570.
Okay, take that point, Nimesh. Thank you so much for joining in. So Paytm is on our radar. We'll keep tracking that stock for you. Reliance Industries is the other one. That stock is higher in trade today, contributing to some of the gains that we're seeing on the Nifty, though it has come off from the highs of the day. There is another bullish note on Reliance. This time is coming in from Jefferies. They have a buy call with a target price of 1785 rupees a share. They say all three businesses, the oil to chemicals business, retail and Jio, are delivering double-digit growth in FY26 so far. Jio's impending IPO could lead to tariff intervention in the near term, so that will be a key trigger for the company. FMCG is ripe for value discovery in calendar year 2026 itself, and New Energy and data center partnership with Google are the other optionalities. And New Energy is a business on which a lot of analysts are quite bullish once it starts contributing to the P&L as well. But stock is still trading below its mean long-term EV to EBITDA, and that is the reason they are bullish, because of valuation optimism and risk risk reward is favorable at current levels. So Jefferies reiterates it buy on the stock with an indication that all three businesses will do well going forward.
Second bullish note this week for Reliance Industries, and the street continues to bet on the stock as it moves closer towards its previous record high levels, somewhere close to 1605 or 1610, so 1572 currently on Reliance Industries. By the way, just before we take that break, pull up Lenskart as well. Now that's at the highest point of the day, and Jefferies initiated coverage on the stock earlier today, a price target of 500 rupees, and that initiation comes just a day before it declares its quarterly results, which is tomorrow. It's first after its listing. Take a short break. We talk more on the markets with George Thomas on the other side from Quantum AMC. Stay tuned. We'll be right back. Welcome back. It's still 26,250 being a bit of a hurdle for the index, and Sudeep Pharma now is still up 32%, but shares worth almost 2,000 crores have already been traded on the stock on its listing day. Continuing our conversation on the markets, George Thomas from Quantum AMC is now joining in. George, good morning. Thank you for joining in. The markets may have hit record high levels yesterday, the benchmark indices at least, but the broader markets is where the actual pain lies, right? You see the mid caps, the small caps, the micro caps, at least 2/3 of the stocks have given negative returns this year. Do you believe that the excesses in the broader markets have now been wiped out and now it's the time for the broader markets to outperform, or do you still see some more pain for the next couple of quarters?
Thanks for having me on the show. So we are slightly longer term investors, and generally we base our calls based on what could pan out in the next 2 years. But having said that, so what has happened in the markets in the last 3-4 years was certain pockets, especially in some of the small mid cap and micro cap names, had rallied to an excessive level, and some of those excesses have corrected in the last few quarters. But our sense is, given the point where we are currently, the earnings growth has not been great for the last many quarters. And there has been a series of actions from the policymakers to boost consumption, and some of it is starting to play out on the ground. So if you look at this year, there has been the direct tax cut, indirect tax cuts, and even interest rate cuts, which has happened simultaneously. And along with that, you are sitting at an earnings base, which is not at all ask. So our sense is from here on, the earnings growth should turn for the better. And from a 2-year perspective, we are seeing a fairly good upside for a long-term investor. So we are quite positive on the markets. Our sense is on the large cap space, there are pockets where there is a chance for good upside. But as you come down the market cap in the small cap segment, investors has to be a little more selective, and funds which are cognizant of valuations are likely to outperform over the next couple of years.
In that case, since you're positive on the markets from a 2-year perspective, which are some of the sectors which could contribute to those growths, or you think it has to be very, very stock specific for any fund manager to choose?
See, the last couple of years, if you see some of the sectors which has given muted returns are the major pockets of financials, IT, and some of the sectors like consumer staples. But from our portfolio perspective, consumer staples, we are not still reached a level where investors can expect decent returns if you marry valuations versus the earnings growth potential. But our sense is some of the segments like financials and IT should turn around from here on. Financials is a mix of banks and some of the savings related themes like insurance. Banks are seeing some signs of credit growth to kind of moderately picking up from the levels where they are. And as the economy picks up, it should become better from here on. Insurance companies have seen certain transient issues, and in the very recent past, markets were worried about the tax tweaks which happened there. But when we speak to companies, we are seeing most of it has been kind of passed on to the value chain in terms of distributors and stuff. And our sense is from here on, given the attractive pricing because of the tax changes, most likely the ticket sizes can improve, and investors should see better growth from here on. The other big pocket where we have a reasonably good upside is IT, where things have been muted for quite a long time. And our sense is from an impact perspective, it is more macro than AI. And as and when the global things settle down, enterprises should start spending, and some of these companies should clock decent revenue growth.
But George, there has been a lot of uncertainty with regards to the IT space. I was just reading your note that you have shared. The IT services players reducing their dependence on the H-1B. There have been comments from the US president as early as today with regards to immigration. But the commentary from a lot of the players on ground still suggests that nothing much has fundamentally shifted. There has been this talk over India being an anti-AI play and so on and so forth. But will only a valuation correction be enough for an investor to bet on IT, or the cons far outweigh the pros right now?
See, when you evaluate the IT service spends, how it typically happens is there is a permanent spend which is required for maintenance and which is minimum in nature. And then there are certain good to have projects which is typically called as discretionary projects. So in a bad macro environment, when enterprises are not sure about what could pan out in the next few months, they would keep these discretionary projects on a back burner. But what we have seen in the past many cycles is as and when, and there would be a point where even delaying those discretionary spends would have an impact on the enterprise. So they cannot be deferred forever. That is one angle. The second dimension is whenever there is a tech transition. For instance, there are a lot of use cases or POCs, proof of concepts, which are evolving for these new Gen AI related things. And IT service companies, by nature, they participate at a later stage. They are involved in terms of, so even if there would be a good amount of companies who have created good use cases for generative AI, but from an enterprise perspective, you cannot plug those Gen AI add-ons as is to their existing architecture. So there is substantial amount of work which is required in terms of modifying their existing software architectures, where IT service players come to help. And along with that, there would be a humongous amount of data preparation work. Your existing data could be existing in silos, your applications would be in silos. So this system integration and integrating with new technologies, that is an essential spend. And if you look at the global landscape where the labor force is distributed, India continues to have an edge. And the cost arbitrage between an engineer at the developed country and in India, that continues to be quite favorable. So we don't see any fundamental reason why tech spends on the Indian IT players should underperform in terms of revenue growth for a prolonged period of time.
Okay, all right, Josh, thank you so much for joining us with your market insights and sectoral outlook going forward. With that, let's move on. In an exclusive chat with us, Jonathan Garner of Morgan Stanley said that he remains overweight on India and does not believe that foreign investors are leaving the Indian market yet. Let's listen in as we slip into this very short break.
Market starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year. Going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small, and most of our other market calls are relatively contained. Overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example. To be precise, we are 75 basis points overweight. At our maximum bullish, as I say, back during those 4 straight years of outperformance, we were at times 200 basis points overweight. So we moderated our bullishness on India this year. But then we have relatively tight risk positions in all markets currently. Ridham Desai and the team just set a Sensex target of 95,000. but again, with a wide bull-bear range around that. And that would certainly be consistent with India outperforming because it gives more upside than we have for overall MSCI emerging markets, where we have something like a 1400 target.
And what's the bull bear on the Sensex?
76,000 up to 107,000. So quite a wide range.
Welcome back. You're still tuned in to Trading Hour on CNBC-TV18, 26,250 on the Nifty, an important level to watch out for. But a lot of individual stocks on our radar. Lenskart is one of those stocks. Jefferies has initiated a coverage on the stock with a buy rating. There's a target price of 500 as well. Mangalam is joining us with all the details of this note. Mangalam?
Interesting one because, you know, Lenskart reports its numbers this weekend itself. So one weekend before its numbers, there has been an initiating coverage that comes by with a positive, stance here as well. Jefferies has initiated coverage. Their target price is 500 rupees. For perspective, the issue price was that Jefferies was just around that 412 rupees mark itself. they have a couple of drivers for them. They're saying that it's the largest tech-driven eyewear retailer, which holds about 5% market share in the country, and this offers a strong growth potential. It's vertically integrated. The omni-channel model also ensures that there is operational improvement coming in, even as the customer experience improves from here. And India accounts for nearly 85% of their EBITDA, while the international segment is something that gives optionality. So attractive unit economics and fast paybacks, they believe, could actually take EBITDA higher by 50% over the next 3 years on a CAGR basis. Just one word on their valuations though. Jefferies ascribed a valuations of 50 times FY28 EV to EBITDA to Lenskart, assuming that the EBITDA in FY28 would be closer to 1600 crores, which is roughly 3.5 times of what it was in FY25. So it's their projections and the multiple on those projections. So we'll monitor how these actually come about as compared to the actuals for the company going forward.
Thank you very much for that. But the stock has held up well, right? Around the time of the IPO, everyone was so worried about the valuations, very expensive. It did drop to 350. That was the low, I think, in the month of November. But it's climbed back up to 425. So vis-a-vis issue price, I'm saying it's held up pretty okay. If you compare it to, say, an urban company, which, compared to the highs of 200, has seen quite a fall. Mangla?
No, the other thing that we need to monitor is that the first block of anchor investors opens sometime in the early part of next month itself. So until that happens, limited float which is available in the market for the stock to be traded. So unless and until there is more supply that comes in or more stock opens up for trade, we'll find an equilibrium there. And maybe the street's holding on right now, also waiting for their results to come by. Who's to know that, the first couple of quarters after the company lists, usually the results are fairly strong. So maybe the street is playing for that as well.
8th of December is that day when the lock-in opens for almost 4.1 crore shares. 2% of outstanding will become eligible to be traded that day. Mangalam, thank you for that update there on Lenskart, holding above its IPO price. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back. One important macro indicator that the street will be tracking will be the second quarter GDP numbers. And the good news is that that number could be as eye-popping as the Q1 number. So the CNBC-TV18 poll sees the Q2 GDP growth at 7.4%. This compares, remember, with 7.8% in Q1. Lata joins in with more on this. Lata, looks like it's going to be a good show today.
One reason why it's good is look at the year-ago number, 5.6%. That was a terrible second quarter we had. So it's perhaps easy to look good because of that. And it's a tad lower than the 7.8%, which was a genuinely eye-popping number which we got for Q1. However, this is real GDP is what we are talking about. That is, we are taking away the price effect. We're only looking at the rise in goods and services. If you add the price effect, what you call nominal GDP, that's growing at only 8% versus 8.3 year ago and versus 8.8 in Q1 and versus a union budget assumption of 10.8%. So clearly there are going to be problems because of that. The growth at the moment, let us look at the good news. The real GDP growing by 7.4 is going to be helped by all sectors. That is agri, manufacturing and services. Agriculture is seen growing at 3.5, which is very good for agriculture. You know, there are limits. You can't expect it to grow at 8%. Manufacturing, very good, expected to grow at 8.9%, partly because of the front loading of exports and a very good capex spend by the government. Both those helped manufacturing, and services also doing very well at 8.1. Largely finance, real estate, trade, all of them did well. The poll for Q3 and Q4 are also in, but they're preliminary numbers. Q3 is expected to grow, that is the current quarter, at 6.7% and Q4 at 6.3%. For one thing, they also have a high base, especially Q4. But most of the economists said these are subject to change after we look at the Q2 numbers. Overall, if you average it out, the full year number comes now at 7.02, which is very good because if you remember the CEA, when he presented the economic survey before the budget, he said he expected 6.3 to 6.8. The most optimistic number was 6.8, but now economists are saying it can be above 7%. Again, nominal GDP is the worry. It is going to grow by 8% according to our poll. You know, nominal GDP is important because that is what gets counted in the budget. That is what gets counted in earnings forecasts of companies. You don't take out the price effect. You just take the profit. Now that if it is overall is growing only at 8%, you have a problem. There could be an earnings growth problem if nominal GDP is that low.
And with that, we call time on this edition of Trading Hour, the last one for the week. For Sonal, Reema and me, thank you for watching. And Halftime Report takes the action forward on the other side.
Stocks trade ranged with advances and declines almost evenly balanced ahead of the weekend. Metals gain while energy drags.
The Petroleum and Natural Gas Regulatory Board, PNGRB, approves an upward revision in its tariff by 12% against the 20% expected. The next tariff review is expected only in FY28. The stock slips on the disappointment.
Online retailer Meesho announces its 5,400 crore rupee IPO, eyeing a valuation of near 50,000 crore rupees. The e-com leader expects higher ad revenues to drive up cash flows as it expands, even as it rules out charging users a commission.
Silver scales to its close to its all-time high of around $54.5 per ounce as high industrial demand and strong investment interest point to a significant deficit. Hope of a rate cut by the Fed Reserve further aids sentiment.
Hello and welcome. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me as always, Ekta Batra and Vinny Motiwala. The market's holding up fairly well. 26,250 after hitting a record high yesterday. No problems. One would say that, one would have wanted a bazooka move, but that wasn't the case. We're not in that market right now. All four indices above our head. The fact that they're in the green is great enough, I guess.
Hi guys, yes, absolutely. You know, we have the Midcap index, which is just about consolidating at this point in time. The Bank Nifty, which is up around 0.2%. But let's see what takes place with the GDP data, which is due at 4 p.m. this evening. So the street is expecting that maybe it's not going to be as great as the 7.8% that we saw in the previous quarter, but we are expecting a figure above 7%. And not to mention maybe around 7.4%. So still strong, but not as strong as the previous quarter is what the expectation is. So let's see how that plays out on Monday's trading session. But as of now, just about consolidating at around 26,246 for the Nifty.
Hi guys, good afternoon. Yes, that's the date today. But when you look at it for the week, right, the Nifty, when you're looking at it and watching out for, has managed to see some bit of a gains of around 0.6 to 0.7%, while the broader end of the market, the Nifty Midcap, that's managed to see a bit of an outperformance in this week. That's what I'm looking at, and changes this week. So that is interesting to watch out for. While in terms of overall performance today also, what we're seeing is that IT very, very flat in trade. Nothing sort of an excitement coming in there. So that is something that we will be keeping an eye out on. A lot of movers today are coming from Wellspun India, SRF, Varun Beverages. Some of these broader end of the market names are managing to hold on to gains. And in that, one important stock that we're putting the spotlight on, or is important to watch out for, is GAIL. That has slipped as much as 6% in today's trading session. Why? This is coming after PNGRB has revised the tariffs. Now, Sonal is joining us to give us an update on this one. Afternoon, Sonal.
Good afternoon. Yes, GAIL is in focus because there is a disappointment that has come by. Now, do remember there was an expectation of a tariff hike. It has come in. It is a 12% hike that we're looking at for GAIL for its transmission pipeline, but it is lower than what the street was anticipating. The expectation was of a 15 to 20% hike, and GAIL had asked for a 33% hike, right? So it's way lower than that. However, the PNGRB, the regulator, says that it's only an interim relief that has come by. There will be another round of tariff hike in 2028, which will be applicable from 1st of April, and that is when they will be considering other factors as well, because right now they have not taken into consideration actual and future operating expenditure and capital expenditure for setting up these pipelines as well. For now, it just has been the capacity utilization and deallocation of APM gas, so some costs around that. So it has come in as a disappointment, despite the fact that there's an expectation of another price hike that could come by in April. ICICI Securities says that yes, it is a disappointment, but still there's an upside risk if the tariff in April 2028 is higher than what the street is working with. What are the brokerages making of this move? UBS, which has a buy rating and a target price of 215 on the share, they say it is a disappointment. An increase in realized tariffs could even be lower after considering some of the costs. 12% hike is announced in tariffs, but actually the hit on the PNL or the improvement on the PNL could be much lower. But the regulator has deferred review of other parameters to FY28, and this is something which could lead to material increase in tariff, and that would be something that will impact the customers. And this is something PNGRB also indicated, that they wanted to smoothen out the process and not burden the customers at one go with tariff hikes. Citi has a buy rating. They say this is below the 15% mark that they had built in their parameters and forecasts. It is below 33% as well, but this should also set to motion implementation of the new unified tariff regime, which will be positive for something like an IGL. Jefferies has gone ahead and increased their EBITDA estimates by 7% for the next 2 fiscals because they believe it is in line with what they were working with, and they are quite positive on the stock with a target price of 230 rupees a share.
Okay, all right. Thanks very much for that, Sonal. So GAIL in focus. But in fact, we did speak to PNGRB earlier today, and they told us that this is just an interim relief and that tariffs will be revised in 2028 again. Listen in.
We have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll do up everything. It is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein we'll all do up all the factors, capex, opex, pay, relief, everything we will give. 2 reasons for tariff revision. One is the capacity determination, which has been done by Engineers India Limited, and second is the deallocation of gas, of APM gas by the ministry. So these are the 2 basic reasons, and wherein we have determined the tariff of 65.69, considering all the 3 factors. Actual SUG we have given, future SUG we have partially given, and the capacity determination hike we have totally given. So this interim relief is in the interest of GAIL.
Okay, all right. Well, that's GAIL. The stock is down around 5% but that was the PNGRB talking to CNBC-TV18 earlier today. To understand the impact further, we did speak to Rakesh Kumar Jain, who is the Director of Finance at GAIL, and the company tells us that this has been lower from what was in fact sought.
We submitted our tariff of 78 rupees way back in August 24. And if you see in terms of net present value, it should have been around 81, 82 rupees. Yesterday night, PNGRB has issued tariff order, which says tariff approved as 65.69 rupees. However, it's on interim relief basis. Actually, it's not a regular tariff order they are saying. They are saying interim relief, and regular tariff order will be issued in April 28. Actually, tariff orders are normally issued in a block of 5 years, but regulation also says if there are significant change in the principles or parameter based on which the tariff was revised, we can, or PNGRB can ask us to submit, or we can approach PNGRB. So this time, in this case, PNGRB asked us to file the midterm review, and we filed it. It will increase by 1,200 crore rupees per annum based on existing volume. And next year, we are also expecting at least 8 to 10% volume hike. So therefore, it will be around 1,300 to 1,350 crore rupees per annum. Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and true up in next revision. So we were expecting the tariff based on those revisions should be 70, 72 rupees, but it has come down to 65 rupees, 69. But there is a gap from our expectations of around 5, 6 rupees. And since we are yet to go through the tariff order, we'll see what are those parameters based on which tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
Okay, on that note, we're going to actually sip into a very short break. Up next, we'll get you excerpts from our exclusive conversation with Meesho on their upcoming IPO.
But let's move on to the primary market action right now. What we're looking at is the start of or the launch of the IPO of Meesho. 50,000 crore valuation is what the company is seeking. The price band that it is set for its 5,400 crore rupee IPO is 105 to 111 rupees. Rima and I caught up with the management and began by asking them about the IPO, the revenue mix, the value left on the table, and at what point do they turn EBITDA profitable. Here out.
So we actually make money from the services we offer to our merchants. Like number one is logistics. Over time, we've basically built the most efficient, lowest cost logistics in e-commerce in India. And because of that, we're able to make a margin there. And we also make money on advertising. So our sellers now have like ad products to basically promote their listings across the platform. And when they use those ad products, we get paid. So these are the primary ways of how we make money.
And what's the split between fulfillment versus advertising to your top line?
So we don't share that split. We haven't disclosed that in the RHP.
Guys, welcome to the stock markets. Now, everyone will be asking you the more important number, which is beneath the top line. It's the operational profit and the net profits. Yes, you guys are contribution positive. Your, business is growing fairly well at a 28% clip. When do you turn profitable on an operational basis and the net profit basis?
I think in terms of profitability, the most important metric that we optimize for is free cash flow. Like if you look at any company, it's actually valued at the net present values of the free cash flow it generates over the long term. So instead of any other operating profit metric, the most important thing for us is free cash flow. If you look at the last 2 years, we've been free cash flow positive. And I think that will continue to be a focus area even going forward. We always take a very long-term view of our business. We believe we can keep growing our business at the right pace while being free cash flow positive. We'll kind of generate the right value for our shareholders in the long run. So that's our big focus area.
Your adjusted EBITDA in H1 is 551 crore as a loss, which is more than double of the whole of last year. Can you explain what led to the widening of the losses?
I think a big focus area for us this year was we saw our value proposition becoming much, much better. And because of that, we saw our payback periods were quite attractive for a lot more customers. So you would see for the first 6 months of this year, we grew at a very fast pace.
Much more than what you've done earlier in the last 3 years as well. What caused that?
I think over the last 2 years, our value proposition became much better. With Valmo scaling up, our costs went down.
And you had the IPO on your mind as well?
Actually, it's not that we do anything for an IPO. If you see, just for the last 2 years, our FY25 growth was faster than our FY24 growth, and then 6 months are faster than the last year. So it's a consistent story for now about 24 months. And if we feel like the payback periods continue to be attractive, we will push the pedal and want to grow to a long-term, steady-state annual transacting user base sooner than later.
So I think how has your customer acquisition cost moved over the last few years, and how has your customer payback period come down over the last few years?
So if you look at 3 years ago versus where we are today, the cost of acquiring a customer for us has come down quite significantly. Most businesses, if you look at it, cost of acquiring customers only increases as time passes because it becomes harder to go deeper and deeper into the customer base. And that's why we are able to press the pedal on growth and grow our customer base even faster.
Sanjeev, will you all continue to push the pedal on growth? Because H1 growth is higher than the growth of last year. And, I was just reading from the RHP, the spend to convert a new consumer declined between FY23 to FY25 by about 27%. But in the first half of the year, it increased by 52%, which means you're making a very conscious effort to get more customers. Your cost of acquisition seems to have gone up. And even from the fresh issue, more than 1,000 crore is on marketing and advertising. So clearly, as you said, there is an intentional push to drive growth, which we saw in first half. How long will that continue?
I think as we continue to make our value prop stronger and as we continue to innovate across different cost headers in the business, right? We continue to make the business model more efficient across logistics cost, other types of cost. We continue to invest in AI as well extensively as we continue to go deeper in India, right? Like it's also important to make the shopping experience extremely simple. And as we continue to just make the platform better, I believe that's the right thing to do for the business.
I just wanted to understand from your standpoint, how opposed are you all to actually introducing something like a platform fee? Because just mathematically speaking, you guys, last year did what? Close to around 183 crore orders that were placed. This year, first half, you've done nearly 125. You annualize that closer to 280 thereabouts. Even if you charge a 1 rupee platform fee, That's straight 280 crores to the EBITDA. Why are you morally opposed to that? Or are you?
I think we are actually, and I would say we've been a very, very customer-focused company from the beginning. And we believe it takes a lot of effort to earn the trust of your customers. And anything which basically goes against some of those principles, we'll not do. There could be many ways of like making like a lot of money in the short term, but if it trades off with some of our principles, we actually don't want to take that.
But you're not profiteering out of them. It's a platform that you're providing them, and it's a legit service that you're providing them.
I think, again, that's the thing, right? Like if you introduce something at the end to a customer and they come onto your platform, they look at a particular price and they suddenly get a surprise at the end, it can that's the thing, right? Like it's the trust. You can't put a number to the trust. Like at what number do you break the trust and at what number do you not break the trust? I think some of this comes less from A/B experiments. It comes a lot from principles, right? Like that you believe in. For the longest time, we've been very, very, like people always believe for the longest time that at some point in time, we will get rid of zero commission. They said, hey, why don't you make some, like X percentage? And we never did it. Right, and same thing holds true here. I think it takes a lot of effort to earn the trust of your ecosystem, and we want to make sure that trust stays, right? Like because that's the only way you will create value in the long term.
At what point does the average order value, which is now 265, 270, hit a trough? It can't keep going lower. So what's in your assessment?
So I think, like Vidit mentioned, first of all, on all of our orders, be it low-priced orders or high-priced orders, we actually make positive contribution margin, roughly similar contribution margin. So for us, it's a lot more about how to mimic the behavior that consumers have offline. If you look at India, most consumers transact very frequently in small amounts because that's how their own sort of cash flows are, and that's how they have been consuming in the offline world as well. So as we make more and more price points affordable by reducing the logistics cost, this number might come down, but we will still be profitably serving those orders. And, it should mimic how India consumes in some sense. We don't have a specific forecast on that.
So what are your contribution margin levers? Because the first half of this year, it's been about 3.8%. The last year was around 5%. How do you grow from here on the contribution margins?
So I think the philosophy there would be that, the ad revenues, which are still much lower for us in relation to how the overall sort of emerging market basis, those will continue to grow. If you look at most other emerging market e-commerce platforms like Pinduoduo or many others, they have seen much higher growth of ad revenues, and a lot of those ad revenue growth comes when the platform is, much larger, the annual transacting user base.
You are already the largest, come on. You have to increase that a lot more.
Yeah, but I think the scope that we have from a headroom perspective is also quite large.
How much is it as a proportion of your overall revenue right now?
So if you look at the global benchmarks, this would be somewhere around 5% of GMV levels, right?
Okay.
So
and yours is lower.
Ours is lower.
What are the steady state contribution margins you're aspiring for?
So I think it should be closer to where the global benchmarks are.
That
I
is?
think,
mid-single digits?
Global benchmarks tend to be about 8 to 10% of kind of NMV. So it should be in those lines.
And what value have you left on the table for people? I have to ask you this because it's 5x sales. Yes, you would say, okay, Eternal is 13x, you have Swiggy, which is 6x, Nykaa is about 10x, all the others are around 9x, you are closer to DMart, but then you're nowhere closer to DMart's profits as well, right? So at 5x sales, how much value do you think you've left on the table?
So I think our objective has been to, first of all, get the right quality of investors as part of the IPO. We have been a private company. Now when we are turning public, I think the foremost objective that, let's say, Vidit, Sanjeev, the board had was that how do we get the most high quality long-term shareholders into the mix, be it domestic investors, foreign investors, sovereign wealth funds, etc. And at what value are they, attracted to the offering? And that's been the defining function. So when our bankers kind of presented to our board saying at this valuation level, most people are comfortable, and then the board kind of took that on as advice and agreed on this valuation. So we believe it's an attractive one, and we'll see it play out.
So that is the management of Meesho. IPO opens on 3rd of December to 5th of December, 5,400 crore IPO approximately there. But let's move on and talk about the important stocks that are moving around in today's trading session. We have Vivek to take us through the list of that buzzing stock list.
Well, thank you so much for that, Vinny. An action-packed day, quite a lot of movers, especially in the broader end of the markets. The bread largely positive. First on the list has to be Paytm. Our colleague Nimish pointed out a significant upgrade coming in from Goldman Sachs. That particular stock high by close to 3% today. IMFA, one stock from the broader end of the markets that we don't talk about too much, but a global, ferrochrome player in South Africa has actually shut down shop. And analysts say that this could lead to significant benefits as far as IMFA is concerned. Poonawalla FinCorp, good volumes today, one of the top gainers as far as the NSE 500 is concerned. And SRF, after a while, this chemical company, after an Access Capital upgrade, stock high close to 4%. And Eureka Forbes, yesterday held a management meet. Very good commentary coming in from the management, especially as medium-term targets are concerned. Stock high by close to 10%, a significant move coming in on Eureka Forbes. On the other hand, quite a few laggards as well. Voltas, been a very volatile last couple of weeks for Voltas today on the lower side among the top F&O laggards. MCX now, here it's seeing a significant fall today on high volumes. Some of the newspaper reports are actually indicating that a lot of data has been asked from brokers regarding the F&O P&Ls from clients, and this has led to a bit of a concern. Stock low by over 4% today. Angel One, again, this particular stock in the NSE 500 index seeing significant selling pressure. Sri Cement, over the past few days, a lot of ground checks have indicated that cement prices have remained soft, low by over 1%. And Yatharth, you did see a large block deal take place. This particular stock on high volumes today hasn't recovered much after the block deal.
Okay, all right, Vivek, thanks very much for that. So those are a lot of the buzzing stocks. And just to add to that list, when you're talking about new companies, IPOs, primary market, we have a new listing, Sudeep Pharma, today as well. And that's listed extremely well in today's trading session. It's up around 28% of the day's high, but nonetheless, strong listing. It was subscribed around 94 times in terms of a total subscription, raised around 268 crores from anchor investors as well. Well, we'll take a short break, but up next, we'll get talking about the technicals of the market. Shrikant Chauhan will be with us. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Let's take a look at the happenings from the F&O desk. Well, the Frontline indices holding fairly in the green. Not a big bazooka sort of move, but we've seen some sort of consolidation from record highs yesterday, and that was pretty much expected. Midcap index is slightly under the weather, as it was in yesterday's trading session as well, and that's something that the advanced decline has been indicating all through the course of today's trading session as well. Largely undecided between red and green, flitting around the flat line and split right down the middle. But the good part is that with the markets moving higher, there has been a moderation in the VIX. So the India VIX is down by about 4%, and it's subbed the 12 mark, which is extremely important from a volatility level standpoint. And now as we speak, even as the market consolidates at these levels, put writers are more active than call writers, telling you there is stronger support than an upside resistance. So we have the 26,200 put, which is fairly active, premium of almost 70 rupees on that one. 26,250 put as well, equally active, and the premium out there is close to around 100 rupees. What does that tell you? Around 26,150 to around 26,170 is where you are likely to see strong support for the Frontline index. Though, as we move towards yesterday's high, closer to 26,310, you might see some supply come in. That's the sense one gets when one looks at the premium at the 26,300 call at around 67 rupees. So around between 26,300 to 26,350 is where the resistance is expected. Though a lot of individual stocks are fairly well long bid today. You have names like Varun Beverages and SRF, both of them up in the tune of 3.5% to 4%, and a lot of open interest backing that. So long build up out there on those two counters. And GAIL, that has been the stock of the day on the way down, and understandably seeing a lot of short positions being added. Nearly 38% jump in open interest. Will be interesting to see whether it enters the F&O ban or not, but will be very crucial to track how GAIL progresses from here on.
Okay, thank you so much for that, Mangalam. We'll keep an eye out on those names over there. But we have some update that's just come in on the IEX and CRC case hearing that's there at the appellate tribunal. Now, seems like the IEX Council is mentioning SEBI's order with respect to insider trading. It's also highlighting that the order mentioned few CRC officials in insider trading. We'll wait out for more updates here. Here's the latest that we have coming in here for IEX and versus the CERC case in terms of the challenge that, they challenged the CERC's order, IEX. So now we'll wait out for the market coupling hearing, finally what happens here. But let's move on. And Sudeep Pharma, Ekta, you were talking about it as well. Yeah. Talk to us about the company as well. Listing has done well, but what is the reason behind this bumper listing?
Well, yes, 29% gain is what you are seeing for Sudeep Pharma. Now, it's a strong listing, like you mentioned. It manufactures pharma excipients, food-grade minerals, specialty nutrition ingredients, and it's present in over 100 countries. 2/3 of its revenue comes from pharma, food nutrition, specialty ingredients is around 1/3, which is a newer segment that they've come out with. 80% of annual revenue is in fact from repeat customers, according to them. They have manufacturing facilities, a total of 5, which is 4 in India and 1 in Ireland. Now, like I mentioned, they did close with a strong subscription. So they were subscribed a total of around 94 times. They've raised around 268 crores from anchor investors. So totally the company, in terms of its IPO, has raised around 895 odd crores. OFS is around 800 crores. Fresh issue of around 95 odd crores. Now, the proceeds will be used for procurement of machinery for production line, which is located at one of their facilities. It's valued at around 45 times plus trailing FY25 PE. So the company says that as of now, there's no listed peer whom they can compare themselves to as we speak. So that's Sudeep Pharma for you. If you look at it on an FY25 basis, revenue is up around 9%, EBITDA is up around 4.6%. Margins also margins declined a little bit, and we have profit, which is up around 4% for the year. Now, the company says that 75 crores will be used for capex expansion of iron phosphate, which is basically an ingredient which goes into children's nutrition, etc. It's also started a new vertical called specialty ingredients, like I mentioned, which has grown to around 170 crores. So it's a higher margin business. And iron phosphate in India has limited approvals, like I mentioned. So it is an opportunity for the company going forward. Well, we'll take a short break, but on the other side, Manisha Gupta will be with us. She's going to take us through a conversation on the other side. Stay tuned.
Welcome back. Joining us on the show now is Krishna B. Goel. Mr. Goel, thank you so much for joining in. And it really seems to be silver that is making headlines right now. We're trading at around all-time highs, $0.50 away from 54.5, really 88% of gains in this year, best year in last 10 years and more. As has been the case in gold, with the price rise, the volumes have declined. Would you say that really is not the case with silver? There are buyers and some more buyers now coming in.
You see, basically, as I told you even previously, that silver is being used also a lot in industrial sector, like all the electronics, the EVs that we are making, all the batteries. So the consumption of silver, actually, if you see, it is much higher than the actual production. In case of gold, yes, the consumption has gone down because there are less buyers now. But in silver, it is on increasing trend.
I get your point, Mr. Goel, that industrial demand has been increasing. But what about the investment demand? Because we're looking at newer category of people now coming in for silver with the kind of returns it's given.
Yes, you see, everyone sees that there will be a good increase and good return on investment even in silver. That's why if you look near Diwali, there was no silver available in market. And the premium in Indian market went up to 40,000 rupees, which was unprecedented. So the new category of investors is jumping into this category for investment purpose, but at the same time, the demand for jewelry, because lifestyle is changing with weddings being done out of their own town, destination weddings, everyone wants to have jewelry which is safe and which they can easily wear, So silver, even in terms of jewelry, the demand has increased. In industrial use, the demand has increased. So there is all positive signs. I mean, almost 7 to 8% production is less than the overall demand.
Oh, absolutely. In the Indian context then, Mr. Goel, are we looking at more people investing as in sense of industry as well? Until now, it has been about diamond jewelry stores and gold stores. Are we looking at more single silver stores coming up as well?
You see, this trend will certainly will be up. If we look at the West, there were a lot of gold buyers and the shops were only selling gold or diamond studded jewelry. But slowly, the trend changes and there were single stores for silver jewelry and the articles. So India will see the dramatic change because of the lifestyle and the new generation which won't use jewelry for their everyday use. Today, everyone is not looking only for the investment, but also for personal adornment. So that shift is being noticed strongly from in last couple of years.
Mr. Goel, what is your sense also on prices from here? 87% of gains already. If you look at the last 2 years, it has been 165% of gains. So silver clearly has been on fire for the last couple of years. How is the outlook now for 2026?
You see, basically, it will keep on increasing, maybe not that speedily as it has been in past couple of years. But since, as I told you, that the production is less, demand is more, so the trend will continue to upwards.
Mr. Goel, the kind of buying that we've seen in Indian markets, jewelry you already have spoken about, and then of course the investment demand in coins and bars is another thing. But would you say the usual silver purchase in India that clearly has been about utensils and statues, etc., is that continuing as well at these current levels?
You see, Manisha, if you remember, I remember from my childhood, every Diwali, every Dhanteras, my grandfather used to buy silver coins. So in Indian culture, the silver has always played a very important role. In our houses, we see that even in our daily uses, we use a lot of silver glasses, silver mugs, So the articles per se, will always be in demand in India.
Oh, well, absolutely. Very well said. Yes, when it comes to silver, whether it's about investment and bar coins, gifting, it has been a way of culture and, of course, investment and now industrial demand as well. So absolutely, the prices are expected to continue to go higher from here. Mr. Goyal, as always, thank you so much for taking time out and joining in and weighing in with your sense on where the silver perhaps could be headed. Well, with that, let's go for a short break. When we come back, we'll talk more about markets and, of course, the second quarter GDP and what's expected from that one today.
As of now, markets 26,200 levels. Around that is what the Nifty trades at. But let's move on and talk about the second quarter GDP numbers that are due today. Maybe almost an eye-popping as Q1 GDP. A CNBC-TV18 poll sees Q2 GDP growth now at 7.4% versus 7.8% in Q1. Hence, most economists have raised their full-year GDP growth forecast to about 7%. Lata, looks like a good show today, right?
One reason why it's good is look at the year-ago number, 5.6%. That was a terrible second quarter we had. So it's perhaps easy to look good because of that. And it's a tad lower than the 7.8%, which was a genuinely eye-popping number which we got for Q1. However, this is real GDP is what we are talking about. That is, we are taking away the price effect. We're only looking at the rise in goods and services. If you add the price effect, what you call nominal GDP, that's growing at only 8% versus 8.3 year ago and versus 8.8 in Q1 and versus a union budget assumption of 10.8%. So clearly there are going to be problems because of that. The growth at the moment, let us look at the good news. The real GDP growing by 7.4 is going to be helped by all sectors. That is agri, manufacturing and services. Agriculture is seen growing at 3.5, which is very good for agriculture. You know, there are limits. You can't expect it to grow at 8%. Manufacturing, very good, expected to grow at 8.9%, partly because of the front loading of exports and a very good capex spend by the government. Both those helped manufacturing, and services also doing very well at 8.1. Largely finance, real estate, trade, all of them did well. The poll for Q3 and Q4 are also in, but they're preliminary numbers. Q3 is expected to grow, that is the current quarter, at 6.7%, and Q4 at 6.3%. For one thing, they also have a high base, especially Q4. But most of the economists said these are subject to change after we look at the Q2 numbers. Overall, if you average it out, the full year number comes now at 7.02, which is very good because if you remember the CEA, when he presented the economic survey before the budget, he said he expected 6.3 to 6.8. The most optimistic number was 6.8, but now economists are saying it can be above 7%. Again, nominal GDP is the worry. It is going to grow by 8% according to our poll. You know, nominal GDP is important because that is what gets counted in the budget. That is what gets counted in earnings forecasts of companies. You don't take out the price effect. You just take the profit. Now that if it is overall is growing only at 8%, you have a problem. There could be an earnings growth problem if nominal GDP is that low.
Take that point, Lata. Thank you so much for laying that down bare for us. We will obviously watch out for the number as it comes by after markets today. We take a short break, come back, focus on the markets once again. There is consolidation which continues. The Nifty now marginally in the red as against being marginally in the green in the previous segment. Take a break, come back, more on the markets.
Welcome back. Well, for the markets, it's absolutely flat. But if you look at specific stocks on a week-to-date basis, if you had invested in, say, Hindalco or TechM at the start of the week, you would be sitting on gains of around 4% to maybe 3.5% at this point in time. And conversely, on the negative side, the top two losers on a week-to-date basis stands at Adani Enterprises, which has lost around 4.5%, and SBI Life, which has lost around 3% as well. Well, on that note, it's a wrap on the show on Halftime Report. Stay tuned. Business Lunch just after a short break.
Stocks trade in a narrow range with advances and declines almost evenly balanced ahead of the weekend. The metal stocks gain while energy stocks are the big drags. The Petroleum and Natural Gas Regulatory Board, the PNGRB, has approved an upward revision in its tariff by 12% against the 20% expected. The next tariff review is expected only in FY28. The stock of GAIL slips on the disappointment. Online retailer Meesho announces its 5,400 crore rupee IPO, eyeing a valuation of nearly 50,000 crore rupees. The e-commerce leader expects higher ad revenues to drive up cash flows as it expands, even as it rules out charging users a commission. Silver scales to its all-time high of $54.50 an ounce as high industrial demand and strong investment interest points to a significant deficit. Hopes of a rate cut by the US Federal Reserve further aids sentiment. And US President Donald Trump posts that he is halting migration from third world countries. He argues that immigration policies have weakened America and it needs time to fully recover. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. The market's currently in snooze mode, trading in very narrow range. The big news, of course, is from IEX. We continue to track that, hearing from the Electricity Appellate Tribunal. But for now, the index has briefly slipped into the red. Before that, it was trading in a very narrow range as we speak. The range for today is only 110 points. 26,172 is the intraday low, and 26,280 being the intraday high for the index. The Nifty Bank made an intraday record, made yet another dash towards the mark of 60,000, but that too has cooled off ever so slightly from the highs of the day. 59,900 was the intraday high, so about 120 points off the highs is where the Nifty Bank currently stands. But the broader markets have continued to be the focal point of the entire week, be it the market breadth, be it the advanced decline. As the Midcap index currently in the red, has come off the highs of the day. The advanced decline now in favor of the declines, and that gap which was starting to get wider is again starting to converge just ever so slightly. But for now, there are more stocks that are declining compared to those that are advancing. Just pull up Yatharth Hospitals before we go on to GAIL, and that stock has slumped to the lowest point of the day, 8% lower now on Yatharth Hospitals. A block deal took place just a few minutes earlier, and as a result of which the stock has seen this big slide. But the talking point of the morning though was GAIL, and the stock continues to remain lower, and that is after the PNGRB approved revisions order for the company's transmission tariffs. Sonal is here to break all of this down for us and what brokerages are making of it. Sonal.
Thank you for that. Well, yes, the transmission tariffs have been announced, and it's lower than what the street was working with. Remember, GAIL had asked for a 33% tariff hike. The street was expecting that maybe not 33%, it would be a 20% hike, but there's just a 12% hike that has come by, and that is something which is disappointing the street as well. Now, remember, the PNGRB told CNBC-TV18 that this is just an interim relief that has come by. There will be another set of tariff hikes which will happen in 2028. And that is when they will see higher levels as well, because right now they've not considered a lot of factors, something like the actual and future operating expenditure and capex that is taken up by these transmission companies. But yes, this is a disappointment which the street was not factoring in. Brokerages, they also do not have a lot of positive view on this particular incident. For instance, UBS says that tariff hike is disappointed. They do have a buy rating, but they are disappointed with the result that has come by because they think realized tariffs could even be lower than 12% after considering and adjusting for other metrics as well when it comes to the P&L. They, however, like the fact that there could be another hike that would come by in 2028, and the fact that PNGRB wants to smoothen the process, not hike tariffs at one go, which could impact customers. This will be the key to watch out for. Citi has a buy rating as well. They believe 12% is lower than the 15% mark that they had anticipated, and this should also set into motion implementation of the new unified tariff regime, which will also be beneficial for IGL. That stock too is higher in trade today. Jefferies says this is largely in line with what they were expecting, and hence they're going ahead with EBITDA revision on the upside by 7% for the next 2 fiscals, and they have a target price of 230 rupees on the share.
Interesting, Sonal. Thank you for that. A slight recovery from the lows of the day for GAIL, is 4.5% lower currently. In fact, we spoke to PNGRB earlier today, and they told us that this is just an interim relief and that tariffs will be revised again in FY28. Listen in.
we have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll do up everything. It is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein we'll all do up all the factors, capex, opex, pay, relief, everything we will give.
It will increase by 1,200 crore rupees per annum based on existing volume. And next year we are also expecting at least 8 to 10% volume hike. So therefore it will be around 1,300 to 1,350 crore rupees per annum. Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and do up in next revision. So we were expecting the tariff based on those revisions should be 70-72 rupees, but it has come down to 65 rupees, 69 rupees. There is a gap from our expectations of around 5-6 rupees. And since we are yet to go through the tariff order, we'll see what are those parameters based on which tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
That was Gail, the top talking point of the morning before, of course, IEX takes over that mandate. The hearing continuing at the Aptel, still waiting for observations to come by. The stock, though, currently witnessing some very, very choppy moves, had seen a spike towards the highs of the day. That recovery has been sold into, currently trading at the flat line there for IEX, still awaiting observations from Aptel. But moving on to some key reactions from HAL's chairman and managing director following the Tejas air crash in Dubai. DK Suresh defended the Tejas and said that the order book for the aircraft remains strong. Listen into what he had to say.
At the outset, let me tell you that there is absolutely no problem with the Tejas. Let me declare it from this forum. There is no problem with the Tejas. It's a wonderful aircraft, and it is absolutely safe, and its safety record is the best in the world. We've had a couple of them, and what you saw in Dubai was an unfortunate incident. I think as countries evolve and develop their own technologies, they go through phases. And today we've made this 4.5 generation aircraft with the latest capability. It's a resounding success, and we should all be proud of it. So I think there will always be naysayers who are talking about this and raising questions, but it will not deter us. We have an order for 180, and I'm sure it will go up, and we will definitely even have an export market for this. So I think this comes up every time there is some indigenous product, and there are bound to be some failures or problems. I would not say conspiracy. It's perhaps social media is quite prevalent today, and everybody has an opinion. And I would also go so far as say that everybody considers himself an expert also. So I suppose that's part of the world today.
Meanwhile, the Defence Secretary spoke on the problem of delivery delays by the Tejas and other manufacturers. Listen to what he had to say.
Delays are not only by domestic manufacturers. You've seen the S-400s getting delayed because of the conflicts. Israel orders, also many of them are delayed because of the conflicts that they are facing. There are supply chain issues which have affected them in the context of the General Electric engines that they've been having to wait for. So yes, all of it is not solely attributable to our indigenous manufacturers, but yes, I mean, there is a tendency to overpromise and underdeliver, and we will need to start cracking down much more, apply LD clauses much more, and in the current round of emergency purchases that we are doing, we've actually taken a very tough stand that any case where delivery is not done within 1 year will all be foreclosed, and I intend to sort of ensure that that is done. So irrespective of who it is, which company, which country, we will foreclose every contract after 1 year hopefully those kind of decisions will start bringing in some level of accountability when it comes to delivery milestones.
So observations now coming in from Aptel with regards to the market coupling case for IEX, and they have observed that they are concerned about the allegations made across the bar and they wish to inquire further. And since these allegations, if found to be true, would cast a cloud on the manner in which the independent regulator functions. Remember all of this now at the Electricity Appellate Tribunal. The counsel for IEX has cited the insider trading report from SEBI, which mentioned that it is because of that that the stock had crashed 29% in a single trading session that was on the 24th of July of this year. And the Aptel has further observed that they are not expressing any opinion in this regard, and they wish to emphasize the need for them to undertake an early hearing of the matter before the regulations are notified. Remember, these market coupling notifications were supposed to be taking effect from January of 2026. So they would want to seek an early hearing with regards to this, is what the Aptel has observed. And they are also saying that they are open to look into any case of corruption, and the regulator must avoid the appearance of wrongdoing. That's the observations expressed by the Electricity Appellate Tribunal in its hearing on the market coupling case. And as of now, so there has been no concrete observation yet. The hearing will now take place in the first week of January, is what we're getting to know. And so no significant reaction as of now on the stock. We'll get back to this in just a bit, but this is what the Aptel observations are, that they are concerned with regards to the allegations that have been leveled and they would want to inquire further. And for now, they are not expressing any opinion, but they are emphasizing the need of an early hearing before these regulations are officially notified. While moving on, then getting you some updates from the auto sector, sources are telling us that the OEMs have written to the Ministry of Heavy Industries on the soon to be implemented CAFE 3 norms. Parikshit is here to tell us more on this. Parikshit.
Well, this seems to be becoming a big problem for the automotive industry, and frankly, they are divided. Multiple OEMs have written to the Minister for Heavy Industries, H.D. Kumaraswamy, saying that the proposed CAFE 3 norms will create a new subcategory for small vehicles, and all this will benefit only one OEM, that is Maruti Suzuki. They've said that this creation of subcategory within the CAFE 3 norms, or the corporate average fuel efficiency norms, based on weight, will have an adverse impact on the nation's progress towards safer and cleaner cars. This at a time when the industry has made a lot of investments towards electric vehicles. The industry has said, and these are 5 or 6 of the top OEMs in the country, they have said to the minister that no relaxation in emission norms should be extended to cars up to 909 kgs, engine capacity up to 1200 cc, and length not extending 4000 millimeters. The reason being, Maruti Suzuki has a 95% share in cars up to 909 kgs. The industry has also gone on to say that if you want to grant concessions on CO2 emissions, then you must grant it for all cars up to 1170 kgs, which is the industry average. Granting CO2 reduction credits to ICE vehicles only based on weight and without the CO2 reduction measures will contradict the purpose and the intention of corporate average fuel efficiency norms, which is to increase and improve the emission norms, control the emissions by vehicles, and also give better fuel efficiency to consumers. They've also gone on to say that the GST has already defined what the small cars are under 1200 cc, and if you now go ahead and create another subcategory as a result of the CAFE norms, then you would be confusing the industry and also impacting investments in supply chains for the future. Vehicle weights have been increasing according to the industry because of safety regulations, and there should be no specific benefits to just one OEM. If there is any benefit, it should be for all.
Parikshit, thank you for that update there. Let us also now listen to what Rajesh Jejurikar, the Executive Director and CEO of Mahindra & Mahindra, had to say about the CAFE norms to CNBC TV18.
Here the first question is what are going to be those norms, and right now that's at a draft stage. Yeah. So, there are multiple scenarios that can play out based on what finally comes through as the draft norms. So what we have to do as an OEM is really prepare ourselves for multiple scenarios, and that's what we're doing. And we believe based on the SIAM the primary view of the SIAM is to stay with the December 2024 draft that was done. There is a different version of a draft now, and the government is in the process of reconciling all the feedback on that. And we would prepare ourselves to meet the CAFE norms based on whatever scenario plays out.
Take a short break. More news and updates follow on the other side. Get you more updates on IEX as well. Welcome back. Now, in a fallout of the deadly shooting of two U.S. National Guards near the White House, U.S. President Donald Trump has warned of a stricter immigration policy and has threatened to permanently pause migration from all third world countries. Parikshit is joining in to tell us more. Parikshit.
Well, yes, this is a very strong post from President Donald Trump, who said he's going to pause migration from all third countries. And this is to ensure that benefits for non-citizens come to an end, and there's a major reduction in illegal and disruptive populations. So it'll take some time for diplomats of the United States around the world, for other nations to understand what this really means. Is he talking only about illegal trafficking of citizens into the United States, illegal border crossing? Does he want to clamp down on legal forms of migration? For example, work visas, travel and tourism, students. What does Donald Trump mean? Nobody understands that right now. But what we're told, that usually whenever President Trump tweets or puts out a post on X on any changes around travel or visas, then it takes a day or two for the White House or the US State Department to issue a guidance to US embassies, missions and consulates all around the world. So similarly in this case, yes, he's given an intent on social media, but the guidelines are likely to follow in the next few days. For the moment, the visa processing at US missions around the world, we are told and given to understand, is being processed and is taking place normally as before. Any changes would take some time to get communicated. It may be through an executive order, it may be through directions from the State Department. But just for context, tackling illegal entry of people into the United States has been a priority for this administration. From the start of the year, over 2,700 Indians, approximately 2,080, have been deported from the United States. These were people who were living illegally. The border crossings, we are told, of Indians being caught crossing the border into America, this is at a 4-year low. And this continues to be a major area of cooperation between India and the United States. So clearly, what President Trump has said will worry a lot of governments, and India too will engage with the US.
Parikshit, thank you for that update. And since that post from Donald Trump on Truth Social, the Nifty IT index saw some bit of profit booking, but not alarmingly. It's still in the red, currently trading around the flat line as we speak. Take a short break. More news and updates on the other side. Welcome back. Now, the death toll in the most deadliest fire Hong Kong has witnessed in nearly 80 years has now climbed to 94, with hundreds still missing. The Hong Kong police have arrested 2 directors and an engineering consultant of a firm contracted to perform maintenance on buildings on suspicion of manslaughter for using unsafe materials. While firefighters have mostly contained the blaze, which was raging for more than 24 hours, families continue to line up to identify their loved ones. Take a leave on this edition of Business Lunch. From me and the team, thank you so much for watching. Midcap Radar takes over the action from the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. It's the last day of the trading week. The Nifty has come off from the highs, almost a 50-point cut from the highs of the day. Mid-caps are sulking, and we do have the advance decline ratio in favor of the declines now. So market breadth continues to be in favor of declines.
That's right. Good afternoon, Sonal. So much happening. It's been a very volatile trading session, like you mentioned, and the mid-caps underperforming the benchmarks. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks trade ranged with advances and declines almost evenly balanced ahead of the weekend. Metals gain while energy drags. Mid-caps relatively underperform key indices.
The PNGRB hikes gas transmission tariff to 65 rupees per MMBTU, lower than the 78 rupee figure sought by GAIL. The stock slumped 6% even as the management tells CNBC-TV18 that they will pass on tariff hikes to customers. The PNGRB also tells us that there is no recourse available for GAIL.
Eureka Forbes shares surged almost 10% today after the management in its investor meet says that the company targets to grow its revenue by 2x and EBITDA by 3x by FY30. They believe that this guidance is achievable provided positive macro tailwinds.
Sudeep Pharma shares list at a healthy 23% premium against its issue price of 593 rupees a share. The company's IPO was subscribed 94 times during the IPO process. Okay, all right. Those are the top headlines that we are tracking. The mid-cap index, that is the focal point, because when we started the trading day, the advance decline ratio was in favor of advances, but now it is in favor of decline. So important to track which way things go by the end of the trading session as well. We have some of these sectoral movers, something like a Nifty Media, which is the top gainer right now. Auto is doing well, but even then, that has come off from the highs. Nifty Pharma doing well. Metals continue to take charge. But the CPSE, oil and gas index, and also the energy space, seeing some pressure, and there's a lot happening in the space generally.
That's right. One stock I'd like to quickly focus on was IEX. Some time ago, you saw the flashes on your screen stating that, the next hearing will be in January 6th. A lot happened and a lot transpired in the hearing today. One of the key points put across by the Council of IEX was the fact that they do want to go ahead and take into account the SEBI ex parte order regarding the insider trading allegations as well. On the back of that, IEX remains in focus, largely flat post the hearing. But moving on, this is our special segment, Midcap Movers. Sudarshan is standing by the wall to take us through the midcaps that are moving around in the session.
So first, I'll talk about the stocks. Those are reacting on the basis of news. And on top of that is GAIL, that is reacting to the order released by PNGRB, which has increased the tariff, but that's below expectation. That's the reason stock at one point was down 6%, currently trading with a cut of almost 5%. MCX is under pressure because there have been several reports regarding the SEBI's action. And that is one of the reasons why stock is under pressure, almost down 4%. Varun Beverages, in one of the conferences, I assume it was Goldman Sachs conference, and it has said that growth might be back on the track after Q3, and that's the reason the stock is up. It's up currently more than 3%. 63 moves. There was NCLT order. It was a positive order, settlement order regarding the case of NSEL, and on the back of that, the stock has surged almost 16%. Hindustan Zinc is higher because silver price is trading near record high. Some of the other mid-cap gainers, SRF is reacting to positive brokerage note. Stock is currently up more than 3%. Nectar Life, since the time stock has released its quarterly earnings, it has been moving in one direction. Today also it has hit the upper circuit, currently up almost 20%. Reflex has seen a block deal of almost 0.2% equity, and that's the reason stock is up more than 3%. Sigachi is currently high with healthy volumes. Today's volumes is 65's 10-day average, and currently the stock is up almost 12%. Last one, Eureka Forbes, as you have mentioned, on the back of the healthy guidance, the company is looking to increase the revenue by 2x and EBITDA by 3x by FY30. And because of that, stock has seen a sharp move, currently up more than 8%. So the mid-cap losers, most of the capital market names are currently under pressure. Angel One is one of the top losers, down almost 3%. Page Industry has been moving lower since the company had announced Q2 earnings. And for the last 2 to 3 sessions, stock has been down almost 5%. Today also it's down almost 2%. Aztec Life and GMDC are seeing profit booking and down in the range of 2 to 4%.
Okay, all right. Thank you so much, Sudarshan, for joining us with all those names. It's a good time to welcome Himen Kapadia from DR Choksi for a technical check on the markets. Himen, good afternoon. Thank you so much for joining in. What are the markets factoring in when it comes to the technical viewpoint? What are the next important levels to watch out for? Do you think last 1 hour of trade could turn more volatile?
Very good afternoon to you, Sonal. Thank you for having me on the show. It's always a pleasure. I think so because, see, 26,277 was a high on 27th September 2024. We went to 26,300, but we haven't exactly done well after that. It's natural if you have all-time high coming after almost 13, 14 months. You expect some sort of hesitancy, little bit of trepidation. I mean, we need to take that out. And, as of now, like you guys also mentioned, it's been like maybe 8 stocks which are moving the market. It's been an insipid move. It's like a dal without tadka, there's no taste. Mid-cap, small caps have been floundering. Mid-caps have done a shade better. So, and everything is riding piggyback on Reliance and the Bank Nifty. So this needs to get broad-based, and just an all-time high, frankly speaking, isn't enough. You don't see a sweeping bull market like you would normally see. It's just narrow pockets. So as of now, the structure is fine. Levels 26,300 needs to get taken out. More importantly, 26,104 needs to hold for the current ongoing positives to continue. And if the Bank Nifty is doing what it is doing, I think things are evenly poised. I'd be more positive than negative, but the advanced line needs to improve. The rupee needs to strengthen. So a few many if and buts. I guess everything centers around the trade deal. Maybe that should trigger off a mid-cap move. Sonal.
Right. Thank you so much, Heyman, for your views on that, and very good analogy as far as the current market up move is concerned. But Heyman, which are the individual stocks you're recommending at current levels? Mainly from the large cap pack, or do you have a few mid and small cap names as well?
No, I will be safe and go with the large caps, Vivek. Firstly, there's a buy call on LTTS. Stock has, firstly, it's out of the FNO. So the volatility cools off and you see genuine fundamentals discovering price. The stock has formed a medium-term bottom. The oscillators on the weekly charts have given a crossover buy. After reflecting positive divergence, everything seems set. Yes, the IT index has made a bottom. TCS has turned, Infosys has turned. Everything looks hunky-dory. So I believe time for LTTS to play catch up. One can buy LTTS at around 44.20. Stop loss 43.20, target of 46.20. I believe it's a modest target. We should be going towards 4,800 or more, probably in December itself. The second stock is Lupin. Sun Pharma has turned for the better. Glenmark has shown traction. And Lupin has, frankly speaking, been hatching eggs, doing nothing over quite some time. It's formed a beautiful rounding bottom on the weekly chart. The oscillators are supporting the move. It's set for an intermediate uptrend. So one can buy Lupin at around 2075, stop loss 2025, target of 2175. Once again, I believe we should be going to 2300 or more. Looks quite comfortably poised for an upside. Vivek.
Okay, all right. Thank you so much, Heyman, for joining us as always and taking us through your technical picks. Have a great weekend ahead. With that, we'll slip into a short break. When we come back, we'll talk about individual stocks that are moving around in the broader market. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar. Well, while the broader markets is lower in trade, we are seeing a lot of action in specific stocks, and there is a new listing as well. Sudhi Pharma listed at a 23% premium to its IPO price, and it has seen a one-way move from those levels. Look at that. It's up 34% as we speak. So strong listing and some gains on that listing as well. Now, the company manufactures food-grade minerals, specialty nutrition ingredients, and is present in over 100 countries. Two-thirds of the revenues are coming in from pharma. Rest is food, nutrition, and specialty ingredients. 80% of their revenues are coming in from repeat customers, and they have around 5 manufacturing facilities, out of which 4 are in India and 1 is in Ireland. Now, the subscription was very strong, 94 times, and that reflects in the listing price as well. They raised around 270 crore rupees from anchor investors. They raised total of around 900 crore rupees, out of which 800 crore rupees was offer for sales. That did not go into the company, and the rest was fresh issue. That is something that they will be using to procure machinery for production of a line located at their Nandesari facility. This now is valued at around 45 times their FY25 EPS, so trailing EPS that is. Company says they do not really have a listed peer they can be compared to. But let's look at the performance now. They have seen an increase in revenues, but it is not by a big margin. From say 450 crore rupees, now it's 500 crore rupees. The EBITDA has increased, largely flat actually. Margins have actually come off on a YY basis. Profits also barely an increase on a YY basis. But you know, the listing has been really strong. They say that 75 crore rupees will be used for capex. They've also started new vertical specialty ingredients in FY22, which has grown to 170 crore rupees, which is the higher margin business. And phosphate, basically, it is a rare approval that comes by for companies, but this company has received this approval. So yes, not a big increase in terms of numbers from FY24 to FY25. Even in FY23, they had margins of around 20.8%. That is something which has increased, and Street thinks maybe that could continue, but important to watch out for the revenue growth prospects, the margins as well, and what happens with valuations from here on, so that we'll be tracking closely.
That's right. Thank you so much, Sonal, for explaining all of the details as far as the latest kid on the block is concerned. But moving on, this is our special segment, Midcap Spotlight. Upasana will focus on Eureka Forbes, which recently held its analyst meet.
Well, certainly, company held its analyst meet yesterday, and here are some of the key important takeaways. Firstly, the company targets to grow revenue by 2 times and EBITDA by 3 times by FY30. And the company believes this guidance is much achievable if the macro tailwinds are positive, and they continue to remain positive. Now, let us look at some of the other important takeaways in which the management has reinforced the company's transition from a product-led water purifier brand to a broader health and hygiene player. It also aims to achieve a revenue target of 1,000 crores of revenue from its robotics segment by FY30 is what they have indicated. And it has also said that it will continue to focus on creating brand awareness through advertising and promotion spends. Now, despite higher investments in capex, R&D, and even advertisement and promotion, the company expects to achieve mid-teen EBITDA margin on the back of the portfolio mix and operating leverage kicking in is what they've indicated. And lastly, company has also highlighted that its newer categories like air purifier and water softeners provide a healthy runway for growth for the company. Now, on the back of this, ICICI Securities believes that the company is structurally better placed for long-term growth, supported by integrated product services, digital-led model. Hence, it has given a buy rating and also upped its target price from 685 to 700 per share.
Okay, all right. Thank you so much, Upasana, for joining us. So that's our mid-cap spotlight stock. Let us now focus on the metal space. There's Hindustan Zinc, Indian Metals and Ferroalloys, or INFA, at day's high. Nigel is here to tell us what's aiding this move. Nigel?
Well, that's right. Earlier this morning, we had highlighted that 2 stocks could potentially be in focus. One would be, Hindustan Zinc, and the other one would be INFA. Let's address Hindustan Zinc first. That one has moved high, and it's holding with some gains today. Why is that? Silver prices on the verge of going to a fresh all-time high. Remember, it went to that ballpark $55 per ounce odd, and then we saw a bit of a correction on silver. Now, silver's back out there, various factors at play, whether it's with regard to the consumption or whether it's with regard to a bit of a supply deficiency in the market or even the much-awaited Fed rate cut. Put all that together, silver's doing well, and Hindustan Zinc is the only listed play to play silver out here. So that's why that stock is holding up. To give you a number, more than 40-45% of its total EBIT number comes in from silver. So that's about Hindustan Zinc. Next, moving to Infra. And, across, for the last 18 months or so, we have been highlighting this point that chrome ore prices are moving up. And because of that, ferrochrome prices could get some sort of a base. Now, in addition to that, there are some smelters that actually have been shut down. Case in point being, a couple of global smelters. You have Saman Core Chrome, which has announced that they will be gradually shutting down. They're giving a one-time to their employees as well. So a couple of their facilities will be shut down. And Glencore Mirafe, they have already gone ahead and shut down some of their furnaces. So basically, globally, ferrochrome players, they are finding it very unviable to go ahead and produce ferrochrome with the elevated cost of production. Now, so that's why there'll be lower ferrochrome production in the globe. But you'll say that China will produce more, right? So China could probably make up for that shortfall, but China has an export tax out there. So that's not going to change the global dynamics with regard to ferrochrome. Net-net, Infra stands to gain because on the cost of production front, they don't get hit. They're backward integrated, chrome ore from their own mines. So that's why they'll enjoy the higher pricing of ferrochrome and not get hit on the cost of production. Explains why Infra is up because of a shortfall in global capacity, while Hindustan Zinc is gaining because silver prices are doing quite well. Back to you.
Well, thank you so much, Nigel, for joining in and giving us all the details on the developments as far as the metal space is concerned. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, one particular stock, that's making all the news today, given the fact that there was an Aptel hearing as far as the implementation of market coupling was concerned, was IEX. IEX continues to remain in focus. Well, just to give a quick background as to what exactly is market coupling, remember in July 2025, CERC had said that there will be implementation of market coupling that will be notified, and there will be regulations that will be put out come January 2026. Now, remember, IEX is the dominant player, has the highest market share when it comes to the short-term power market, which is the day-ahead market with over 85% market share. In fact, in most times, the market share trends over 90%. Now, with the implementation of market coupling, what it essentially meant was that the price discovery process, as far as the short-term market, would happen in all three exchanges in a circular manner. And in fact, CERC had also said that Grid India could be the fourth exchange, indicating that there could be a potential loss of market share when it comes to IEX, post which you did see a significant correction in the shares of IEX, post the order that did come in. Post which IEX went ahead and approached Aptel, and the hearings have been going on in a subsequent manner. The latest hearing that happened today took into account a SEBI's ex parte order, which indicated that there were wrongdoings that took place during the process of the implementation and the hearings that led to the conclusion of the implementation of market coupling. In today's hearing, what essentially transpired was that the final Aptel was not, there was no announcement as to what exactly the order was, but there was a fresh date given where, number one, the fresh date is January 6th, and what essentially will transpire is that IEX will go ahead and take on board all of the allegations that will come in, especially in terms of the insider trading case, post which both the councils will have an opportunity to meet the Aptel course. So essentially what is expected to transpire is that this case will prolong for some more time, and as of now, it is status quo. There is no change as far as the implementation of market coupling is concerned.
All right, that's about IEX. We'll keep getting more updates on that. That's an important update and case to track. But we have run out of time on Midcap Radar today. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of the market, it's been a muted sort of a day in terms of an up move or a down move. We're seeing that flip-flop between the red and the green as of now. Just trading with a slight bit of the negative bias right now. The Nifty 26,200 though is what it's managing to hold on to as of now. Let's look at the broader end of the market. When you look at the Nifty Midcap, bit of an underperformance that's coming on that front, right? Nifty Midcap is down almost 0.1%. Small Cap 2 is trading with cuts of 0.3%. And that is why let's pull up the advance decline ratio now. At one point of time, we were a slight bit more in favor of the advances versus declines. But now look at the crisscross. And then at our 12:01, we've seen that move coming in where declines have increased and the advances have reduced. So a slight bit of a gap over there, and we'll be watching out for what happens in the next couple of hours of trading session as well. But yes, that's a market setup that we're watching out for. But this is a show where we solve all your stock-related queries, and we're going to be just doing that with Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, Vice President, Technical Research at Prabhudas Leeladhar. Shaina, as well as Vaishali, good afternoon. Thank you so much for joining us on the show as always. Vaishali, before we start with those queries, your thoughts in terms of the markets. Monday we'll start seeing December coming in. What is the expectation then?
Hi, very good afternoon. I think market is on a bullish mode, but normally in December we see a very sideways move. So bias continues to be positive, and I think now 26,000 should act as a support, and very likely we can see 2,500, 600 to start with.
Okay, we'll watch out for those levels. 26,000 support is what we'll be keeping an eye out on as well. But let's keep it going and get started with the stock-related queries. Let's move on to the first query for today. We have Ricky, who's writing to us from Pune, holding 25 shares of LG Electronics at a price. This is LG Electronics India. Price is 1,690 rupees per share. Wants to know the outlook for LG Electronics. In terms of a move today also, as of now, 1,658 is what the stock is trading at. Shaina, your view for LG Electronics?
It's had a very good listing, and it's well above the listing price, the recent listing. At the same time, I think the investors bought it at a slightly elevated level. And so from here, I believe that the stock will consolidate for quite some time actually before he actually sees a good return from his buy price. Basically, valuations are not cheap. If you look at it in terms of P, it's about 52 times FY27 earnings. And even the second quarter numbers were a bit disappointing. Of course, GST did play a role in it in terms of the top line, but profits also were lower. So I do believe that in terms of valuation and all these other factors, at least for the next 2-3 quarters, getting a good return from here from the buyer's price looks difficult. So I would say it is better to switch or keep a stop loss and exit if you see too much of downside.
Okay, switch, maybe keep a stop loss also is the word coming in from Shaina. Vaishali, I know this is absolutely recent listing that we're seeing, but any thoughts that one could look at maybe if they exit the stock right now, any buy target or levels that one should be comfortable maybe to look at entering in?
Well, actually, of course, I hardly have any data, but from what I'm seeing the recent movement, I think 1620 is acting as a support, and today's candle shows hope. So I think there is good momentum coming in. So if we see the stock moving above 1650, 1660 and sustaining above that, very likely this can go towards 1700, 1800. So I won't be in a hurry. I would say hold with a stop loss of 1620.
Okay, hold with a stop loss of 1520. That's the word there from Vaishali right now. Next query for today. KB Nagaraj is writing to us from Mumbai. He's holding 500 shares of Sri Renuka Sugar. Price is 50 rupees per share. He's holding one more stock that he's talking about is Birla Corp. 1,367 rupees is his buy price, 100 shares of that. What should they be doing with this right now? Shaina, hold, sell, what's the word on both these stocks, Birla Corp as well as Sri Renuka Sugar?
See, I would say it is better to exit from both the stocks. I'm not sure why he's purchased both these stocks. If he's purchased it with some potential M&A activity, which it seems to be likely for both Sri Renuka as well as for Birla Corp, then he can take the risk and hold it for the long term and wait for those situations to unfold. But otherwise, in terms of actual current, if that is not the aim, M&A activity in the long term, then I would think he should exit both these. See, Sri Renuka continues to make losses, though it is the largest manufacturer of ethanol in the country, and we are likely to see ethanol prices. The government may increase those prices. It's been in the discussion for, I think, almost 2 years. So that could be some bit of positive. But it is making losses. The balance sheet is under stress. The debt is high. So, Wilmar, which holds about 62% of the equity, may look to exit it. So the potential for M&A is there. But that all takes its own sweet time. So if you're going to hold it for that, then keep a watch for that. Otherwise, exit. Birla Corp, similarly, see, in terms of valuation, it is very attractive. It's got 20 million tons capacity of cement. And if you look at the average EV per ton, it's just about $70-$75. So to that extent, valuations are very attractive. It could be a M&A potential, but at the same time, I think in pure valuation, current numbers, it looks expensive. So there are better stocks available in the cement sector. Second half should be better. So I would say, both of these can be exited from.
Okay, both of this exit is the word on the fundamentals. On the technicals, Vaishali, what's your view? Because Sri Renuka Sugar, there's no stopping it, right? 1 year also, if I'm looking at it, it's just one side, and that's the downside for Sri Renuka Sugar in terms of a move. As well as in terms of Birla Corp also. Nothing exciting happening there as well. What are we watching out for here now?
Sure enough, so I agree with China because sugar is always a no. I mean, you don't see any momentum. And for the past few months, years, we have not seen anything happening in this sector at all. Chartically also, this doesn't show any hope right now. So Renuka Sugar is totally an exit. As far as Birla Corp is concerned, my only thing is that when I'm looking at the larger term horizon, like if I'm looking at the weekly chart and all, it's at a support level. And even the recent data, what I'm seeing, it's only in a deep oversold zone. So maybe you can see a bounce coming back towards 1200, 1250. That would be the level to exit. So now that he's already in such a low level, continue holding with 1100 as stop loss. And if you're lucky, you'll see a bounce back coming in. 1250 would be a good level to exit.
Okay, exit is the word on the fundamentals as well as the technical front. We just have some news update coming in. RBI to hold a press conference at 5 p.m. today. We'll watch out for the updates there as well. But yes, that's what we have at the bottom of the screens flashing for you all as of now. Keep an eye out on that. Let's move on then to the next query for today. We have K.R. Narayana, who's writing to us from Mysore. He's holding 300 shares of Aarti Industries. Price is 743 rupees per share. Also 40 shares of Deepak Nitrite at a price of 2,150 rupees per share. What should one be doing with both these stocks? And Aarti Industries, Deepak Nitrite, 1 year time period is what they're willing to hold on for, Shaina.
Yeah, so basically, specialty chemicals, while the expectation was that the sector will revive almost 2-3 quarters back, nothing like that happened. And we've seen the investors lost a lot of money. Now, after the steep correction for both of them, they both are like phenol-based specialty chemicals. I think current levels, it is better to continue to hold because now we are starting to see some bit of stability come back into the prices of specialty chemicals. And there seems to be at least second half could be better with exports picking up. I do hope like we don't have any negative news in terms of tariffs, etc. on agrochemicals, incremental tariffs or some additional problems coming in. I hope those issues are settled in the second half and we are likely to see exports pick up again and prices stabilize. So at current levels, I would give it a hold, both of them.
Okay, hold both of them right now, Aarti Industries as well as Deepak Nitrite on the fundamentals. On the technicals, what's your view, Vaishali?
Technicals, I feel Aarti is on a road to recovery because it's gradually showing higher bottom formation. It's in a rounding pattern. But of course, I would say keep a stop loss of 370 levels, because if these levels break, then that could go on for further erosion. So because chartically there is no strength seen right now. Only thing it is just showing some ray of hope that yes, this could be a bounce back. As far as Deepak Nitrite is concerned, it's continuing to make new lows. Even on a monthly chart, I'm seeing the trend is down. So I would be wary of holding this stock.
Okay. We'll keep an eye out on the levels over there for Deepak Nitrite as well as Aarti Industries. Let's move on to the next query. We have KS Rao, who's writing to us from Andhra Pradesh, holding 70 shares of Tata Capital, price is 330 rupees per share, wants to know the future prospects of the company. Tata Capital, what's the word coming from you, Shaina?
Yeah, so these are the IPO prices, the IPO listing price, and he's not really making any loss or any money on the stock as of now. I would say that, valuations, even the IPO, it's from a very good group and they have got a good AUM of, about 2.5 lakh crores. But I would say the current valuations are pretty expensive, even if you compare it to the peers. So I see a long period of consolidation before you can see any meaningful upside, especially if you're going to look at pure valuations. So, I'm neutral on the stock. If you're a very long-term investor, you can continue to hold. If you're going to look at valuations and, switch, then I would say it makes sense to just get out.
Okay. Keep an eye out on what Shaina mentioned. Depends on the time period also you're willing to hold. But, Vaishali, again, this is a company which has not got much in terms of charts and technicals, but any view that you have here or any thoughts on this one?
Well, I would say continue holding because, again, we've seen the stock making a low at around 316 and then giving a bit of a rise. Then once again getting into a consolidation. Today's candle again showing a buoyant move. So hold, take a calculated risk. Keep a stop loss of 325. 320 would be a good level to hold on. And that if there is a continuation in movement, this can go towards 350, 370. That is all the projection that I can see right now. So we can have a relook once it reaches 370 levels. But for now, hold with a stop loss of 320.
Okay. Keeping an eye out on the stop loss level there for Tata Capitals. Hold is the word on the technicals. Let's move on and actually take a very short break. After the break, we'll come back and we'll keep it going with the stock-related queries. Stay tuned in for that. Welcome back to your stocks on CNBC-TV18. As of now, we're seeing Nifty at 26,200 levels, down just 10 points in the trading session as of now. We'll keep an eye out on that. We have the Nifty Bank, which is also just managing to hold on to a slight bit of a gain at today's trading session of almost mild positive right now. Look at it from the day's highest point, it's come down significantly. When you look at it for the week though, right, Nifty is managed to, do some bit of a good. We'll keep an eye out on that. And for the week so far, the mid and small cap actually had managed to do well. Mid cap actually was doing better than the Nifty 50. So that will be interesting to watch out for that when it will happen at the end of the week as well. But let's move on and actually go across to Shireen, who is addressing the 98th FICCI annual meeting as well. Over to you, Shireen.
Past presidents, distinguished guests, ladies and gentlemen, a very good afternoon. It is an honor to welcome you all to this special session with the senior leadership of the Government of India. We are privileged to have with us Sri Rajesh Kumar Singh, Secretary, Ministry of Defence, Sri Devesh Chaturvedi, Secretary, Ministry of Agriculture and Farmers Welfare, Sri A.P. Das Joshi, Secretary, Ministry of Food Processing Industries, Sri Rajesh Agarwal, Secretary, Ministry of Commerce and Industry, Sri Amardeep Singh Bhatia, who will be joining us very soon, and our moderator, Ms. Shireen Bhan. Friends, India stands today at a defining moment in its economic journey. Across sectors from defense, electronics and automotive to pharmaceuticals and food processing, Make in India and Atmanirbhar Bharat are accelerating industrial transformation and job creation. Our achievement in digital public infrastructure have enhanced service delivery and financial inclusion at a scale unmatched globally, becoming a powerful platform for productivity and innovation. As we work towards the aspiration of a globally competitive and self-reliant India, it is crucial that government and industry continues to move forward together with clarity, ambition, and speed. The policy priorities we pursue today will shape India's trajectory for decades to come. In that context, today's session, from challenges to competitiveness, policy priorities for sustaining high growth, is both timely and important. We look forward to hearing from our esteemed secretaries who are at the forefront of shaping India's economic direction and to aligning industry efforts with national priorities. I now hand over to Ms. Shireen to begin this crucial dialogue. Thank you so much.
Very much. Good afternoon, ladies and gentlemen. Thank you very much for joining us here this afternoon. It is a privilege and an honor to be back here at the FICCI Annual General Meeting. I've always had the privilege of being able to host a show with the whole of government, all the secretaries representing the government of India, and it is an honor to be back here to do exactly the same. I won't go through the introductions again because you already know who I'm going to be speaking to. As was articulated at the start of the program, the idea really is to delve into each sector, to ask each secretary what the year has shaped up to be, but more importantly, what the outlook is as we look at 2026 and beyond. If I were to do a dipstick survey here in the room, I think the number one question that everybody wants an answer to is, when will the India-US BTA happen? And I know all fingers on this panel will point in one direction towards Mr. Rajesh Agarwal, Commerce Secretary. That's just one of the issues that we intend to talk about here this afternoon. We've got an eminent set of guests. So without further ado, ladies and gentlemen, because there's plenty to talk about, let's get started. Mr. Agarwal, the very first question to you, as I said, the number one question that everyone's asking today is, the expectation was that by the end of November, by fall, we would have an inking, a signing of the India-US BTA. Where are things currently on that front, Mr. Agarwal?
Hello. Yeah, thank you, Shireen. I think there was a commitment to see that the first tranche of India-US BTA is completed by fall of this 2025. However, things have changed and moved a lot from 13th February onwards. When we got into a BTA negotiations, we were on the path to deliver a good aspirational first tranche by the fall of 2025. But in between, we have found a lot of changes in the global trade landscape. One of the key has been in the US landscape where we came out with reciprocal tariffs, tariffs which were imposed on all the trading partners in order to see that the trade deficit with the trading partners can be evened out, and also maybe overall create a revenue stream for the government of United States. So with that new change in the overall landscape, the BTA has also gone through some articulation, some changes, wherein right now we are engaged with not only negotiating a bilateral trade agreement, which definitely with a country like United States will take a lot of time, because trade agreements are very wide-ranging agreements these days with a lot of issues, not only market access issues, which are negotiated under the umbrella, but at the same time, we are also engaged in a protracted negotiations on a framework trade deal, which will try to address the reciprocal tariff challenge that the Indian exporters today face. So these are two separate parallel negotiations going on, but one will feed into the other. What needs to come first is the framework trade deal, which is able to address the reciprocal tariffs. We have engaged on it for last few months very deeply with the US teams, and I think all I can say that we are close. We have tried to iron out most of the issues. Now it is only a matter of time when this decision has to be taken, that when the two countries have to find the right landing zone to announce the deal. So that is where we stand as of now. Thank you.
Some clarity, sir, on where things currently stand as far as the negotiations with the US are concerned. And it's important that you've highlighted for us that there are two parallel negotiations underway. One, of course, is for the bilateral trade agreement, and the other is to deal with the reciprocal tariffs, the framework that you spoke of. Is the hope that the framework to address the reciprocal tariffs will perhaps be done in this calendar year, sir? Is that the expectation? Is that the hope that you're working with? And have the outstanding issues, especially when it comes to market access, when it comes to the US's concerns on India buying from Russia and so on and so forth, does the US now feel that India has addressed some of those concerns that they raised?
I think our expectations, we are very optimistic and very hopeful that we should find a solution within this calendar year. But as you know, with any trade negotiations, the final deadlines cannot be, because even if there is one sticking point or one sticking issue which is in the mind of even one of the partners, the trade deal may not meet that deadline. Having said that, I think the overall position is well set to deliver it in next few weeks or months as soon as we can. But let's see, it's a call that will have to be taken at multiple levels. At the levels of negotiator, I think we are in a zone where we can say it is something that we can achieve in a very short while of time. There's not much to negotiate. There are very few issues, and that can be taken. The political call needs to be taken on some of them. And having said that, also as a country, we have always stood for our own sensitivities and our own uniqueness. So there are areas which are non-negotiables from our perspective. And that I think people, the countries which have negotiated deals with us are very clear that what are the things that India is not open to negotiate or not able to commit or bring to the table because of our unique nature of our economy, the way we are poised and the sensitivities that we do have in our economy. So those remain negotiable, whether it is any agreement, including the one with United States. Thank you.
You know, Commerce Secretary, I know that we cannot speculate beyond a point on the timing itself, but I just want to understand on the framework per se. As and when there is an understanding on both sides to go through with it, would that automatically mean that there would be a reversal of the 50% tariffs that have been imposed on India?
The assumption is that a trade deal will be beneficial for Indian exports only when there will be addressal of both 25% tariffs, not only the one which is a trade tariff which has been imposed on trade in lieu of the lack of trade deal, but also the other 25% tariff which have been imposed for some other geopolitical reasons. Until unless both are addressed together, it will not mean a meaningful deal for India. So we understand whenever the deal is finalized and signed and agreed to by the both sides, I think both these 25% will stand.
Are talks still on, sir, or have talks concluded?
The talks are still on, and it is because these are two negotiations also. There's a larger one also which is going on. So talks are on. Our teams are engaging virtually on a regular basis. There are virtual sessions every week on some issue or other. So there is an
Are you going to be
engagement.
visiting the US anytime soon, or are they going to be visiting us anytime soon?
Let's wait for some time. You may see the visits can happen either way. Whether we visit them or they visit us. They were in pretty lockdown for some time, 45 days or so. Now they are out of lockdown. So we expect some visits from their side also in the near future.
So on the BTA, sir, and I don't want to make this just about the US, but one final question on this before I get the other secretaries back, and then I'll come back to you. But on the BTA, are negotiations done and negotiations still underway, even as far as the BTA is concerned? And what's the broad timeline for the BTA? Because this is separate from the BTA.
I think BTA will take some time. It's quite an expansive. BTA is like a free trade agreement, and it will take a lot of time. And especially with the change dynamics, where you have got reciprocal tariffs in the play, which are beyond the MFN tariffs that each country do have. I think we'll need to find pathway for complete elimination of reciprocal tariff in our process of doing BTA. So I think that will take a bit of time, and we'll not hurry up those. We are working on various aspects of BTA, but let the first one come first, and then we'll see what are the timelines that we put for the BTA. Thank you.
Okay, that's a very, very clear comment coming in from the Commerce Secretary. BTA is likely to take longer. What the government is hoping for is to get the framework in place, a package, so to speak, to address the issue of reciprocal tariffs. And the hope is that you'll get that done in a second. But Agriculture Secretary, let me come to you, sir. And of course, part of that non-negotiable list that he's dealing with also involves the agriculture sector. But let's talk about what the year has shaped up to be for the sector. We've had rains, we've had floods, and that has impacted both yield as well as crop productivity. The year gone by, but more importantly, the year ahead. What's your sense on agri-growth?
So, as you must have read in the newspapers that the 24-25 final estimates were released. And the special feature of those release was that there's a bumper harvest of food grains, bumper harvest of oil seeds, and bumper harvest of horticulture in 24-25, which was obviously supported by a good monsoon, but also because of the fact that a lot of research has gone to the land in terms of better seeds, better infrastructure, availability of inputs. In 25-26, of course, overall the monsoon was very good. It was above normal. There were very few areas of deficit, but there were some areas of excess rainfall and also floods. And we know that there were many states where the floods were quite devastating in some areas. So that has sort of reduced the quality of produced and also productivity in those particular areas. But overall, the coverage has been okay. And what we expect is because of the fact that now the reservoirs are full, there's a good moisture in the soil because of heavy rains. The Rabi is progressing very satisfactorily, and whatever little bit dip which would have caused because of floods and other sorts of disasters in Kharif or the monsoon season will be more than offset in Rabi, and we will have good crop overall in the country. And that is also being reflected in the way inflation is moving, especially the food inflation, which is now more or less stable, very stable, and at times it becomes negative also.
Yes, we have seen that happen. So you don't anticipate any spike as far as food inflation is concerned?
Not at least in the next 6 months, we can predict that.
Not over the next 6 months, and that's good to hear. We've got the budget coming up, sir, and I think everybody's sending in their wish list to the Finance Ministry and to the Finance Minister. What is yours?
See, I can only say that one of the biggest wish list of the Agriculture Ministry and the stakeholders of agriculture was the GST, which was not, of course, part of the budget, but it was a part of the reform process. And the way the GST reforms which were announced and implemented last 2 months ago, they have really changed the way agriculture is now, inputs are being now procured by farmers. The reduction has been, the good thing was that this reduction in GST in micro irrigation, mechanization has been passed on to the consumer. And therefore, we are seeing a boost in the demand for mechanization and for other products, and which will help the agriculture sector in the long run.
So growth estimates for the agriculture
yes,
sector?
we can say the growth of these sectors will be high because of increased consumption led by the of course, the general prosperity, the surplus incomes which will be available, and also the reduction in prices of these commodities or these implements and equipments.
I'll come back to you for more specifics in just a second, but let me get the Defense Secretary into the conversation. Sir, thanks very much for joining us. While we're dealing with the US, we're also having to deal with Russia, and that's part, I would imagine, of the dialogue and discussion that you're going to have next week. President Putin is going to be here. The expectation is, will India further deepen its bilateral arrangement in the defense sector with Russia? Let me start by addressing that issue with you. Should we expect any announcements, any deals between India and Russia on the defense side?
Even if there were, I'm not going to announce them here. So nice try. But as you know, Shireen, we have a lot of legacy equipment from the Russians, and maintenance and support. And even there are also some orders like the S-400s where they've been delivered partly. So obviously all of that will be on the table. In terms of new announcements, I will not be able to sort of mention those, but our defense cooperation with Russia is of long standing. They've been our friends through both fair and foul weather, and we are not going to sort of stop our defense cooperation with them anytime soon. But I do want to stress that India follows a policy of strategic autonomy. Items that we need from the Russians, we will, of course, buy, and to the extent possible, not only buy, but also make in India. From the Americans also, there are certain specific types of equipment that we need. And over the last 10 years or so, we've done almost $30 billion worth of purchases from the US as well. So we are diversifying our equipment suppliers. But more than anything else, we are trying to ensure that we increasingly do spend the bulk of our money within the country. Last year, out of 2 lakh crores of contract signings that we did, 1.33 lakh crores, almost 88% was with domestic suppliers, both PSUs and private. That trend will continue. It will never go below 75%. Big global buys will be there, but they will be exceptions rather than the norm.
Well, several things there that I want to pick up on and get specifics from you. Let me start with the indigenization program, because as you pointed out, it will continue to be something that you prioritize and will be part of the government's efforts going forward as well. When can we expect the next list as far as indigenization is concerned, sir?
So the positive indigenization list that we currently have on has about 509 odd items, out of which about 50% of those have been indigenized. The next one will be out shortly from the Department of Military Affairs. In general, the intent is to, depending on the TRL level, you try to do entirely within India, the production and the design. In certain cases, you will rely on technology transfers and then make in India. And there will be some rare cases where you will do either imports or you do a small chunk of purchase from outside, as we did for the C-295s, and at least assemble or produce the rest of them in India. These are the three broad categories on which we'll work. But as I said, 3/4, 75% of that will be almost entirely make in India.
So since we're talking about make in India, and I want to understand from you whether we should expect joint manufacturing, especially in the context of the India-US defense partnership, in terms of that partnership deepening. Is that an expectation that we should have, that there could be joint manufacturing? That's an expectation on some, for instance, for the S-400, even when we talk about Russia. Are these realistic expectations to have?
So far, the bulk of our production in the past has been what we call licensed production, which is largely from Russian OEMs. Most recently, we've got one production ongoing where the final assembly line of the C-295 military transport aircraft is being done within the country, Airbus and Tata's together. With the Americans, largely we've relied on imports. In certain cases, for example, for the light combat aircraft, we've taken the engines from the General Electric. With the Americans, I would imagine the chances are of initially getting them in through MROs and then thereafter perhaps moving into production. In other areas, we will probably do with other suppliers like the French and the Russians. I see more chances of doing co-production, joint ventures, etc. But in general, as I said, foreign OEMs will have to get used to the fact that most of our money will be spent within the country, and if they want to get a share of that pie, they will have to do joint ventures here and co-produce here.
And co-produce here, but unlikely to be the case when we talk about the US specifically. I'll come to you, sir, in just a second, but I want to come back to the Commerce Secretary just to pick up on what we heard there from the Defense Secretary. Sir, you know, defense and the kind of arrangement, agreement, deals that are likely to happen between India and the US, how much are all of these aspects weighing on this framework that you're currently negotiating? How much of what is happening in the oil ministry by way of that CNG contract, which is a historic first between India and the US, weighing on this framework to address the reciprocal tariff?
I think...
Go ahead, sir.
Hello. Yeah, I think India-US relationship, if you look at over last 2 decades, it has only gone strength by strength. So our relationship is across in all economic sectors, whether it's defense, energy, trade. We are there, people to people connect, the diaspora. I think the overall strength that this relationship has got over last 2 decades is all going to weigh in this relationship. And that's why you will find that in spite of the fact that India and US has not been able to strike a deal, which was expected early on, till now.
Which is expected to be the first deal.
Yeah, but still, you will see the trade between the 2 countries have not gone down. Still, if you look at our trade, our exports to US, we are still, this calendar year, $10 billion up than last year. So we're still doing better. I think there's a lot of positivity between our businesses on both sides. Still there, you're seeing a lot of positive movements on all other aspects of economic engagement. Because there is a lot of synergy, there's a lot of positive energy in this relationship. The deal has not happened, that's a fact. But outside that, I think a lot of things are happening, which will all weigh down on this relationship, because any relationship or any aspect or any work need not be seen in an isolation, but they whole form a part of the entire relationship that India and US form. So whatever we are doing together, I think this will all be part of the entire relationship that we see 20 years down the line. That is how we look at it. Deal may not have those aspects as such. They will not be negotiated as a part of the framework deal. But these all things, I think, goes on to say that this is one deal that world needs, India, US need to have together.
Yes, so directionally and intentionally, you're making India's position clear in terms of where we could perhaps move forward. Let's understand what's happening as the food processing side, sir. One of the successful PLI schemes under your ministry. What's the expectation now, given the experience that you've had with the PLI scheme? Should we expect another incentive scheme? Is that necessary or warranted today?
Thank you very much. So far as PLI you have asked, food processing sector has done fairly well in the PLI on any account, whether we see the investment or the growth or the export or the employment. So on all the fronts, we have done very well, and we will be very happy. In fact, we are working on it, whether we can have, the next round of PLI for the food processing at least, or for the sectors where we have done well in the PLI.
So that's a demand that you would like to put forward, that you believe that there is a need, a requirement for a second PLI scheme?
I feel that there is a demand, because if we see the first round of PLI, we could not cover the, different sectors. So there are few sectors which are left out. There are few, companies or few verticals which were left out. So we feel that there is a need, and we will articulate our demand and put it across.
Okay.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, it's a late start to closing bell. 45 minutes to go to wrap up this Friday's session and the week, and it's absolutely flat. Markets have come off a tad bit from the day's high. The Sensex has lost about 200 points plus from the intraday peak. The Nifty is flat, hovering around the 26,200. But guys, this is the week where we can still celebrate that we hit all-time high levels, and week to date, we're still up a little more than 0.5% on the Nifty, and Midcaps have actually fared a little better.
It's quiet. Celebration would have been better if we had managed to, retain at least a morning high, some momentum. But it's kind of fizzled out. But I think overall as well, because of the, truncated working hours in the US, because of the Thanksgiving holiday, I think we'll have more clarity when the new week settles in. For now, the bulls will have to just deal with the fact that they did reach that all-time high, but the conviction, second day running, it's missing for now.
And the key data point to watch will be 4 o'clock, the Q2 India GDP print. And Lata tells us it's going to be a good number. 7.4 versus 7.8%, which was an eye-popping number in Q1. So immediately after markets close, we'll train our eyes for that.
Absolutely. We'll be into the weekend by then as well. But markets will react on Monday morning. Well, let's find out how do you position yourself in the final hour of trade. Mitesh Thakkar from Bonanza Portfolio is joining us with those closing strategies. Hi, Mitesh. Good to have you back on the show. What's the call then on the Nifty? I mean, as range as it can be, right? Flat as ever. What do you do, Nifty Bank?
That's right, Nigel. I think very narrow range today. It's an inside day to previous day, which itself was a narrow day. So very clearly, very compressed kind of an activity. And I think this can happen. Typically, this is a market which is trying to break into all-time highs. It's right below the earlier pivot. And that that firm decision making is still pending. That whether I want to go ahead or whether I want to come back, give a pullback, and then gather more strength and then go up. So for the timing, I think avoid the index, and that's what I've been advocating since yesterday. On the stock side, I have one buy and one sell right now. I would recommend a buy on LTIM, which is Mindtree, Larsen Toubro Mindtree, with a stop at 60.49 for targets of 61.75. And Oil India was a sell yesterday and today morning. I think now ONGC is also correcting. That's a sell with a stop at 247.25 for targets of 235.
Let's get to one of the big stocks today, and that is GAIL. The stock is still lower by close to about 4-5%. Let's pull up that intraday chart. This is after PNGRB approved the revision order for the company's transmission tariff. But what's disappointed the street is that the 12% increase is much lower than what the company was hoping for and what the investors had penciled in. We chatted with PNGRB and the management of GAIL earlier. First, let's listen in to what they had to say.
We have concluded the tariff interim in between the 5 years also. So next hike will be from 1st April 2028. So where we'll do up everything. It is clearly mentioned in the tariff order that next revision will be effective from 1st April 2028, wherein we'll all do up all the factors, capex, opex, relief, everything we will give.
Normally, whenever PNGRB processes the tariff, they moderate certain future capital expenditure and operating expenditure and true up in next revision. So we were expecting the tariff based on those revisions should be 70-72 rupees, but it has come down to 65 rupees, 69 rupees. There is a gap from our expectations of around 5-6 rupees. And since we are yet to go through the tariff order, we'll see what are those parameters based on which tariff has been moderated, and certainly if we feel that there are issues, we'll certainly take up suitably. We do not have any choice in terms of regulation. We have to apply the tariff approved by PNGRB on non-discriminatory basis to every customer.
Okay, that was a big story of the day. The stock hasn't recovered because, well, to sum it up, they were asking for a 33% increase. The market was hoping at least 20% will be given. But what's actually come through is 12%, and that disappointment is still playing out on the GAIL stock. Gurmeet Chadha of Complete Circle is with us. Gurmeet, lots of stocks to discuss with you as always. GAIL Now, we know that there is another tariff, sort of consideration that will happen in FY28. What do you make of things and what's the call?
So we in general stayed away. So we both from GAIL as well as the city gas distributor because of these frequent changes in which may come due to regulatory guidelines. Same is the case for OMCs. You never know what is coming next. So at best you can take a trading call. And in a market like this, it's not ready for any negative surprises. The reaction is extreme. One space we did like and made some money was refiners, pure refiners, not marketing, where we got into Chennai Petroleum at about 600 when, the market cap was 9,000 crores and it was available at like 1/3 the replacement cost. So was very, very cheap. And we saw diesel cracks going up, Singapore refining margins picking up, and then we exited, a couple of weeks back. So you can take trading calls as best, as I rightly said, and refining capacity also globally is very, very short. So other than that, we tend to stay away from most of these PSU names where there is always an overhang of government intervening.
Okay. So staying away from GAIL, let's move on. Some other interesting stocks to track today. Paytm is an interesting one, and that's because of a brokerage view that's come in. It was actually something that Nimesh highlighted. It was our standout brokerage of the morning. Goldman Sachs is sounding quite optimistic on Paytm. Stocks up about 2.5%. Let's see do we have Nimesh? Okay, we'll get to Nimesh in just a bit. But Goldman is saying that it believes that the regulatory environment is getting incrementally positive for Paytm. And now we know that the RBI has allowed Paytm to go on and, start onboarding merchants again. Gurmeet, what's the sense? Do you think this time around it's going to be different for Paytm? Can it be a value creator?
So, we have Paytm in our portfolio. This along with Eternal is something we've been invested for some time now. I think incrementally they have been more focused now on largely the payment and lending business. I think they were trying to do too many things with Paytm Mall, etc. I think they're getting back to core, and RBI allowing new onboarding is welcome. I think we'll probably give more fillip in terms of onboarding more merchants. They've done a terrific job on some innovations they have done, especially the sound machine, etc. Lending also seems to be doing well. They've learned their lessons even on lending in terms of what to do, what not to do. And I think even on the payment side, I think there's some incremental share in market share. So I think it's looking good for them. And I think at some point of time, the UPI will also be monetized. May not be done immediately, but at some point of time, it will start with something very minute. Can't run on free forever. So that's something we have in the portfolio. But the weightage is around 2% in the portfolio.
Yeah. I mean, UPI, speaking of UPI monetization, I always feel this. If the National Payment Corporation of India was a listed entity, perhaps we could have had our own giant, right? Maybe not to rival NVIDIA, but yeah, payments is India's big thing. It's public infrastructure, public digital infrastructure, so we don't have it listed in the market. But anyway, it's an important technology, as we all very well know. Gurmeet, just stay on. So Gurmeet already has Paytm, but let's go back and understand why Goldman Sachs is calling this out as an important stock to watch. Nimesh, this was your standout brokerage. So what's Goldman's thesis here?
Yes, sir, Biswana, they've put out some interesting highlights and interesting observations on why they've upgraded the stock to a buy now. The first reason is the regulatory environment. That was a big drag for the stock for the last couple of months and quarters and years. That is incrementally now changing and turning for the better. That's the key headline from the Goldman note. Now, this will mean that there is going to be early signs of recovery in the Paytm's payments business as well as the earnings visibility. So, on back of that, Goldman expects that the 20% plus revenue growth is quite achievable in the foreseeable future as far as Paytm is concerned. Additionally, there could be more positive, upsides in terms of earnings upgrades, as well as, if there are more regulatory interventions on the positive side, as far as the payments business is concerned, largely on the MDR. If there is something on that, that is going to be incrementally positive, and that will also mean that, not only that, but there could be more upside from the market share gain as well. That's the key thesis on which they've upgraded the stock. In fact, Goldman believes that the EBITDA margin can double in the next 3 to 4 years for Paytm, and at this price, the risk reward is quite favorable. So it's a big upgrade to a buy, but the stock price they've raised all the way from 705 to the new target of 1570. So it's a big target upside, but even from current levels, it's a potential 20% upside as far as the Goldman note is concerned.
Thank you very much for that, Nimesh. Lenskart is the other one doing very well in the consumer tech platform companies. This is on the back of a Jefferies bullish note where the target price is set at 500 rupees. And the stock, contrary to, during the time of the IPO where everyone was concerned about the valuation, is actually held up. The IPO price, issue price, was about 402 and Lenskart is still at 412. But we'll wait by to see what the numbers throw up. Earnings are tomorrow and plus the 1 month lock-in is still to come in. That's Lenskart for you. We will slip into a break. We'll thank Gurmeet for joining in. On the other side, we'll invite Rashi Talwar Bhatia of Ashmore. Stay with us.
Welcome back. Absolutely flat market. Let's see what's happening on the F&O side. Nigel, any movement there?
Well, if you look at the Nifty is as flat as can be, and the VIX is well behaved. You like that, right? We don't want the VIX to spike up. So the VIX is well behaved even on days when the markets are lower. The other data point that we track is the Nifty PCR. The last I checked, it was at around 1.1, and Surabhi's confirmed that as well. So that's pretty okay. That's in the more or less in the middle of the range. You don't want it to dance away to around 1.5 like we saw a few trading sessions ago. But the options data suggesting today is yet another day for the writers. Because if you're writing calls or you're writing puts, you're making money. Just pull up a couple of strikes. The 26,200 put, well, fair bit of writing is what we're seeing out there. The premium has come down. At the start of today, I think it was closer to 90 rupees, came down to around 72 rupees. And if you look at the 26,250 callers, well, the premium out there as well has come down from around that 105 rupees to around 84 rupees or thereabouts. So there's writing on both sides telling you that the bulls and the bears, there's a bit of a tussle going out there. but they believe that in the near term, we could be in the bit of a range. What that could be, 26,000 on the downside, and on the upside, around 26,000, 26,400 or thereabouts, just going by the options data, because there is some call writing as well at around 26,300. Moving to individual stocks then, that are in focus in today's trading session. Lotus Labs. The street is waiting for a large trade. I'm not sure whether or not that's going to happen or when that's going to happen. The timing is important out there. So there were shorts. Today, we are seeing some of those shorts getting covered out, and the stock has bounced up in trade as well. So Lotus Labs is one particular name. Next up, you pull up GAIL. There's big shorting out there. The stock is down 4.5%, and the opening is built up is massive. But as we said earlier today, when the markets opened up itself, I said that around 170 rupees, that's an important support. And, Mitesh had said it around 171, 172. If that can get defended, then maybe the stock bounces back from there. So there are fresh shots on the system. Varun Beverages, from the word go itself, you're seeing a lot of fresh buying on that counter. And that's an active counter, otherwise not very, very active, but a good amount of open interest built up on that particular name as well. Net, the Nifty, it looks like we are bracing ourselves for a better December as well, because that 20-day MA is deep, sub the 26,000 odd mark. So you'll have to go with a bit of a bullish bias for looking at the data points. Back to you guys.
Thank you. For that, Rashi Talwar Bhatia, partner and portfolio manager Ashmore, is now joining in on the show. Rashi, thank you very much for joining in. So how has 2025 been for Ashmore? What were your big calls, the big winners, where you went wrong with the positions that you've held? And looking ahead to 2026, how will you position your portfolio? What changes, what themes are you looking at?
Yeah, so, 2025 is not over. December is still to go. And I've been here long enough to see many such years where December can change things dramatically. So I'm just hoping for a very stable December with no major upheaval. I think in terms of, for us, it's been a decent year. I cannot complain. And I think that's part to do with the fact that early on this year, we took a view that the domestic consumption financials were going to be a beneficiary. And when I say domestic consumption, I mean more on the discretionary side, because early on in February, it was pretty clear that the government was focused on, improving liquidity and supporting growth. And if you look at February to pretty much till the last GST cut, we've seen something come in either from RBI or from the government every month or so. And I think we're starting to see the domestic consumer that had got stuck somewhere towards the end of 2024 because of the evaporation of liquidity or RBI sucking out the liquidity, now coming to back into form. So I think that's kind of helped. And, it's interesting because if you look at, we're back to, say, September 24 highs, but as everybody said, the market is flat over September 24, give or take a few. But if you look at actually sectoral moves within the market, they've been pretty sharp and they've been pretty, large, so to speak. And that's the interesting part.
Indeed, it's not been a uniform kind of an up move. We've had quite a few winners in individual stocks, like an M&M has done so well, Bharti has done well, IT has dragged its feet. But according to you, for 2026, or looking ahead now, what would be the top 3 themes? And again, what would you be overweight sectorally? And what would you be underweight?
So I would, as of right now, continue to focus on the domestic consumption, consumer discretionary name, and some of the financial names, the larger private sector banks. I think these guys are going to be the biggest beneficiary of the liquidity influx that we're continuing to see. And it's just the starting point. We've just started to see data of literally 1 month. And I think what the point people are missing is that November and December, we saw collapse in discretionary demand, autos, etc. And when we come in at a reasonable number, this November and December, we'll start to see data tomorrow. The base is so affected that the numbers will look good. So I think from that perspective, we are positioned for that. That's how we're positioned. IT is an interesting one, and we're constantly reevaluating that because we had a reasonably large underweight for most of the year. And valuations have started to look attractive. It has corrected, and the dollar or the rupee has weakened per se, but we're still not able to find complete conviction or stories that we like over there. So therefore, we are watching it and looking at it carefully, but we haven't jumped in as yet.
So, Rashi, if you had to tell us, your top pick would be what? The private banks?
And discretionary consumption.
Both those two?
Yeah, that would be, it would be the large private sector banks. When I say discretionary consumption, I would also go with the two-wheelers, the incumbents. We've seen one do well, but one has still lagged.
Which one you like? The big boy, the Thump, the big Royal Enfield, or the one that has bigger export exposure, or the one that's more rural focused?
Yes, you can go with any. I'm telling you, from a discretionary side, all of them will benefit. The rising tide will lift all boats. You can decide which one you like based on valuations, or based on the growth, or based on which product profile you.
But two-wheelers is something you like.
Two-wheelers is generally, yeah.
What about auto ancillaries? Some of those stocks out there, the PE has expanded quite a bit, and quite a few auto ancillaries, which I don't want to name because I don't want to be biased to any of them, but a few of them, they're looking quite good. And Street is bracing for a very good third quarter for the auto ancillary stocks itself. Are you playing that theme?
The joker in the pack is what happens to the US. I'm not sure. And a lot of the ancillary plays have large dependencies on the Western markets, Europe and US. And I am praying for a reasonably soft landing in terms of what we're seeing. But it's the same. I cannot be bearish on IT because US budgets are not getting finalized. Even IT companies that are delivering good quarter numbers in the existing quarter do not have an outlook for the future. They themselves are not able to see it, and expect auto ancillary companies that are in the supply chain of supplying to the companies in the same geography are going to be thriving, right?
What about consumer tech names, Rashi? A Lenskart, an Urban Company, Pine Labs, Grow. These are across sectors, but everyone agrees the potential is large, the earnings growth is strong. And if history is anything to go by, we've seen a Zomato and Swiggy also deliver on the leverage that comes in via scale. So where do you stand on some of these recent listings? Are they a part of your portfolio, the four that I named?
We don't generally talk about what is part of the portfolio and what is not. In general, we tend to be a little circumspect when it comes to IPOs. And that happens because we've not met the management enough, that we haven't seen quarterly numbers come out. We haven't seen, the regular set of information that we get for a lot of the other companies is not there when we're evaluating IPOs. So we tend to be a little more circumspect and stay away from IPOs for a bit. And we always meet management whenever we are offered those meetings, but are very clear that we take our time, because I like to see management 3-4 times before I can get a sense of who's optimistic, who's pessimistic, and judge even their demeanor when it comes to talking to investors. So I think the opportunities and all the names that you mentioned will come up at some point of time for us over the next few quarters.
Rashi, thank you very much for joining in. Just counting down to the close, still flat for the market. So let's find out what the mood is across dealing rooms. Nimesh is now joining in to give us some insight. Nimesh, after hitting all highs yesterday, at least in the first half, markets have gone quiet and consolidating.
Well, Rima, it looks like it's a Friday mood, right? Absolutely flat on the Nifty. There is really no momentum, especially in the broader markets. It's like, the momentum is really lost in the last many weeks. And even from a flow perspective today, there is a bit of selling as well, is what I understand. So FIs are slightly better sellers across the broader names. The sector which stands out today is metals. The index is up 1%, and some bit of traction seems to be clearly there in the metal names. In fact, there was an HSBC upgrade as well in those aluminum stocks. So a bit of momentum clearly visible in the metal names today. And from a flow perspective, selectively the financial stands out. Whether it's private banks or smaller private banks or NBFCs, rotationally there is a bit of buying flows into the financial space. So that stands out from a flow perspective, but absolutely flat in the Nifty. and zero momentum in the broader market names.
What about stocks?
Well, so the first stock on my list is Yatharth Hospital. The stock is down 8% after a large block. 7% equity got changed hands. I understand the promoter entity was a seller in today's block. Well, half or maybe part of the block was bought by the domestic mutual funds, but need to see the disclosures. But from a sell perspective, looks like the promoters have sold today, and that stock is under pressure. The second name is Motilal Oswal. Again, the stock has recovered in today's market, essentially because I understand the selling pressure from a leading FII fund is largely over. Remember, I've been highlighting that there are at least 38 stocks where one fund has to sell out because of the merger. So part of that selling seems to be over in today's market in Motilal Oswal. The third name is Laurus Labs and Lodab. Both are buzzing in trade, essentially on the back of buy flows. I understand one leading HNI investor has been actively buying into Laurus as well as in Loda. So that explains the move there. And the last one is IFL Capital. Every now and then there is the sense of some deal brewing and might get announced very soon. Remember, we actually reported a deal a month back about a private equity. It looks like the deal could be around the corner, and that's the reason why that stock is also up 5% in today's market.
Okay, all right. Thanks very much for that, Nimesh. He'll take a quick break on that note. Come back and then we'll have some of the final trading calls for today.
Welcome back. Let's get in, Mitesh, to find out if there are any last 15-minute trades. Mitesh?
Yeah. So, with the index not being very decisive, I think, some mild trades can be taken on the stock side, and I have one STVT and one BTST. So STVT on Astral, I think that's down about 2% closing in the day's low. So keep a stop at about 1451, 1452, look for a 1420, 1415 kind of a target on the downside for tomorrow. And on the buying side is Britannia. Now, the structure isn't good over here, but if you look at the last 1.5 months history, I think 58, 10, 20 has been an area where the stock has taken support at least on 9 or 10 occasions. So it's bouncing back from there. So we'll keep a stop at 58.30 or just below it, and a target of 58.85 can be looked at for tomorrow.
Okay, all right, Mitesh, we'll leave it on that note. Thank you very much for being with us through the week. You enjoy your weekend, and see you with the market again on Monday. Some comments coming in from the Commerce Secretary on the US-India bilateral trade agreement. The presumption is that the trade deal will be beneficial for both if the tariff is set at 25. Both reciprocal and additional tariffs will have to be addressed. So this is the Commerce Minister speaking, giving us the latest updates on this, optimistic on finding a solution with respect to the BTA within this calendar year. That's interesting. That could definitely be, it's putting a timeline. I don't think we've actually seen a very definitive statement on a timeline just yet. He did allude to the fact that earlier it was supposed to be done by fall. And now he's saying that it could be done within this calendar year itself. So let's see. Let's pull up the Nifty and see if the market's taking note of these comments. Not quite. Nifty is still down about 15, 16 points. So those are hopeful comments coming in from the Commerce Secretary on the India-US.
But this is, you know, when you start high, right? At the start of the year, when India was, say, gunning for a favorable deal at 10%, if someone would have said you're going to get 25%, we would have said, no, 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 we want better. We want more. We want the best deal.
Yeah.
And now at the end of the year, after the negotiations have dragged on and you're sitting at 50% and peers are also at 20, 25%, if you say 20, well, it's a good 25, you say it's a good deal.
You take it.
You take it, right? So this is what happens, right? When Trump starts at 50%, then 25% seems palatable.
Yeah, but it's been a tough year.
It's been a tough year.
India has stood its ground, one of the very few countries which has. And the negotiations are still underway.
Hopefully last leg.
Hopefully it's the last leg. And as the Commerce Secretary is saying, hopefully it will be wrapped up before 2025 goes. But with that, let's move on and talk about auto sales, because when we come back on Monday, it'll be that time of the month when we figure out whether the auto sales numbers are still ticking high or not. Now, it's a tough ask, Sudarshan, right? Because we had this bumper Diwali, the GST cuts, and now the reality has to strike. How might that reality look?
But the good part is we are expecting another month of a strong growth by the auto companies. And do you know the biggest surprise will come from which segment? It's going to be commercial vehicle, because channel checks are suggesting a major surge in the demand for commercial vehicle segment. As far as passenger vehicle and two-wheelers are concerned, we are expecting a healthy growth here also, especially for two-wheelers. Now, the one positive factor is the number of marriage dates this year in November 2025 has been much more than what we saw in November of 2024. That also is likely to going to aid the growth. Now, considering all these factors, passenger vehicle is expected to report a growth of 21%. Two-wheelers may see a growth of 15%, while commercial vehicle growth might come as high as 20%. Now, talking about the expectations company-wise, in the two-wheeler space, the growth is expected to be in the range of 8 to 29%, with Bajaj Auto being the biggest underperformer, where company can report a growth of 8%. And the surprising part is this time the biggest outperformer is going to be Hero Moto along with Royal Enfield, that is Eicher Motor, and both these companies may see growth of 29% each, while for TVS Motor growth can be of 22%. Now coming to passenger vehicle segment, Maruti is going to see a growth in somewhere in the range of 16 to 17%. M&M, like as always, it's going to outperform the segment, may see a growth of 22%. Hyundai may see a growth of 7%, and Tata Motors passenger vehicle also may see a double-digit growth. Come to commercial vehicle segment, both Tata Motors commercial vehicle and Ashok Leyland are going to see a high double-digit growth, and that growth range can be of 16 to 17%. Another good part, the channel checks are suggesting that not only November, even the kind of growth that we are seeing, even December month can be very good.
Thank you very much for that. M&M continues to remain in pole position through the start of the trading session. Still going strong, 2% up. The street likes yesterday's announcement about the new launch. feature-loaded and very aggressive pricing at nearly 20 lakh. Anand Tandon is now joining in. Sudarshan, thank you very much for that. The other stock Sudarshan was looking at was SRF, where Axis Capital today has upgraded it to a buy. And they see the chemical business growing at 23% CAGR over FY25 to FY28. So if you're looking for stocks with earnings momentum where there is visibility, Axis believes SRF is one. Anand, have you studied this company?
Well, not recently, but yes, it has been a company which I have looked at in the past. And overall, I could argue that, the chemicals industry, except for certain parts, is actually, it had been somewhat subdued and is now coming back in terms of the volumes that they are pushing out. Many of the companies have gone through a capacity expansion, which has either already started or is likely to start in the next few months. So the specialty chemical space is something that could be interesting. There are, of course, pockets in commodity space which are going to be a bit challenging. For example, chloroalkali, where a couple of the very large players are now coming into the market, which can dent the profitability or sales of the existing players and so on. But SRF is reasonably well positioned.
Okay, all right. Stay on, Anand. We'll come back to you with more questions in just a bit, but we do have to take a very quick break. Back with the last leg of today's market action in just a moment.
Welcome back. Still very flat for the markets. The Nifty is just inching, hovering around the 26,200 mark. we've asked you a lot about IPOs in the past, the ones when they open, and you've always said that you're not a big fan of IPOs, especially once they open, they're priced to perfection, and so on and so forth. But generally wanting to get your views in if you've had a look at Meesho, and the other one is Physicswala, because they are catering to a TAM, which is what we call as Bharat, where it's the tier 3, tier 4 cities, and these companies are large. Like even Meesho, we were just chatting with the management, their revenues, are annualized are more than 10,000 crore rupees. It's loss-making right now, but how do you like companies where the ARR, the ARPUs, or the average order value is very low, and they're catering to the underserved market? What are your thoughts generally on the opportunity and the penetration here?
In most cases, the challenge is where are you going to be increasing the revenues from? Because if you are going to lose money, and Meesho is actually a very great execution story. They have tapped into a niche. I know people who work around me who are using this on a regular basis. So it is not, there is no question that they have done a fabulous job in terms of building that market. But that market is extremely price sensitive. So your ability to increase revenues does not come from being able to raise prices, but only from volume increases. And I would argue that much of that penetration is actually available already. You may be looking at numbers which seem to suggest that it's not highly penetrated, but that's because perhaps there is no market below this. So the question really is, what are you going to do to be able to increase the sales value, and how much more can you increase? Because even if you keep adding categories, the total pot of money available in the hands of their target customers is not very high. So the only other option is to actually reduce your procurement cost and find greater margins there, which again is a challenge because you are already dealing with businesses which are, probably pricing it to the lowest that they can. Net, it's a difficult market. At some stage, maybe it will break even. The question is, on a sustained basis, will you be able to make an ROE which makes sense? And I think it is still a little early to call that.
But Anand, there'll be a couple of ideas, right, that you like. Even in a market like this, which is looking expensive and earnings growth is not coming about, there'll be a couple of niches that you like, right? If you could name a couple of them.
Well, I don't think that you can make an argument for valuation anywhere. So the only question is, where are you finding sustainability? And I think that is actually easier to find in the larger companies. I mean, I think a Reliance or an NTPC or, the power sector, power grid, or even some of the, for example, the pharma companies, the large big ones which are doing, for example, CDMO, none of them are cheap. But with that said, they are still likely to be able to continue to grow in a difficult market. And more importantly, if you find a situation where we actually get a tariff trade, you will see some upside coming through in many of these, as much as perhaps the smaller ones. I think the argument that is being made in the market that we should be looking at the wider market, I find myself a little hesitant in accepting that.
So finally, before we let you go to enjoy the weekend, Anand, I mean, I was just discussing this while doing the weekly wrap as well, right? It's an all-time high, but one without broader participation. So tell us anything interesting that's come on your radar, any new company or stock that you would be studying, something, beyond the large cap screen, something in the mid-cap space worth looking at.
Like I just said, I would restrict myself to the large cap right now. There are always themes that one can be looking for, but broadly, I don't think that the Indian market leaves you any upside in terms of valuation. So you're only looking for earning from an order viewpoint and seeing where there is, and there is greater security in the bigger companies.
Okay, fair enough. So you've driven that point home. And that point has been well taken. Thank you for joining in. Slightly cautious view coming in from Anand Tandon there. Says that he will stick to large caps. And the large caps have done well after a long grind. This is a week that will be remembered for at least hitting that all-time high level. Though we've not built conviction, on that. That's been the grudge of the week, so to speak. Anyway, let's take a look at the final rates then. We've got an absolute flat closing this Friday afternoon. The Nifty is down about 6 odd points, 26,200 thereabouts. Ditto for the Sensex, 13 points up. Midcap index flat, Bank Nifty flat. Actually, everything is flat if you look at it today. In terms of the indices, there's been some buying on the auto space, and that's reflecting in the large cap names. So M&M 2% higher. There is Bajaj Auto, which is about 0.5% higher. Eicher Motors managed about a 0.6% gain. Other gainers of the day included Sun Pharma. There was Adani Enterprises up about 1%. Reliance provided some support, 0.5% up on Reliance as well, and as did Lever, Lever was up about 0.7%. But then let's see where the pressure came in from. Lots of financials, actually a lot of the non-banks, they've come in for some profit taking. So SBI Life and HDFC Life, both of these stocks are down between 1.5% to 2%. Shriram Finance has lost about 1.5%. Eternal is at 300. It's lost about 2-3% this week. There's Bharti Airtel, which has been down today about 1% or so. And IT. IT has had a great week, 1.5% for the week. It had a great month, almost 5-6% up for the month. But there was profit taking today as we got fresh commentary from the US president that sounds a bit worrisome on the whole immigration issue. So HCL Tech, Infosys, a lot of the large cap IT names, HCL Tech, all of them on the downside. Okay, let's see what really stood out in terms of the broader market. The index was flat, like I was saying, but there were individual names. Eureka Forbes, 8% up on this one. Wellspun Living, 11% up on Wellspun Living. The stock immediately reacted. You just heard the statements from the Commerce Secretary. Let's pull up the other ones as well. Gokuldas Exports, perhaps, and some of the other exporter stocks, because the Commerce Secretary has just indicated that maybe we'll see a deal before this year ends. And some of these stocks are reacting to that. LG Bala, 5% up. So these are some of the names on the upside. Bell has gone. On the losing side today, Gale, obviously, stock in news, down about 4%. MCX down about 3%. Wockhardt lost about 3.5% as well. So these were some of the names that really stood out. IEX is mired in all kinds of, legal complexities. Ends down 1% for the day. Well, the bell has gone, and that's where we take your leave on this edition of Closing Bell. Thank you very much for watching, but don't go anywhere because all the action continues. Up next is Editor's Roundtable.
The last trade gains for the third straight week amid a range-bound trade. The Sensex and Nifty did touch new record highs this week, but could not sustain the rally. Financials were the big gainers this week. The Nifty banking index gaining about 1.5%. Over the next 30 minutes, we'll decode the week's market action, put the spotlight on the broader market underperformance this year, and decode Misho's nearly 5,500 crore IPO that's set to open on 3rd of December. Hello and welcome to Editors Roundtable. I'm Reema Tendulkar. With me, Nigel, Nimesh and Prashant. And joining us here in the studio, in the newsroom, is Nimesh Chandan, CIO, Bajaj Finserv, AMC. Hi guys. You know, we got the headlines, right? Yes. All-time highs after 14 long months. But you just didn't get that feeling, like that bullish feeling, the momentum.
I'm getting that feeling looking at you. Yesterday was red, today is green. All Christmas.
All Christmas.
Christmassy colors. Huh? But I think, I mean, I was looking at the market today. I was doing some stuff for CNBC-TV18 Access. Yeah. So not on the regular shows, but it's a draggy kind of a day. Huh? Yeah. Absolutely draggy kind of a day. Nothing at all.
Absolutely flat on the index, Nifty, small cap, really no momentum. The only momentum seems to be that promoters come, they sell, the FIs come, they sell. That's been the big trend.
There is
and IPO action continues.
Yeah, and the IPO action continues. So I think that's been the two common trend, IPOs and promoter selling.
You guys have seen that meme on social media? It's a famous meme and people use it for all kinds of things. Nimesh, I just thought of it. Nimesh said, every day FIs come and sell, every day IPOs come and sell. तो क्या है? रोज सुबह उठो और क्या? पैसा जाता है और सो जाओ, something like that, right? But I don't know if it's been that bad. Actually, the week, how
we're up about 0.5%
I think let's just wrap up, the action, and then we go across to Nimesh and ask what's going on. So basically, all-time highs. Portfolios not feeling like that. Small cap index close to 10% away, and individual stocks down 40, 50, 60% or thereabouts. The supply of paper continues, and a lot of large IPOs, that's what's sucking out liquidity. So one argument is that the domestic liquidity is picking up, which is very, very good. Everyone's doing a good job. The other argument is, what's the use? The promoters are taking away the money. You're left with the dream, and they are left with the money. And you could argue that some of that money comes back, but the kind of supply of paper, that's something that's a little bit worrying, both in the secondary as well as in the primary market as well. The FI selling, well, that's toned down a little bit. I recall a couple of months ago in September, August, we did see a lot of selling out there. So they continue to remain sellers, but the pace of selling actually has toned down, and on days they turn mild buyers as well, though they continue to remain net short around 80, 81% or thereabouts, which isn't such a bad thing. Till the Nifty holds on to the 20 DMA, you'll say Santa will come to town hopefully in December, and hopefully we'll brace for higher highs. And just one point, all through the year we've been talking about India underperforming, right? November, actually, we either market performed or we outperformed as well, because the Nifty goes on with a gain of around 2%, and the Shanghai market actually is down close to around 2%. So, though they have outperformed us year to date, for November at least, we had more green than them, which is good in itself. What do we track from here on? Central bank action is going to be very, very important, right? The Fed, whether they're going to cut, not cut, what's going to happen on that front. That Fed futures, actually, that probability has moved from 30% to 80% and 85% as well. But hopefully, the Fed does come about with a cut. I don't know whether it's the last cut from the Fed chair, going by Mr. Trump, had to say. And then the RBI as well, all probability they cut. And Bank of Japan, we'll have to keep an eye out on that, whether or not there's any kind of shocker that comes out of there, because we know that yen carry trade has its repercussions. And hopefully, the second half of the year is going to be very good. Earnings will pick up, economy will pick up, things will look good, and will not be as dull as this.
But I think Nimesh has a lot of conviction in the markets. Nimesh, you are seeing a melt up phase. Those were your words.
Yeah. So last time I was with you guys, I had said that markets look like a coiled spring. And with this new high being touched this week, I think we are set for a melt up when actually some of the positive news that people are waiting for may come. This new high is underappreciated, clearly. Sure. All the major worries that we had in terms of geopolitics, in terms of trade deals, in terms of Trump still tweeting about immigration, all these worries stay. FIs are still selling. And yet, the market has crossed a new high. And with sectors like banking, and I think the Midcap index also crossed a new high. So I think this strength is underappreciated. With these worries, if we are here, if many of these things get solved, you can imagine where we would be. So I'm actually quite positive on the markets. Earnings growth is picking up, economic growth is picking up. The government has done everything to boost consumption. And this demand that comes will, I think, be the flywheel that will help capex, that will help exports, that will help the deals getting signed quickly. So when people say that China has a bargaining power with rare earth, I think we have a bargaining power with the world in terms of having the fastest growing young economy.
Right.
So I'm quite positive.
You know, Chandan, Nimish, the other part of the argument is it's been a narrow market at the top. You know, only select stocks has helped the Nifty reach the all-time high. Even the IT index is down for this year, right? So it's been very selective pockets which have done well, and the broader markets have been really bad in that sense in terms of performance. How do you read the broader market performance from at least for this year?
So when there is certain dearth of growth, say in a year when you are seeing slow growth, and which I think from last year, if I say from September 2024, people have in the first half, in the first 6 months from there, people were revising growth downwards.
Yeah.
There was lack of growth. So clearly people would want to hide into something which is giving them consistent growth. There were so many news events, headlines driving markets. People would want to again be in a place where they don't see so much volatility and they are ready to give a higher premium for that.
Sure.
So which means, and I think the IPO interest also was because of that. Okay, if I'm getting some listing gain, I would want to invest and put my cash there. While this has been a narrow market, I would also flip the argument and say that a lot of stocks actually have upside, which have not really moved. Again, last time when I was on your show, I said we look at target prices of BSE 200 companies. Out of the 200 companies today, if I look at it, there are 2 companies who have stale estimates and are not giving any target prices. Out of the 198, 172 companies have a positive upside in terms of target price, according to what Bloomberg calculates as an aggregate of all the average prices. I'm not taking the bullish prices. And 96 of them have a double-digit upside. So that's about 50% of the universe, which is yet seeing a higher move. So that makes me actually more bullish that though right now you're absolutely right that things are quite narrow in terms of movement, but that gives me more hope that we will move.
It'll spread out.
It'll spread out. It'll widen.
You know, guys, you were talking about some of those triggers, right? Is the India-US thing also a trigger? I mean, whenever that happens, one of the triggers in your equation?
Absolutely. I think India-US, and now I would even add India-European Union deal.
So there is positivity on India-EU. I just want to, if the producer can pull up the graphics. So our colleague Shireen just interviewed a bunch of secretaries, Commerce Secretary included. And I just want to read out. So this is from the top trade secretary, right? He says, and just an hour back the conversation happened, Rajesh Agarwal, the Commerce Secretary, says there was commitment for completion of the India-US bilateral trade agreement, the full BTA by the fall. Things have changed. In between, a lot of global trade landscape, etc., has changed. Engaged in talks for a BTA, a trade agreement with the US. Trade agreements involve much more than market access. And then he says, okay, he does say very optimistic to find a solution within this calendar year.
This fiscal year, I guess.
No, it says calendar year.
It says calendar year.
So which is now like, whatever, 1 month, right? Which is what the market is expecting as well. But then he says presumption is that trade deal will be beneficial if both sets of 25% tariffs are tackled. Right? It's not the penal tariff of 25% is taken off. Whenever deal is signed, both sets of tariffs will have to be addressed. Talks are still on. There is larger one which is also being discussed. BTA will take a lot of time when reciprocal tariffs are there. So it seems like it's. I mean, there is. I don't know. I mean, we'll get this exact soundbite. But he also said this entire trade agreement, a proper trade agreement, will take a lot of time because there is these reciprocal tariffs. Does it mean anything to you, and how do you think about it? Market expectation is this week, next week. Next week nahi hota hai, to agle hafte. But what's your sense?
And we've got the makings, right? Because crude buying has gone down. Defense deal is happening. You had the textile stocks, the indicator that Prashant talks about, Gokuldas, Welspun Limited. They went into the weekend up 10%. So those indicators are indicating that deal hai.
So market's definitely expecting a deal. But let's just back up a little and say that if you look at the entire trade tariff restrictions that have been put on us, that 50% tariff, 25 plus 25, affected about 0.3 to 0.5% of GDP. It affected less than 2% of the corporate profits in BSE 500. It created a negative sentiment, mainly. And that has put pressure on the markets. Now, I believe if that 25% penalty goes away, Indian businesses are competitive enough to take market share and be there. See, we've also got a little bit beneficiary for exporters, a little bit benefit of rupee depreciating a little bit there. Also, government, what I read yesterday, they are also coming out with a package to help some of the exporters either diversify the markets or handle their costs and taxes better.
Yeah.
So even if there's one leg of the deal, see, many of these bilateral treaties, which were handshakes till now, the details are yet to be worked out even with some of the other countries. So it is possible that the full-fledged deal may take some time. But even if there is an indication that the 25% extra penalty that we have been put on, unfairly though, that goes away, I think markets would cherish that.
Okay, all right. Let's focus on, I think today's big data point that we're going to put out, and that's by Nimesh. Nimesh, everyone's been talking about pain in the broader markets, not feeling like 52-week lifetime highs. Let's put it into data points, right? You have dissected the data. Let's hear more about
it. That's something which will show up in the data as well. But, market has been like two halves this year, clearly, Nigel. The good part is the Nifty and Bank Nifty is all-time high.
Yeah.
But the even, bad part is that the broader markets have seen massive pains this year. So let me just go to the wall and show the data as well. So, again, as I said, the broader market has seen a big pain in this calendar year. While the Nifty and Bank Nifties are at all-time high, multiple stocks in the broader markets are down 50 to 70%. That's the kind of fall you've seen in the broader market stocks. The next split will come up across the three major indices, the BSE small cap, the BSE mid cap, small cap, and the micro cap. In the BSE mid cap, 52% of the stocks are given negative returns. It's equally bad in the small cap and the micro cap. Now look at the first, which is the mid cap index. Look at the kind of stock correction we've seen. Ola Electric is down 52%, Brainbees is down 52%, Vedant Fashion, a good name, that is down 52%. Kalyan Jewellers is down almost 40% in this calendar year, and so is Oracle Finance, which is down 36%. So that's some of the bunch of names in the mid-cap index. Now comes the small-cap index. If that list is much higher and much more painful, Sadhana Nitrochem, that stock is down 86% in this calendar year. Vishnu Prakash was an IPO this year, that's down 72%. Dream Folks, Pakka, there was a lot of retail interest in Pakka, that stock is down 62%. And one of those listing of this year, MobiKwik, even that's down 60%. As I said, the small cap list is much bigger. Another sets of stocks will come up in the small cap basket. Praj Industries, a momentum name, a lot of institutional interest, that's down 60%. Tejas Networks is down 60%. Provek, again, it was seen as one of the big beneficiaries of tourism, that's down 60%. So is Protein eGovern and Ganesha Eco. A good institutional holding in these two names, even they are down almost 57-60%. So that's the small cap. Now comes the micro cap. A lot of pain in the micro cap stocks as well. Jindal Worldwide is down 60. Street Planners is down 55. Orchid Pharma is down 53. KNR Constructions, Root Mobile, more than 50%. So that's only the list of stocks which are down more than 50% in calendar year. Now is the mid-cap index, the Nifty Mid-Cap 100 index. All good names. Swiggy is down 25%, Supreme Industries, NTPC Green, Godrej Properties from the real estate pack, that's down 25%, and IRB Infra is also down 25%. So that's the kind of list. Across mid, small, micro, everything is down. Now look at some of the standout names within those big losers. Ola Electric, from the IPO price, it's down almost 65%, but from the highs, it's down 74%. And now the company is saying that they're going to raise funds via QIP. So again, Ola Electric has been a big disaster in this calendar year. The second name is Sadhana Nitro. I identified this because the stock was down almost 86%. The promoter holding has fallen down from 65 to almost 30% in this calendar year. So clearly it looks like it's the retails who have lapped up and their holding has gone up big time. And that stock is down 86% in this calendar year. So that was the second name. Another new listing was this year, Vishnu Prakash. That stock is still down from the 52-week high, it's still down 76%. And even here, the story is simple. The retail holding has gone up all the way up to 26% in this calendar year. So that's Sadhana Nitro. Another stock which will come up on the screen is Ganesha Ecosphere. This is interesting. From a 52-week high of almost 2,500, now the stock this week actually hit a low of 850 and is quoting around 950 odd level. So it's down almost 63%. Interestingly, the mutual fund owns nearly 22% in that particular stock. And the last name is Provek. It was seen as a big play on the tourism. That stock from a high of 1,300 is down nearly 77% and hit a low of 300 rupees. Even there, the current, the retail holding is quite high at 20%. So clearly, whether in stocks where the promoters have sold or whether they were QIPs, everyone lapped up in this year, but the pain has been quite strong. And you can see from the data as well, a lot of mid and small cap stocks are down 50, 60, 70%. Nimesh, your thought on some of those companies where the promoters sold the QIPs, they raise money by QIP. It's a old saying that when promoters sell, it has to be negative. I mean, for a while, it didn't turn out to be. Everyone thought it's a new norm. Now it's a reality, right? A lot of promoters have sold out. Retail holding has gone up. And look at the list, like 70 down, 55 down, 60 down. What's your take?
So the list that you presented, we keep a watch on that list, and we are more focused towards the BSE 200 side. So I saw about 50% of the companies are at least 10% or more away from their 52-week highs. And you're right, some of them have actually fallen 50 to 70%, like what you highlighted. And they are institutional stocks also. There has been institutional holding in there. Now, typically what happens in a market where the sentiment is not very positive, people overreact to a negative news that comes and underreact to a positive news that comes. In fact, not all of them, but some of the names in that list are worth looking at.
That was the point, after the fall, would you look at some of those names as a potential buying candidate?
See, in small caps and mid caps, I would put mid caps, small caps and micro caps. You can generate a lot of alpha if you're a stock picker. Because though businesses are very diverse, people get bullish or bearish about the entire category at one go.
Absolutely.
So, sub small cap kharab hai or sub small cap achhe. Right? No? That is how people move. So that's why the opportunity lies for a stock picker to pick up some of these fallen angels. And I'm not saying the entire basket is right, but there would be some which you can pick from where people would have overreacted or so. So I would look at.
I'm getting a sense that you've done your homework on a couple of these stocks where
it's quite evident.
You know which ones. So आप as a homework for the weekend, दो तीन बता दीजिए, मतलब जो पढ़ना चाहिए, देखना चाहिए, which you can learn from, which you should go back and look at. I mean, it'll be useful.
See, I also believe that winners of the previous rally don't create the next rally. Right? If we want to look at rallies in BFSI, infra, construction companies, real estate companies, look at what happened between 2003 and 2007. Even PSU banks, those were the winners. Maybe the next few years will be like that, where you need to look at some of these infra companies, real estate.
बहुत cryptic हो गया. मतलब कुछ एक दो तीन आप मतलब specific companies just as a purpose for one can go back.
I may not be able to.
Are there names in this list which Nimesh mentioned?
Some of the construction companies we are positive on, so we've started accumulating. I can't name them. I'm sorry, but there were only few construction companies there, so you can pick up which ones are there.
Nimesh, आप बता.
So another thing is, it is very tempting to generalize that so many promoters are selling, so many QIPs are coming, so many IPOs are coming.
Opportunity comes
then
from
everything is negative. Okay. So on the overall market, despite the supply market is at a new high, but where does this money go? Somebody asked me, Nimesh, how much money is there in the market today? I said zero, because somebody has sold and somebody has bought. There's nothing in the market right now. So where is this money going? Obviously, when money is going out of the country, an international listing comes, takes money out, sends it to the parent, that obviously is negative for the market because the money has gone out. But if it is going into certain capex for the company, or it is getting somewhere again directed towards the market through a private equity fund or some fund sold the stock and they bought something else. So that rotation is fine. If India is a market and an economy that can attract flows, then all this will be like part of the path.
Nimesh, just to hold on, we need to slip into a very short break on that note. As we do that, India's Commerce Secretary and Chief Trade Negotiator, Rajesh Agarwal, let's listen in to what he had to say when he spoke to Shireen Bhan on the US trade negotiations.
The stocks are still on, and it is because these are two negotiations also. There's a larger one also which is going on. So talks are on. Our teams are engaging virtually on a regular basis. There are virtual sessions every week on some issue or other. Let's wait for some time. You may see the visits can happen either way. Whether we visit them or they visit us. They were in pretty lockdown for some time, 45 days or so. Now they are out of lockdown. The assumption is that a trade deal will be beneficial for Indian exports only when there will be addressal of both 25% tariffs, not only the one which is a trade tariff which has been imposed on trade in lieu of the lack of trade deal, but also the other 25% 25% tariff, which have been imposed for some other geopolitical reasons. Until unless both are addressed together, it will not mean a meaningful deal for India.
Welcome back. You're watching Editors Roundtable. Well, next week, all eyes will be on Meesho as the IPO is all set to open between 3rd and 5th of December. Just some key details. They're looking to raise 5,420 crore. Of that, 4,250 will be a fresh issue. Balance 1,100, 1,200 will be an offer for sale. Now, here is some stats about Meesho. Well, it is India's largest e-commerce platform in terms of orders and users. 1 out of 6 Indians shop on Meesho. 234 million are their annual transacting users. And in terms of orders processed, last year it was 183 crore. The growth numbers are also very large for the company. They've been growing. I mean, if you look at the net merchandise value, that was about 20,000 crore in the first half of the year. And the whole of last year, it was 30,000 crore. Now, this was a company which pioneered zero commission model. They didn't charge anything from the sellers, unlike what an Amazon, Flipkart did. So how do they make money? Largely from their own in-house logistic fulfillment channel. It's called Valmo, which processes about 2/3 of all the orders of Meesho right now. And the other way for the company to make money is via advertising. So these are the two levers via which the company makes money. Nothing from the sellers. It's a pure zero commission. Now the question really is on the valuations. It's 50,000 crore is the asking market capitalization. In H1, the company made a loss of 7,000 crore rupees. And if you compare it in terms of price to sales, Meesho comes at 5.3 times. Now, this will be lower than some of the other consumer internet e-commerce players, like Eternal is at 14 times. Lenskart came at 10, 11 times. Nykaa is also at about 10 times. Trent is at 9 times. So the closest comparable in terms of price to sales for Meesho would be DMart. But DMart is highly profitable, while Meesho, as of now, had a loss, as I said, of 700 crore rupees. So, I mean, generally, when you look at all the IPOs, like Lenskart, Pine, Grow, they're all actually trading above the issue price, despite the concern around valuation, etc. We still have to wait for a few quarters of numbers to play out. There could be a bad quarter, stock falls, lock-in period for some has to end. But how are you positioned in your portfolio on these consumer?
We are very, very selective.
Which ones do you like? I mean, with the disclosure?
So we've been participants, as it was disclosed. We've been participant in Grow. Okay. We've been participant in a pharmaceutical company called Rubicon Research. So we've been very, very selective in terms of our participation. In Benjamin Graham's book, there is a phrase that during bull markets, IPO full form should be, it's probably overpriced. So we go with that. So if in the secondary market, we are getting value, then we don't chase IPOs that way. So that's a fund house strategy, or our fund house stance at Bajaj. But still, the kind of companies that are coming for IPOs, so valuation aside, the kind of companies that are coming for IPOs is still good quality companies. Majority of them. I'm not tracking all of them that come, but majority of them are good companies, either are coming with a digital or a tech platform or a more futuristic business or a high growth business. I think that's still a positive sign for the market. You should be worried when at a higher valuation, you see companies which have questionable business models, are typically also ran, not any leadership in the business or a brand or moat in there, but they come for IPOs and are getting oversubscribed, then you should be worried about. I think that's a sign where one should be worried. Otherwise, while being selective on valuations, we are not really say no to any IPO.
Yeah, they've all achieved scale. All these companies are, as you said, leaders in their own category.
One of the factors also will be when lock-ins open, right?
Lock-ins open,
because the pre-IPO, the lock-ins will open, and then I think some more supply comes. Right now, for many of these companies, the free float is kind of low.
See,
on
over
the
a longer
side.
term, every company gets the shareholders it deserves. So institutions who are truly focused on long-term businesses will use these opportunities whenever, say, after the lock-in, if there is a sharp correction, just people shorting for the reason that they're expecting somebody to sell, then slowly the color of the book, the color of the shareholding in every company will change to get what they deserve to be. I think in a year's time, you will actually see what the IPO list was and what the actual shareholders remain.
Yeah. But Nimesh, this has been a great conversation. Thank you very much for coming down to our studio. Enjoy your weekend. And we'll take away that there's a melt-up coming in the markets. So it sets us up well for the month of December. Well, with that, it's a wrap on this edition of Editors Roundtable. Thank you very much for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty gained for the third straight week, but the gains remain limited even as the benchmarks touch new lifetime highs. Midcaps outperformed the blue chips, with financial stocks leading the rally. Commerce Secretary and India's Chief Trade Negotiator Rajesh Agarwal highlights two parallel negotiations underway with the United States, says he is optimistic about a framework trade deal to address the reciprocal tariff challenge by the end of 2025, says talks over a bilateral trade deal will take a lot of time, adds that a trade deal would be beneficial only if it addresses both reciprocal tariffs and the additional penalty levied on India. US President Donald Trump says the country will permanently pause immigration from so-called third world countries. Does not specify which countries will be targeted. US will also re-examine green cards issued to immigrants from 19 countries, which does not include India. Russian President Vladimir Putin will visit New Delhi next week for the India-Russia annual summit. The two-day visit comes at the invitation of Prime Minister Modi and against the backdrop of US imposing punitive tariffs on India for buying Russian oil. All right, let's start with the big headline. The second quarter growth numbers are out. India's GDP grew at 8.2% in the June quarter. This is far higher than what our poll had estimated. Lata Venkatesh here with her analysis. Lata.
Yes, it is a huge number as far as the GDP is concerned at 8.2. Our poll said 7.4. There were several polls on the street with even 7.2. So this is a very big jump compared to what the street was expecting. And I think the big jump has come in manufacturing. Manufacturing has come in at 9.1%. And our poll was not anticipating such a big rise in manufacturing. I'll just give you what our poll said on manufacturing. It said 8.9. They've come in at 9.1. But across the board, even agriculture, it says 3.5. Ours was also 3.5. The important point is the nominal GDP has come in at 8.7. Now, how is it? 8.2 is the overall growth in the GDP. To it, you add the price rise and you get the nominal GDP. Or rather, GDP for about 60% of the items is counted in today's prices. Then you reduce, deflate it by the price rise. The price rise is taken as 0.5%. Most people on the street expected it to be closer to 1%, the year-on-year rise. For you and me, the price rise may feel like being higher, but arithmetically, the WPI, the wholesale price index, has been negative in the past 3 months, that is July, August, September. That is why you calculate the nominal GDP at 8.7% according to the data, and then deflate it and you get 8.2. So only 0.5% inflation has been taken into account. So it's 8.7 nominal GDP compared to 8.8 in the first quarter. The CNBC-TV18 poll was expecting an 8% nominal GDP. In any case, I think this GDP number is way above what the street was expecting. So we should expect a fairly positive reaction on Monday from the markets as well. Manufacturing, as I told you, has come in at 9.1%. Agriculture at 3.5%. The other positive numbers have also been construction at 7.2%. Gross fixed capital formation, something the market will be very happy about, has come in at 7.3%, and private consumption at 7.9%. Remember, a lot of people were expecting consumption to be low in the second quarter, because the Prime Minister announced that the GST will be cut on August 15th in his Independence Day speech, and the cut became effective from September 22nd. The expectation was that people would have consumed less up until September 22nd, anticipating lower prices. But consumption coming in with a strong growth of 7.9% indicates an inherent strength in consumption. Therefore, this is, a no-holds-barred good number. Any which way you look at it, capital investment up 7.3%, as I told you. Gross fixed capital formation rising by 7.3 is a damn good number. Government consumption is lower at 2.7. But anyway, that's a small part of the overall GDP. Private final consumption at 7.9 and gross fixed capital formation at 7.3 are damn good numbers. Likewise, manufacturing at 9.1 is a very good number. Construction, which is extremely employment heavy, coming in at 7.2 is also a very good number. So all told, you will have to say that these numbers are way above street expectations. You will start now seeing people upgrade their overall growth number. Already people are sitting at 7.02. That was our poll in terms of the full year GDP. Now I guess it will get upgraded to 7.2 or thereabouts. the important part is, where does this leave the Reserve Bank? If growth is as strong as 8% for the first half, remember, we got the first quarter at 7.8, second quarter 8.2. So first half growth is 8%. Do you really need a rate cut when growth is chugging along, or rather growth is, galloping at 8% would be a question. So we must watch out for reactions to the bond market, but there is no doubt that the equity markets are going to be extremely happy. It's a very, very buoyant number. That's the first impression.
All right, so the big takeaway by Lata Venkatesh. Shifting focus now, Commerce Secretary and India's Chief Trade Negotiator Rajesh Agarwal has highlighted that two parallel negotiations are underway with the United States. In a conversation with CNBC-TV18's Shireen Bhan at a FICCI event, Agarwal said that they were optimistic about a framework trade deal by 2025 end to address the reciprocal tariff challenge. However, he said that talks over a bilateral trade deal will take a lot of time. He said that a trade deal would be beneficial only if it addresses both reciprocal tariffs and the additional penalty levied on India.
The expectation was that by the end of November, by fall, we would have an inking, a signing of the India-US BTA. Where are things currently on that front, Mr. Agarwal?
There was a commitment to see that the first tranche of India-US BTA is completed by fall of this 2025. However, things have changed and moved a lot from 13th February onwards. When we got into a BTA negotiations, we were on the path to deliver a good aspirational first tranche by the fall of 2025. But in between, we have found a lot of changes in the global trade landscape. One of the key has been in the US landscape, where we came out with reciprocal tariffs, tariffs which were imposed on all the trading partners in order to see that the trade deficit with the trading partners can be evened out, and also maybe overall create a revenue stream for the government of United States. So with that new change in the overall landscape, the BTA has also gone through some articulation, some changes, wherein right now we are engaged with not only negotiating a bilateral trade agreement, which definitely with a country like United States will take a lot of time, because trade agreements are very wide-ranging agreements these days with a lot of issues, not only market access issues, which are negotiated under the umbrella. But at the same time, we are also engaged in a protracted negotiations on a framework trade deal, which will try to address the reciprocal tariff challenge that the Indian exporters today face. So these are two separate parallel negotiations going on, but one will feed into the other. What needs to come first is the framework trade deal, which is able to address the reciprocal tariffs. We have engaged on it for last few months very deeply with the US teams. And I think all I can say that we are close. We have tried to iron out most of the issues. Now it is only a matter of time when this decision has to be taken, that when the two countries have to find the right landing zone to announce the deal. So that is where we stand as of now.
It's important that you've highlighted for us that there are two parallel negotiations underway. One, of course, is for the bilateral trade agreement, and the other is to deal with the reciprocal tariffs, the framework that you spoke of. Is the hope that the framework to address the reciprocal tariffs will perhaps be done in this calendar year, sir? Is that the expectation? Is that the hope that you're working with? And have the outstanding issues, especially when it comes to market access, when it comes to the US's concerns on India buying from Russia and so on and so forth, does the US now feel that India has addressed some of those concerns that they raised?
I think our expectations, we are very optimistic and very hopeful that we should find a solution within this calendar year. But as you know, with any trade negotiations, the final deadlines cannot be, because even if there is one sticking point or one sticking issue which is in the mind of even one of the partners, the trade deal may not meet that deadline. Having said that, I think the overall position is well set to deliver it in next few weeks or months as soon as we can. But let's see, it's a call that will have to be taken at multiple levels. At the levels of negotiator, I think we are in a zone where we can say it is something that we can achieve in a very short while of time. There's not much to negotiate. There are very few issues, and that can be taken. The political call needs to be taken on some of them. And having said that, also as a country, we have always stood for our own sensitivities and our own uniqueness. So there are areas which are non-negotiables from our perspective. And that I think people, the countries which have negotiated deals with us are very clear that what are the things that India is not open to negotiate or not able to commit or bring to the table because of our unique nature of our economy, the way we are poised and the sensitivities that we do have in our economy. So those remain negotiable, whether it is any agreement, including the one with United States. Thank you.
You know, Commerce Secretary, I know that we cannot speculate beyond a point on the timing itself, but I just want to understand on the framework per se. As and when there is an understanding on both sides to go through with it, would that automatically mean that there would be a reversal of the 50% tariffs that have been imposed on India?
The assumption is that a trade deal will be beneficial for Indian exports only when there will be addressal of both 25% tariffs, not only the one which is a trade tariff which has been imposed on trade in lieu of the lack of trade deal, but also the other 25% tariff which have been imposed for some other geopolitical reasons. Until unless both are addressed together, it will not mean a meaningful deal for India. So we understand whenever the deal is finalized and signed and agreed to by the both sides, I think both these 25% will stand.
Are talks still on, sir, or have talks concluded?
The talks are still on, and it is because these are two negotiations also. There's a larger one also which is going on. So talks are on. Our teams are engaging virtually on a regular basis. There are virtual sessions every week on some issue or other. So there is an engagement.
Are you going to be visiting the US anytime soon, or are they going to be visiting us anytime soon?
Let's wait for some time. You may see the visits can happen either way. Whether we visit them or they visit us. They were in pretty lockdown for some time, 45 days or so. Now they are out of lockdown. So we expect some visits from their side also in the near future.
So on the BTS, and I don't want to make this just about the US, but one final question on this before I get the other secretaries back, and then I'll come back to you. But on the BTA, are negotiations done and negotiations still underway, even as far as the BTA is concerned? And what's the broad timeline for the BTA? Because this is separate from the BTA.
I think BTA will take some time. It's quite an expansive. BTA is like a free trade agreement, and it will take a lot of time. And especially with the change dynamics, where you have got reciprocal tariffs in the play, which are beyond the MFN tariffs that each country do have. I think we'll need to find pathway for complete elimination of reciprocal tariff in our process of doing BTA. So I think that will take a bit of time, and we'll not hurry up those. We are working on various aspects of BTA, but let the first one come first, and then we'll see what are the timelines that we put for the.
Right, shifting focus to the US president. Now, Donald Trump has said that he will permanently pause immigration from all third world countries to America. In a social media post, President Trump said the measure would help the US recover from former President Joe Biden's immigration policies. President Trump also said that he will, and I quote, deport foreign nationals that are non-compatible with Western civilization. However, he did not specify which countries will be targeted. The announcement came after an Afghan national was accused of shooting two members of the National Guard in Washington, D.C. The U.S. has already suspended all immigration requests from Afghanistan. The U.S. will also re-examine every green card issued to immigrants from 19 countries. The list of nations that the U.S. Citizen and Immigration Service has called countries of concern does not include India.
The suspect is an Afghan national flown here by the previous administration, who was such a bad administration. And I have a picture of a plane. This is what it looked like when they came in. It was total bedlam. Do you remember that period of time? Total bedlam. People crammed onto the plane. We have no greater national security priority than ensuring that we have full control over the people that enter and remain in our country. For the most part, we don't want them.
Russian President Vladimir Putin will visit New Delhi next week for the India-Russia annual summit. The two-day visit comes at the invitation of Prime Minister Modi and against the backdrop of US imposing punitive tariffs on India for buying Russian oil. All right, time for a short break. Coming up next, several car makers write to the Heavy Industries Minister, say the proposed fuel efficiency targets benefit only Maruti Suzuki. More details when we return. Welcome back. Let's talk about the day's market action. The Wall Street ended flat for the second straight day with the Nifty holding levels above 26,200. Frontline indices closed with minor changes. Sensex, Nifty and Midcaps fell in trade while Nifty Bank rose 15 points. For the week, market gain for the third straight week amid a range-bound trade. Broader markets outperformed the benchmarks and this was led by the financial stocks. 30 out of 50 Nifty stocks posted gains over the week. Nifty Bank gained nearly 2%. Several car makers have written to the Heavy Industries Minister saying the proposed fuel efficiency targets benefit only Maruti Suzuki. Industry sources have said that emission concessions, if any, should be granted to all cars and not just those with weight up to 909 kilograms. Parikshit Luthra joins us now with more. Parikshit, what are your sources telling you?
Well, this proposal for CAFE 3 norms has really divided the industry. It has become a bone of contention. Several OEMs, and these are leading OEMs, Mahindra, Tata Motors, Maruti Suzuki, MG Motor, they've all written to the Heavy Industries Minister saying that there should be a level playing field and there should be no subcategory for small vehicles when it comes to the corporate average fuel efficiency norms. They've said that creation of any subcategory of vehicles based on weight will have an adverse impact on nation's progress towards safer and cleaner cars. They said that a lot of investments have already been made towards electrification and therefore any kind of changes which benefit one particular company will impact others. They've also said there should be no relaxation in emission norms granted to cars up to 909 kgs with an engine capacity of 1200 cc and length not extending 4000 millimeters. This is because Maruti Suzuki has a 95% market share in cars up to 909 kgs. At the same time, they are saying that the CO2 emission concessions, if any, should be granted to all cars up to 1,170 kg, which is the industry average. They also said that granting CO2 reduction credits to ICE vehicles only based on weight without CO2 reduction measures would contradict the very intent of the corporate average fuel efficiency norms, which is to improve the efficiency of vehicles, improve the mileage, and also reduce vehicular emissions altogether. Now, the industry is also saying that the GST has set one definition of small cars, and if you put up another definition, another subcategory within CAFE norms, that will only impact the planning of the overall automotive industry. So therefore, they're asking for a level playing field.
All right, thank you, Parikshit, for that update. Shifting focus now, the Indian Energy Exchange has alleged that Central Electricity Regulator's order mandating staggered implementation of market coupling from 2026 is tainted. In a plea to the Appellate Tribunal for Electricity, the exchange cited a SEBI report to claim that CERC officials indulged in insider trading. The tribunal has expressed concern over the allegations and will hear the case in early January before the rules are notified. Ashmit Kumar joins us now with more. Ashmit, please tell us more about IEX's plea.
Well, serious concerns being raised today before the hearing that took place in APTEL. The Indian Energy Exchange, which is directly impacted by that coupling order of July 2025, today raised concerns before the APTEL, not about the legality of that coupling decision, not about the rules and regulations and the framework in place, but rather about a SEBI report which came out in October, which is an ex parte interim order, which directly says that there was an attempt, a conspiracy that was hatched by CERC officials, whereby they would issue this order, this coupling order, which resulted in a 29% crash in the share price of IEX, and that was something which prompted insider trading, which led to these violations of the SEBI Act, of the SEBI regulations, which is a direct case of insider trading. And this, the counsels for IEX said that is a case of the order being tainted, that the very person who's authored the coupling order is someone who's also been cited by SEBI as being part of this insider trading circle, that this is in itself is enough grounds for the APTEL to set aside this entire coupling order. For now, the APTEL not saying anything on the merits of these allegations, but nonetheless saying that these are very serious allegations and that APTEL would like to go to the bottom of these questions that have been raised. So clearly, much more ground that needs to be covered now by APTEL. The next hearing in this case, we understand, will be on January 6th.
Right. Thank you, Ashmit, for that update. With that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18. Thank you for watching.
afternoon. Welcome to a very special edition of Indianomics on the just announced GDP numbers. I'm Lata Venkatesh. The Indian economy has grown in the second quarter of the current year by exceeding all expectations. The total GDP riding on a fillip in the industrial sector has grown at 8.2%. This is the fastest rate in about 6 quarters. We are going to analyze this data over the next half an hour. Already the bond market has analyzed and come to the conclusion that with an 8.2% second quarter GDP growth and the 8% first half GDP growth, it is extremely unlikely that the Reserve Bank will cut rates. We have seen a 5 basis point rise in yields across the curve, whichever instrument you take, 5-year, 10-year, old 10-year, new 10-year, there has been a rise in the yields. So that's the most important impact after the announcement of the GDP. We don't have the equity markets trading now, but if it were, then you could see perhaps a 21-gun salute, a huge rise even in the equity markets. But to analyze the economic implications, I have a panel of economists joining me. Kaushik Datt, the Chief Economist, India and South Asia at Deutsche Bank, Sakshi Gupta, Vice President and Senior Economist at HDFC Bank, and Sameer Narang, Head Economics Research Group at ICICI Bank. Gentlemen and Sakshi, thank you very much indeed for your time. Sakshi, I come to you first. You had a very interesting report that India's incremental capital output ratio has also gone down. Now, when you look at these numbers and the gross fixed capital formation number, which is also very strong, rising at 7.3, what's your outlook for the second half? Do you think we are going to produce at least a 7% for the current quarter? You're on mute, I think.
Sorry, yeah. Am I audible?
Yes.
Yeah. So, Lata, today's GDP numbers, of course, are a very big surprise, as you highlighted, beating our estimates as well. We were close to 7.2. Look, there are a couple of things. I mean, we can debate why these numbers are so high. Of course, it is coming on a low base from last year where real GDP growth was, sub 6%. We know that there are deflator issues also, which are inflating real GDP growth numbers, because in nominal terms, nominal growth was just about 8.7%, slightly lower than what we saw in the first quarter. But that aside, I think this data does tell us a couple of things. One, I think on the consumption side, there is this momentum that has continued to pick up in the second quarter. I think a part of this is being led by the rural economy, as well as, I think, some improvement in urban demand. On the investment side, yes, of course, I think a lot of the heavy lifting has continued to be done by the government. But I think that if you look at some of the other indicators, corporate bond issuances this year, etc., and some of the feel that we are getting on the ground, there is beginning to be some positive signals around, in certain sectors that private capacity expansion is also increasing, right? Clearly, the manufacturing number coming in above 9% for this second quarter is again a very reinforcing and positive signal, which indicates, that manufacturing capacity as well as production continue to be on the positive side despite the tariff threat that India faced.
No, I take your point. Manufacturing is standing out as a very strong number, though, to be fair, my poll also said 8.9 for manufacturing. The surprise has come even in finance, real estate and professional services, coming in at a growth of 10.2%, as well as public administration, defense and other services, which has come in at 9.7 over a base of 8.9. So it's an extremely strong growth despite government consumption going down. Kaushik, what would you pick out as the biggest surprise in the number? I got only one person coming to 7.7 at least, and that was Soumya Kanti Ghosh of SBI. He gave us a number of 7.7, but said that he wouldn't be surprised if it were 8. But otherwise, that was the best number we got. What is the surprise?
Lata, you forgot to mention my name. I thought I gave much earlier.
No, you never answer my poll. Kaushik, you don't answer my poll, so you're not in it. Go ahead.
Okay, so I had predicted 7.7 long time back, and I had also written that it will be above probably 8%. I was a little scared to give above 8%, but it was very easy to forecast it because it's not very difficult. Because if you get your nominal GDP growth right, and I had a forecast, now I can tell you, you can see in my report, it was 8.6%. And all you had to do is take the deflator, which was coming at 0.5%, because in July, September, WPI inflation averaged 0% and CPI averaged 1.7%. So if you apply a 70-30 ratio for WPI versus CPI, you would have got a deflator of 0.5. So 8.6 minus 0.5, you would have got to that 8% handle or something. I was a little conservative, so I gave 7.7, not knowing how.
You know, to be fair, Kaushik, even our poll indicated an 8% nominal GDP and a 7.4% GVA. So even the people who were, 7.4% real GDP. So it was almost 0.5% deflator even as far as our poll was concerned. The deflator perhaps has been correctly calculated by most people. There is no taking away from the fact that the overall economic growth, despite the deflator, notwithstanding the deflator, has been a positive surprise.
Yeah. So definitely, I mean, we are not saying that this is not a good, kind of, number. This is a good number, but it was, at least to me, it was known that it will come strong. One is because we are calculating year on year. Remember that. So last year, July, September was 5.6. So the base was very favorable. The second is the deflator issue. We knew that it was a question of, whether you will get your nominal GDP, forecast correct or not. We had it at close to 8.6. So that came at 8.7, I think, actual. But, the half empty story is about the nominal GDP growth having come down so significantly. And that has a lot of implication for whether it's tax collection or whether it's, other ratios like earnings estimate in the equity markets. These are all based out of, your nominal GDP growth. Nominal GDP growth falling so much is not a very good sign, and it'll have its own issues with debt GDP, flattening out. So you have to keep this in mind that this is probably one of the lowest nominal GDP growth number that we are going to have. And in FY26, we'll probably have nominal GDP below 9%, which is not a very good, story. And remember that, going forward, what can happen if that nominal GDP doesn't increase too much. I'm just talking about next year. And suppose your GDP deflator comes up, then your real GDP gets squeezed and comes much lower, right? So you should not be just seeing the real GDP and saying, because your real GDP and nominal GDP has become almost same. Is that a good thing? That is up to debate.
Okay. No, I agree with you that the nominal GDP is among the lowest numbers that we have seen in some time. But just now we are getting the tax numbers also. The October tax GTR, gross tax revenue, is up 13.2%. I don't know the April-October number yet. I mean, I haven't done the calculation. I only did for October. At the moment, it's not reflecting in tax. And we should also remember that after the government announced the budget, we then had the final numbers for last year, and that reduces the asking rate of nominal GDP to just about 8.1%. So at the moment, the fiscal deficit is not in any danger. But as you say, anything else dependent on nominal GDP, like the final tax collections or even earnings of companies. The company's earnings are only going to depend on the total amount of goods and services extra they produce. That creamy layer of rise in prices is not going to be available. And that might bring down earnings growth, which is a worry. Samir, would you agree that, the growth is genuinely a surprise, but the nominal GDP can have its side effects?
No, Lata, I agree. Nominal GDP has its own side effects. But when we look at a number of other nominal variables, as you are pointing out, and as was stressed by Kaushik as well, what you see is that credit offtake is picking up. It's 9.7 lakh crore this year versus 8.1 lakh crore. Overall credit growth on a YOY basis is also much higher now. It bottomed somewhere around May, which was sub 10%. It's now around 11% plus. And when you talk about corporate results, they are also, even if you exclude the variation which is given by the OMCs or the refiners, overall revenue growth has picked up, overall earnings has picked up, operating profit has picked up. So it seems that we have bottomed out, and we are gradually seeing an increase in momentum, improvement in various growth indicators. There will be headwinds and tailwinds. Tailwinds will come from consumption. Very strong non-oil, non-gold imports, very strong vehicle sales, which we are seeing both in two-wheeler and passenger vehicles. But exports could be a headwind, which will ensure that growth is not as strong as we would have liked. So ideally for, a growth to go up to 8%, on a sustainable basis, what you require is much higher exports. And in the last quarter, we had seen, fairly good export growth. This quarter may not be because of the 50% tariff.
Yeah, take your point. And Kaushik, to come back to the fiscal impact, I told you the October number looked strong, but the April-October gross tax revenue growth is only 4%. So we could have a problem. Already CapEx spend for the month of October has been pretty low. So one doesn't know if there will be other repercussions because of this. But while we want to discuss what happens in the next policy, the immediate question is what will Reserve Bank do? Sakshi, your view, do you think you can really go with a cut with an 8% first half GDP?
Look, I still think it's a close call, Lata. I don't think that at this stage I would completely discount out the possibility that, of a rate cut in the December policy. It's really how you view this data, right? One of the things that we haven't discussed in this data is that a lot of the manufacturing growth or real GDP growth that we are seeing is because there was so much front loading, right? And so much production ahead of the festive season that is driving some of these numbers, right? A lot of that now starts fading away as you move into the second half of the year. Particularly on the export side, where we have still not seen the impact of tariffs play out, and it's just starting, right? So I think if you start looking at forward-looking numbers for the year, be it in real terms on a quarter-on-quarter basis or in terms of the nominal growth that we have currently, I think there is still case that one can make and say that, look, RBI might be more forward looking and think about, the inflation is providing them room to perhaps bring down the policy rate a little bit further. So I would still say it's still a close call.
What's your expectation, Kaushik?
We've been going on with the rate cut call for some time. We think RBI definitely should cut in December. These GDP numbers were known that it will come on the stronger side. But look at the forecasts for October, December, January, March, April, June that RBI has given and the consensus estimate that we have from the economist community. It's all at 6.3, 6.1. And I saw April, June next year. Now it's looking like close to 6% from the collective wisdom of all people who have submitted their surveys, which is basically telling you that the high base of this year, for whatever reason, whether it is deflator or other issues, next few quarters, you have a headwind of growth falling closer to, below 6.5%. And RBI's forecast is showing the same. If you look at FY27 growth forecast for RBI, it's sitting at 6.6%. They might revise this year's growth forecast higher. We already are at 7%. RBI is at 6.8. Probably December, they will raise it to 7% or slightly higher. But next year, their forecast is 6.6. If they're not going to change that, you're going to be below the potential growth rate. And, the base of this year plus the deflator story that I told you, if inflation picks up, then real GDP automatically stabilizes. You're going to be, from a forward-looking point of view, much lower than where you are today. And monetary policy is all about forward-looking, projections. And the tariff deal is still not done. We are now hearing that probably by the end of December, we'll get a deal. We thought it'll get done by November. Already the stresses are getting reflected in the September-October trade data. GST has been a good story for October, but beyond October, we need to see whether the momentum sustains. So there are lots of headwinds which RBI will have to keep in mind. And at the same time, RBI is an inflation targeting central bank. You have inflation close to zero. And going forward, RBI will revise the inflation forecast down surely for this year. Next year also, RBI's forecast is 4.5%. Whereas the consensus estimate of economists are close to 4%. So whichever way you look at it, I think there's a room for 125 basis points rate cut. And I'm not saying that, you have to do it. But the point is, if you're not doing it now in December, then the case for doing it either in February or April, it's too far away and, it loses its own whole relevance. And remember that February end, we will get a new set of GDP numbers. Everything will change. So all these forecasts that we give will not matter because the methodology will change and what comes with the new base, anybody's guess, and it will start with the October-December GDP numbers. So all these forecasts that we have may, to some extent, may be not that meaningful, but whatever data we have till now, you look at the forecast forward-looking either by the economists or by RBI, everything is below 6.5% for the next few quarters. And that merits a rate cut at this stage, not taking any more risk.
Okay. Well, I'm now beginning to doubt this whole idea of forward numbers altogether. Forward numbers, which were forecast in April, were 3.7% inflation. We are at probably 1.9, not even 2%. The forward numbers were 6.5 first for growth and then 6.7. But we are probably definitely going to end up at least at 7.2. So, I mean, if you keep looking at forward numbers, then the backward, when you look back, the decisions look wrong. The same question to you, Samir. Do you think with the growth at 8% and inflation, inflation is below expectation, growth above expectation, it's the happiest position a central banker can be. Does he really have to tinker with anything?
No, I think, first of all, I agree with you, Lata. We need to show some humility here. Numbers for all of us have been very different from what we thought at the beginning of the year. In fact, we have revised our growth numbers twice. And honestly, today also, we will revise it higher, somewhere in the range that you spoke about, 7.2 or slightly higher. Because October numbers are looking slightly better, because consumption is holding up much better than we thought earlier after the GST cuts. So that is holding up well. The second thing is on inflation, you're right. Inflation is, much lower. We tend to revise it again every 2 months on the lower side. But next year inflation, we believe, will be around 4%. So I think on this growth number, RBI can easily say that, growth is holding up. We don't need to tinker anything, as you are saying, as of now. The second part, which we should remember, is that this is the second year of BOP deficit that we will be looking at. So naturally, you are looking at much lower liquidity or savings flowing from abroad into India. So the natural equilibrium of interest rates actually has to be higher than lower. And the third thing is that the currency is weakening. That is also inflationary. And right now, transmission might be perhaps a little bit difficult, as credit deposit ratio has been inching up. It's around 80.2 right now. And we should remember in 2019, when we were cutting rate, injecting liquidity, the credit deposit ratio was around 75. It went all the way below 70 during the pandemic, and then it went up all the way above 80. And now we're also again above 80. And this is a busy season. Wholesale deposit rates are any which ways going up. So I think the focus should be 83 basis points of transmission has happened on the lending rates, on the fresh lending rates as of now. The remaining can be transmitted through, more open market operations or swaps, or the way RBI wants to inject liquidity in Q4 in order to ensure transmission. And if, inflation and growth forecasts do hold true later on, if growth does slow down, they'll have room to cut, because inflation any which ways perhaps will be lower on the lower end, as we are revising it lower any which ways every 2 months.
Okay, no. So what's your bottom line? Cut or no cut?
No, I think we think they can avoid a rate cut right now and do it later if need be. Okay, no need to do a rate cut right now.
That is, I think, two nays. I don't know where to put Sakshi. Yes or no, Sakshi?
I think, Lata, that they should cut the policy rate.
Okay, so that's 2:1 in terms of a cut. It will be a divided house. We must remember that it's a fairly dovish Monetary Policy Committee. They seem to have gone along with the no action last time only because the Reserve Bank said there is place. So it's quite possible that the majority forces the Reserve Bank's hand, but it's going to be a very, very difficult communication. But the more important question to ask is whether India's potential growth itself is higher than we are all estimating. Remember China in the 90s, when they were harvesting their demographic dividend, were producing over 10% growth. Maybe we are in the 8% threshold and we are unable to believe that we are so good. That question to my economist panel after the break. Welcome back to our very special Indianomics on the GDP numbers that have just been announced for the second quarter. It's a stunner at 8.2%, but the nominal GDP makes us a little more humble. The number comes in at 8.7, a tad lower than the 8.8 that the economy scored in Q1. That has its own implications, of course, for corporate earnings and for the government tax collections. I've been speaking with economists Kaushik Das of Deutsche Bank, Sakshi Gupta of HDFC Bank and Sameer Narang of ICICI Bank. Gentlemen, and Sakshi, thank you very much for your patience. Sakshi, would you believe that, we have to perhaps wake up and say that this economy is growing faster than we thought? That the potential is actually maybe north of 7?
Well, Lata, not to get biased by recent numbers, I still do believe that India's potential growth is perhaps close to 7% at this stage. Look, we have to look at a number of indicators. In my recent report, I, look at capital productivity across segments and, at the aggregate level. So yes, capital productivity for us has gone up, right? But a lot of that improvement is coming in, sectors like, power, construction, services. I think the manufacturing sector has actually seen a worsening of productivity over the last 5 years. Combine that with the fact that your labor productivity, I think over the last decade at an aggregate level, of course, there will be sectors that would be doing better, but labor productivity also hasn't improved much.
Okay.
Right. So I think that just from that fundamental perspective, I think that, yes, there is potential for us to kind of improve and move from the 7%.
You have to wind up quickly. We're out of time.
Yeah, potential growth to 8%, but I don't think that we are there yet, just based on these productivity metrics.
Okay. We have only a couple of minutes left, and I want a poll on where you all see Q3 and full year GDP. So let me first do the poll and then get to other questions. Kaushik, what's your Q3 and full year number?
So we have Q3 at 6.5, and for this year we have 7%. Next year is at 6.5.
But would you be revising after looking at this number?
I have to see the details, Lata. As you know, the discrepancy portion, whether it has subtracted or added, how much CSO could explain. All net exports, you'll see, has subtracted a lot from growth, with imports being much higher.
Yeah.
So how much CSO has been able to explain out of that C plus I plus G, and how much, net of discrepancy, how much is the growth, all that goes into,
No, I agree with you. Actually, discrepancy is high, and so is the net exports that has to be subtracted. So, yes, you'll have to do your math. Sameer, where are you standing for Q3 and full year?
I think Q3, we will revise it higher, given consumption is very strong, so around 7. And Q4 will be around 6.5 because of the fiscal compression. So the overall year number should be 7.2, 7.3.
Okay.
That's the back of the envelope calculation, but we come with detail.
Okay, so 7.3. Sakshi, your full year number?
So for the full year, currently we're at 7.2, but I'm going to revise it higher after this GDP number. So I think it will be closer to 7.3, 7.4.
So you may be at 7 even for Q3.
For Q3, we are at 7, slightly higher than that, given the momentum we've been seeing.
I just got about 30 seconds for Kaushik and Sameer. Kaushik, would you agree that maybe we have to rethink the potential of the economy?
No, potential growth rate, we always calculate, at 7% when we do all this Taylor rule formula calculation. What I can say is that after COVID, we felt that the potential could have fallen to 6.5 or lower, but that has not happened because of government supply side reforms. So I think 7% is a good number to work with. As Sakshi said, don't get biased by just the few last quarter's numbers. And remember, once we get the new GDP series with all this calculation, all this discussion will gain more traction. So at this moment, 7% is a good number to work with.
Fair enough. Sameer, you get only about 10 seconds. Would you believe that India's potential is higher than we are estimating so far?
No, as of now, it's 7. But if we can get our exports going, it'll be 8.
Okay. Well, at the moment, that's the difficult part, whether we'll be able to get our exports growing at all. But let's wait to also see whether all these numbers get modified seriously when the new GDP series comes out on February 28. Sakshi, Sameer and Kaushik, thank you very much for enlightening us and reading through the numbers, reading between the numbers. The GDP, second quarter GDP is a stunner at 8.2. On that note, we wrap up on this edition of Indianomics. Thanks for watching.
Hello and welcome to Global Eye. I'm Parikshit Luthra. Now to the big story from the United States. One of the National Guard members targeted by the gunman has died. US President Donald Trump said in his first live remarks since the shooting, while the other Guard member remains in critical condition. Soon after Trump took to Truth Social to announce a new immigration stance, he said he would permanently pause migration from all third world countries to give the US system time to recover. He also said that the US will aim to end federal benefits for non-citizens and significantly reduce what he referred to as illegal and disruptive populations. This followed reports that the suspected shooter is an Afghan national who came to the US under temporary immigration status during the Biden administration and was later granted asylum. In response, US immigration authorities have suspended all immigration processing for Afghan nationals pending a full review of vetting protocols. Additionally, the administration has ordered a re-examination of all green cards issued to immigrants from countries of concern. Meanwhile, US missions around the world are awaiting guidance from the White House and the US Department of State before implementing any changes. And it is believed it may take a few days before new instructions are issued. At present, routine visa services appear to be operating normally. In today's discussion, we'll explore what these developments could mean for India, especially since the number of Indian nationals apprehended while trying to enter the US illegally has hit a 4-year low. And also in 2025, the US reportedly deported over 2,700 Indian citizens. Listen in.
Suspect is an Afghan national flown here by the previous administration, who was such a bad administration. And I have a picture of a plane. This is what it looked like when they came in. It was total bedlam. Do you remember that period of time? Total bedlam. People crammed onto the plane. We have no greater national security priority than ensuring that we have full control over the people that enter and remain in our country. For the most part, we don't want them.
And joining us now to take this discussion forward is Ambassador K.C. Singh, former diplomat and strategic affairs expert, and Naveen Chopra, chairman with NN Chopra Consultants. Thank you very much, gentlemen, for joining us. Ambassador K.C. Singh, let me go across to you first. Could you give us a sense of how this is going to be accepted by countries around the world? Now, this is a very sweeping remark that President Trump has made, that he's going to pause migration from all third world countries. How is he going to do that, and what will be the impact?
Well, President Trump, I don't think he cares what other countries are thinking about his policy announcements. We've seen it with the tariffs, completely without any basis, rationale. They kept going up and down depending on whether he likes a country, doesn't like it. So this announcement, everyone will sit back and wait. With Trump, you don't know tomorrow morning. He may moderate it. He may worsen it. We don't know that because he's actually picked on the wrong case. The Afghan who's done the shooting was a US collaborator in Afghanistan. He was working for CIA. And there was a danger that he might be repatriated. If he was sent back to Afghanistan, having been a collaborator, he'll be probably killed by the Taliban. So he's choosing between jail in America to death in Afghanistan. Now, instead of singling the case out and saying, let's not send people back to dangerous places, he's stepped down on the gas because his own rating is down, his popularity is down. A number of midterm elections have shown that the mood has turned in the country and the economy is not doing too well for all his protestations. So he's picked on one issue on which he's been rating reasonably high, which is immigration, which also, because of the way the ICE agents have been going after people. The other day, they picked on a relative of his own White House spokesperson. Now, if that, to distract from that, he's gone on to this. I think it's more for domestic political reasons than for any impact, because in fact, what has come out is that jobs have not increased in America over the last 9 or 10 months of his presidency, because immigrants going out is not helping Americans get jobs. It's just slowing the economy down. And then Trump himself a few days ago said that H-1B visa is fine, even though his base were unhappy. He realized that without those educated workers and skilled workers coming in, US economy will be impacted. So we really don't know what he means. Is it only for domestic consumption? By third world countries? Is he only going to pick on countries which are seen as having terrorism or being anti-US or having regimes which are anti-US, Iran, Afghanistan, etc.? Or it's across the board? We don't know. I doubt it. I don't think he can do something across the board. Yeah.
Ambassador Casey saying whatever the outcome may be, and understanding that we've got after speaking to multiple sources, that it will take some time for a guidance to flow from the White House to US missions around the world. No one really understands at the moment what his tweet or Truth Social post means. But just the sentiment, just the optics of it, do you think this is going to push the emerging countries further away from the United States?
Further away from President Trump. I don't think they'll be pushed away from the United States. They're all waiting for the midterms, another about 13 months. And they think if the Congress transfers from the Republicans to Democrats, or may even happen before that, because there is one Republican member who's resigning. There's another race which is very close. So things are not looking very good. I think other countries are watching. They've got used to it over the last 10, 11 months. If you don't react immediately, this is Trump. He will just come out with a sword and go waving it around. Don't get in his way. But in the meanwhile, just wait and see when he gets tired and sits down.
All right, let me go across to Naveen Chopra. Mr. Chopra, what's your sense of things right now? We have seen, ever since the Trump administration came to power for a second time, we've seen curbs on legal forms of migration, the scrutiny of applications going up. Now, in the run-up to this announcement that he has made on Truth Social and Twitter, have visa processing started slowing down for all categories? Are some of the people that you deal with, do you see people having issues getting their visas or going through visa formalities at US embassies?
Trump has, in his first term as well as in his second term, and second term probably magnified it, been playing emotional cards, essentially aimed at the base that he has, which largely consists of Anglo-Saxon whites who are essentially, the large proportion of them are school pass-outs or school or 10th class pass-outs. His support amongst the college educated did rise in this last election, but that is also not the larger chunk. And in terms of most of the policy announcements that he's done, it is done from that perspective. I get an impression, and I would say without prejudice, I get an impression that if you look at the history of Trump and his growth and the way that he has treated his own people in his businesses and stuff, that he essentially has a racist mindset where non-white-skinned people are anathema. Although he has employed a lot of them, he is using a lot of them, but that's also from the realization or stemming from the realization that skin pigment doesn't equate brain power, and the brain power right now is residing amongst the a large proportion of it resides amongst the Indians and the Chinese and the Asians, because our guys, from an education perspective, education is very core and central to every parent. Children are motivated and pushed to get themselves educated. They work hard. They get themselves educated, which is the consequence of which they are in every aspect of American life, from NASA to Microsoft to Google to the government to doctors, professors, and so on and so on. Now, these people become successful. They earn good money. They're also good business people. There are lots of very, very successful Indian businesses in the United States. And they are the ones who are driving the fancy cars. They are the ones who are having fancy houses and moving into high-end suburbs. And this is causing, particularly amongst the base. Now, as far as the visa story is concerned, yes, it has impacted. Yes, there is. I would not call it a loss of interest. I would call it a slowing down out of apprehension for what is to maintain them. But I'll tell you, I kid you not, that the American dream is still the big one. Okay, even now, anybody who's going to be able to get into the United States is going to get into the United States, because even now, Trump withstanding the amount of opportunity that
Mr.
exists
Chopra.
in the United
Yeah, Mr. Chopra, you're saying that the American dream is still intact for many people all across the world. Having said that, among the people, the clientele you deal with, are people wanting to go to Canada or United Kingdom or Europe for that matter, considering the kind of changes, the volatility that we're seeing in the United States?
Yes, there is a shift also towards United Kingdom, Australia, New Zealand, Ireland, Europe. European countries are coming into focus. Germany is very, very big right now. But when it comes to the United States, the elite or the wealthy individuals increasingly larger numbers, and this is very quiet. I can't give you any data, but larger numbers are going in for the EB-5 route, where they invest into the United States and they get a family, a green card pretty much straight away, and that route is still being open. They have not shut that route down. I think there's a lot of optics going on out here, and I also, from experience, 30 years of experience in the global education student mobility market, I have seen multiple cycles of countries clamping down on because of this local, Anglo-Saxon, primarily the Anglo-Saxon sentiment, and then having to open up because there's not enough people to do the essential jobs. This has happened 3 or 4 times with Australia. It has happened 2-3 times with the UK. It has happened now big time in Canada. And of course the United States is the first cycle. So it's cyclical, and you are absolutely right. My colleague on the show was making this observation that waiting for the midterms. Yeah, I mean, there seems to be some churn happening, and the midterm could spring surprises. But having said spring surprises, you need to consider both sides of the equation. If Trump gets a majority in both houses, he'll change the constitution.
That's true. My final question to Ambassador K.C. Singh. Ambassador K.C. Singh, how should India navigate these challenges? We're still not there when it comes to the trade deal or an agreement to set aside the tariffs, the high 50% tariffs. What should we do? How should we speak to the Trump administration? We're already doing that relentlessly.
Look, unstated, when we do the trade deals, unstated is always the issue of migration. When we're doing it with Europeans, we're taking it up. With England, we took it. UK, we took it up. We say this is like trade. It's not just goods, services, goods, and then people migration. That's all part of a larger, complex arrangement. And you can't say, no, I will not take your people. I'll just take your goods, or I'll use the services. So this would be very much there even with the Americans. So it's a bit of a setback, because you can't see doing a trade deal with America if they clamp down on visas, and even legitimately, people who are legitimately wanting to go to America, you block it. It's not going to be helpful. But the Indian government, I think they will do what they've been doing for the last 6-8 months, which is at the political level, you remain quiet. You will have your spokesman just say, we are unhappy with this or regret it, or we hope they change it. They'll watch for a few days, and then after that, we'll have some kind of a statement. But behind the scenes, I'm sure Mr. Goyal will have to take it up and say, we can't have a trade deal if we're going to be behaving like this, because this is part of the deal. Movement of people is part of what we negotiate.
May I say something?
My final answer. Yeah, please go ahead, Mr. Chopra.
Well, I mean, I think that, Trump is a slightly simplistic mind to my way of thinking. I think he should be told that, look, we have 1.4 billion Indians, and one soap a month equates to 1.4 billion soaps. Now, do you want access to this market or not? I think, we should play tough with it. And we should buckle down. We are largely an inward-looking economy. We are, that's why we didn't suffer too much from the global shock. I don't think that we should be scared. I think we should buckle down. We should look for other markets aggressively. I know this, that if you let the Indian businessman loose, remove the constraints on the Indian business community, they will go and win the world for you. If they are not doing it, it's because of the internal constraints that are placed through all the kinds of rules, regulations, and stop this, can't do this, can't do that, go here, don't go there.
Right.
You remove those constraints and they'll win the world for you. I absolutely...
The only problem is, Mr. Chopra, you're right, and Ambassador K.C. is saying both of you have made some very strong points, but clearly all the problem also is he's being driven by politics. To what extent Will this continue motivating him? That remains to be seen. But of course, India will have to be ready for all scenarios when it comes to President Trump in the White House. That's all we have time for with Mr. Chopra and Mr. Singh on this segment. We're moving on, but we'll be right back after the break. We will be talking about Russian President Putin's visit to India this December for the annual bilateral summit. And it's very significant in terms of our overall strategic ties, energy ties and defense ties as well. We will be discussing this with Professor Amitabh Singh from JNU and Nikita Mentkovich from Eurasian Analytical to discuss Putin's visit. Welcome back to Global Eye. Russian President Vladimir Putin will visit India from December 4th to December 5th for the annual bilateral summit. The visit, first announced during National Security Advisor Ajit Doval's trip to Moscow in August, has now been formally confirmed by the Ministry of External Affairs. President Draupadi Murmu will host a banquet for Putin. The Russian president will also hold talks with Prime Minister Modi to review bilateral progress. Ahead of the summit, External Affairs Minister S. Jaishankar met Putin in Moscow at the SCO Heads of Government meeting and held talks with his counterpart Sergei Lavrov to finalize preparations. Meanwhile, Putin's aide Nikolai Patrushev met Prime Minister Modi in Delhi to review the summit agenda. This year's summit is significant as it marks the 25th anniversary of the Declaration of Strategic Partnership between Russia and India. This is also Putin's first visit to India since December 2021. The trip comes at a sensitive time with rising global tensions and US President Donald Trump pressurizing India to scale back ties with Moscow. PM Modi last met President Putin in September on the sidelines of the SCO summit. The two leaders even spent 48 minutes in Putin's limousine before heading to their bilateral venue. PM Modi said India and Russia have always stood shoulder to shoulder, even in the most difficult times. This meeting took place just days after Trump imposed a 25% additional tariff on India's Russian oil purchases. As per data from Kepler, India's Russian oil imports are expected to rise over 1.8 million barrels per day this month, the highest since July. Reports suggest this might be because refiners rushed to stock up ahead of US sanctions on Rosneft and Lukoil that took effect on November 21. In FY25, two-way trade touched a record high of $68.7 billion US. India's exports were worth $4.8 billion, while imports from Russia amounted to nearly $64 billion. During the summit, India may push for a follow-on order of S-400 air defense systems. In 2018, India signed a $5.4 billion deal for 5 S-400 batteries, 3 of which have been delivered so far. Russia has promised to deliver the remaining 2 in 2026. The country has reportedly offered India the full production and technology transfer of Su-57 stealth fighters. However, India is yet to make a decision. Joining me now to discuss this further and what this means for India is Amitabh Singh, Associate Professor at JNU, Center for Russian and Central Asian Studies, and Nikita Mentkovich, Director, Eurasian Analytical Club. Nikita, if I can ask you first, what will President Putin and Russia be expecting from this visit, which comes under the shadow of US sanctions and immense pressure from the United States to reduce the partnership with Russia?
I think we should forget about United States and those demands. We are 2 independent states. It is our business how to keep our ties strong and how to cooperate. That's why we should ignore American position. I think during this dialogue, our leaders should discuss economy, defense, and other problems which can be solved by 2 of our countries. In fact, Russia and India are allies. More than 100 of Indian citizens are volunteers fighting in Russian army, liberating Ukraine from fascist regime and American occupation. I think that we should strengthen our ties in economy, up our trade, build new transport ways, and keep our ties stronger. Of course, United States wouldn't like it.
Right.
But United States do not like a lot of things at the world. I think we just should forget about Mr. Trump and what he like or dislike. It is not his business.
All right.
It is our life.
Okay, I'm going to return to you. All right, I'll come back to you shortly. Let me get in Amitabh Singh very quickly. Professor Singh, what do you think India would realistically want to achieve from this visit of President Putin? Very critical. Russia is an age-old, decades-old defense partner. We've got multiple defense, legacy defense equipment for which we need Russian support for maintenance, service and parts. We would want our Sukhois to be upgraded as well. What do you think Prime Minister Modi would want to achieve in terms of continuity?
India has been partners with Russia for long now, and they are the most trusted partners when it comes to our defense hardwares, our defense supplies, and it has gone on for years, not only at the level of defense, but also at the United Nations level in supporting our demands at United Nations, supporting Kashmir issue, and many things like that. This visit will be different. I would say different in the sense that this is happening after 4 years that Putin is coming to India. This is happening when the Russia-Ukraine war is on. This is also happening when likely solution to Russia-Ukraine war is on the table of both Russia and the West. So the expectations of India at this time is many. One of that is the confusion that was caused by the oil supply being stopped because of the sanctions on Rosneft and Lukoil. India would like to do away with the confusion that has prevailed, that it was not India, but the sanctions that has been imposed on Indian companies. That has led to a decline in the volumes of oil that we were importing. The second thing is that India would like to strengthen the defense partnership that we already have. Remember that 70% of Indian military hardware is dependent on Russia's supply. So we are also looking, and you rightly said, a follow-up on S-400 missile batteries. Maybe we'll demand or we'll expect Russians to supply us with newer generation S-500 missile batteries. So these are some of the agenda that we have. The major and different agenda this time would be that we are likely to sign labor mobility pact, in which the skilled labor is likely to get more access to Russian markets, because already after COVID and of the Russian-Ukraine war,
that's an important point.
Yeah, that employable people has been dwindling in Russia.
All right, labor mobility agreement between India and Russia would be important. Nikita, when it comes to expanding the partnership beyond energy, beyond defense, what are some of the other areas that President Putin may want to focus on?
I think we have a lot of economy topics to talk about. It is oil, it is gas, it is transportation, it is medicines. It's possible for cooperation between our industry. Of course, I think our leaders should discuss production of Russian weapon for the Indian army. A lot of our machines are effective enough. For example, C-400s are very demanded by Indian army to defend national borders. I think there are a lot of other possibilities to dialogue, including space investigation or other possible topics. As I said before, India and Russia are allies, so we have a lot of topics to deal with.
Okay, we've completed our time, but thank you very much, Amitabh Singh and Nikita Menkovich, for joining us on the program. It will be a very crucial visit of President Putin this year, and the United States will be watching it very, very closely. That's all we have time for on Global Eye. Goodbye, and thanks for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty gained for the third straight week, but the gains remain limited even as the benchmarks touch new lifetime highs. Midcaps outperformed the blue chips, with financial stocks leading the rally. Commerce Secretary and India's Chief Trade Negotiator Rajesh Agarwal highlights two parallel negotiations underway with the United States, says he is optimistic about a framework trade deal to address the reciprocal tariff challenge by the end of 2025, says talks over a bilateral trade deal will take a lot of time, adds that a trade deal would be beneficial only if it addresses both reciprocal tariffs and the additional penalty levied on India. US President Donald Trump says the country will permanently pause immigration from so-called third world countries. Does not specify which countries will be targeted. US will also re-examine green cards issued to immigrants from 19 countries, which does not include India. Russian President Vladimir Putin will visit New Delhi next week for the India-Russia annual summit. The two-day visit comes at the invitation of Prime Minister Modi and against the backdrop of US imposing punitive tariffs on India for buying Russian oil. All right, let's start with the big headline. The second quarter growth numbers are out. India's GDP grew at 8.2% in the June quarter. This is far higher than what our poll had estimated. Lata Venkatesh here with her analysis. Lata.
Yes, it is a huge number as far as the GDP is concerned at 8.2. Our poll said 7.4. There were several polls on the street with even 7.2. So this is a very big jump compared to what the street was expecting. And I think the big jump has come in manufacturing. Manufacturing has come in at 9.1%. And our poll was not anticipating such a big rise in manufacturing. I'll just give you what our poll said on manufacturing. It said 8.9. They've come in at 9.1. But across the board, even agriculture, it says 3.5. Ours was also 3.5. The important point is the nominal GDP has come in at 8.7. Now, how is it? 8.2 is the overall growth in the GDP. To it, you add the price rise and you get the nominal GDP. Or rather, GDP for about 60% of the items is counted in today's prices. Then you reduce, deflate it by the price rise. The price rise is taken as 0.5%. Most people on the street expected it to be closer to 1%, the year-on-year rise. For you and me, the price rise may feel like being higher, but arithmetically, the WPI, the wholesale price index, has been negative in the past 3 months, that is July, August, September. That is why you calculate the nominal GDP at 8.7% according to the data, and then deflate it and you get 8.2. So only 0.5% inflation has been taken into account. So it's 8.7 nominal GDP compared to 8.8 in the first quarter. The CNBC-TV18 poll was expecting an 8% nominal GDP. In any case, I think this GDP number is way above what the street was expecting. So we should expect a fairly positive reaction on Monday from the markets as well. Manufacturing, as I told you, has come in at 9.1%. Agriculture at 3.5%. The other positive numbers have also been construction at 7.2%. Gross fixed capital formation, something the market will be very happy about, has come in at 7.3%, and private consumption at 7.9%. Remember, a lot of people were expecting consumption to be low in the second quarter, because the Prime Minister announced that the GST will be cut on August 15th in his Independence Day speech, and the cut became effective from September 22nd. The expectation was that people would have consumed less up until September 22nd, anticipating lower prices. But consumption coming in with a strong growth of 7.9% indicates an inherent strength in consumption. Therefore, this is,
3%. And similarly, this lower inflation has been faced both by the producer and the consumer, which has helped to produce and create this conducive growth environment. The only sector which has had a deceleration in this second quarter is the mining and quarrying, which is to be expected given that it was the monsoon season during this period, and that's the cause of deceleration for the mining and quarrying. Next.
Yeah.
So if you look at the services sector, which has really registered a whopping 9.2%, within that, the financial, real estate, and professional services has grown at 10.2%. And some of the specific indicators, if you look at, bank credit growth has grown at 10.8% within that. The IT sector has grown at an 11.5%. So there are sectors within these services which have done even more. And of course, the government sector has done well at 9.7%. Thank you. Next.
Yeah.
In the manufacturing sector, which is also shown 9.1%, this has continued from the first quarter, despite global headwinds. The organized sector, both the public and private corporate sectors, have significant growth. I already mentioned about steel and cements, but garments, automobiles, automobile components and tires, each one of them have registered good growth. And the different interventions done both by the central government and the RBI would no doubt have helped in this. Next.
Yeah.
On the expenditure side, the private financial consumption expenditure, which has a share of more than 60%, has recorded a growth of 7.9%. And we must remember that nearly 50% of the PFC is services, and therefore the consumption of services has also been at that same level. On the gross fixed capital formation, which has a 30% share, too has grown by 7.3%. If you look at construction sector, it is 7.2%. Central government capex has grown significantly at 31%. And while imports of goods and services in general has increased by 8.4%, there's been a double-digit growth in imports of machinery and equipment at 15.8%. And even other services and on consumption side, we look at whether transport and steel consumption, they've all been very, very positive. Next. So I'll just end out here on this, just to highlight the inflation numbers, because obviously there is the gap between the nominal and real GDP growth has significantly narrowed to 0.5%. And that's due to the kind of prices we have seen both for the producer and the consumer. And even if we look at it sectorally, there are significant areas where it's actually been negative. So I'll stop here and Ananta, please go ahead.
Thank you, Dr. Garg, and for setting the stage for my portion of this presentation. Good evening, ladies and gentlemen, friends from the media who have come to this conference. As Dr. Garg has clearly pointed out, we have had a growth rate of 8.2%, which was outside the range of many, even the most optimistic estimates. And that shows the cumulative effect of the policies that are being put in place since the government returned to office in June 2024, including the significant direct tax relief in February budget, and the employment-linked incentive schemes announced and implemented since the July 2024 budget, etc. So that kind of has laid the foundation for continued performance of the Indian economy. I also maintain in recent public appearances that sometimes it's difficult to put a cause and effect in an econometric sense between the supply side infrastructure investment that this government has made since 2014. But over time, naturally, we begin to see the impact, because the supply side investments, whether it is in electricity generation, the length of kilometers of highways laid, the number of airports opened, the improvement in logistics, the reduction in turnaround time in Indian ports, etc. All of these things have removed the supply side constraint on the Indian economy. Bank balance sheets and corporate balance sheets are in good shape. And the digital public infrastructure has also opened the doors for loans to individuals, and the various credit guarantee schemes and schemes like Swami loans for affordable homes and Swanidhi loans, etc., have also channeled credit to hitherto individuals and small businesses that were not deprived of credit. So all of that at some stage begin to percolate down to the real economy and supports the economic activity. So we don't really take cognizance of these measures because establishing one-to-one correspondence between these measures and actual growth rate in a quantitative sense is difficult, but over time they all accumulate, they all add up to create a dynamism in the economy, and that is what we are seeing. And naturally, in a global comparison, we are doing quite well in terms of the annual real GDP growth rates. As Dr. Garg pointed out, the agricultural growth rate was 3.5%. Both manufacturing and services have done very well. And the manufacturing numbers accord very well with the second quarter bottom-up corporate data we have seen in terms of top line and bottom line recovery as well in manufacturing companies. And as the slide shows you, export share is the highest in the last 8 quarters, and the consumption share of GDP is at 62.5%. So India remains an important market for other countries as well, where India's growth actually supports the growth of other countries because our consumption share is high and we continue to import products as well. So in that sense, India's growth is a net positive contributor to global growth as well. And what about the coming quarters and how things look? And that is the next part of the presentation. Agricultural activity remains robust. Rabi, it is driven by higher sowing in major crops such as wheat and gram. So you can see that year-on-year growth rate is 19.9%. Gram is about 8.9%. And all the green color bars are either the same or higher than the bar for for calendar year 2024. The final estimates for agricultural production in 24-25 indicate a record output of food grains led by rice, wheat, maize, and moong. Rice procurement for the current Kharif marketing year has exceeded last year's levels. The availability of inputs remains comfortable. The record high reservoir levels also naturally are augur well for Rabi sowing, which is what we have seen on the left side. Now, how is the momentum in the economic activity looking now that we have 2 quarters under our belt? And as MOSPI's data show, the first half of the financial year have recorded a real GDP growth of 8%. So now we can state comfortably that the full year growth will be either 7% or to the north of 7% rather than to the south of 7%. So there is basically we are saying growth rates will be at least 7% in real terms for the full financial year 25-26. Now, if you look at the numbers for October 2025, e-way bill generation has grown 8.2%, although it is lower than the pre-COVID average, or for that matter, FY 24-25. I think it is still a healthy growth rate. Non-food bank credit, which was in single digits in recent months, has begun to pick up at 11.1%, higher than the pre-COVID average, but below 24-25, but comfortable level of 11%, higher than the nominal GDP growth rate. Electricity consumption was lower because summer months were not that hot and there was excessive monsoon rainfall. And also now we have a fairly early setting in of cooler weather. So electricity consumption is something that we need to watch out, but it could also signal energy efficiencies beginning to come through. And petrol and diesel consumption is kind of growing at rates which are not too far lower than the long-term average and the near-term average, because it also includes the fact that prices have remained stable. So it is entirely driven by volume growth, which is not a bad thing. So overall, I think the picture looks one of steady growth into the third quarter. And if you look at other indicators such as PMI and fleet activity also signal ongoing momentum. PMI manufacturing is at 59.28. Core industries growth rate was flat in October, but in Q2 it was 4.5%. PMI services higher than last year, higher than the last 4 years average pre-COVID. Port traffic is growing at a very healthy rate. Domestic air cargo was down in October. Railway fleet traffic in line with the pre-COVID average roughly. Hotel occupancy rate not yet available. So overall, I think, again, as I pointed out, even in the manufacturing sector, which we saw in the second quarter numbers, backed up by bottom-up corporate data, these indicators can augur steady growth as well. In the services side, we'll come to the fact that merchandise exports were lower year-on-year by 12% in October. I think there is an impact on the of the higher tariff by the United States imposed on Indian goods, and naturally, despite the stellar efforts by exporters to find other markets which have offset the tariff impact, but there is naturally still a residual negative impact, which is what you see in the merchandise export growth rate of minus 11.8%. And the same thing can be mentioned in the case of non-oil, non-gems and jewelry exports, which are slightly better than the overall merchandise export contraction. Total import numbers signal a healthy growth rate, and Dr. Garg also pointed out import of machinery equipment was in double-digit growth. Net inflows in terms of services, again, very positive. Steel consumption, 2.6% in October, but first and second quarter growth numbers were very good. So naturally, there is some sort of consolidation or pullback there. Cement production continuing the good trend of the first two quarters. And the same is the case with the construction and infrastructure goods, which grew at a healthy rate on a quarterly basis. We don't have monthly numbers here. Rural demand remains very resilient based on available indicators. And as the GST rate cuts begin to filter through to the economy, we basically have to make sure that the full impact of GST rate reductions will come through in the data for the coming months as well. Three-wheeler vehicle sales, after 9.8% growth, is recording a 5.9% growth in October. Tractor sales doing very well after two very good quarters as well. So overall, I think rural demand remains resilient. When it comes to urban demand, it is gaining traction post-GST rationalization in terms of UPI transaction growth, passenger vehicle sales, domestic air passenger traffic. These are beginning to recover after contraction in the second quarter, partly in anticipation of the GST rate cut expected after the announcement was made on 15th of August. In terms of investment spending, as Dr. Garg pointed out, the union government's capex grew 30.7%, and the overall investment rate more than 30% in the economy. GFCF, the gross fixed capital formation, if you look at the expenditure-wise data, that is also showing a healthy number north of 30%. IIP capital goods, 5.3%. Similar, more or less in the same ballpark as last year's numbers. Capital goods imports, healthy rate of 5%, and sales of listed private non-financial companies recovered and to an 8% growth rate in the second quarter in the fiscal year compared to 5.5% in the first quarter, and also compared to 5.4% last year. In terms of inflation, October inflation was 0.3%. Food inflation was -5%. We haven't seen these numbers in a very, very long time. Core inflation rate is well below 5%. It's 4.3%. And the Naukri jobs peak index in October showed a contraction after two very decent first and second quarters this year compared to the last year, second quarter, which was very anemic at 1.3%. So overall, I think the employment situation remains steady. Now, obviously, we are also not reckoning with the major economic reform measures and policy measures announced by the government. The repeal of the various quality control orders, which augur well for small and medium enterprises, the relief package for exporters in terms of working capital management announced a couple of weeks ago, including a 5-year plan to help promote geographical diversification of exports. A total package of 45,000 crores was announced for exporters. And then there was the most important announcement in terms of sentiment and psychology for both workers and employers and for job seekers, the government decision to notify the labor codes with rules being framed before the end of the calendar year. These are measures that are meant to create the right balance between workers, job seekers, and the employers, with lots of benefits for workers in terms of codifying the minimum wages, taking care of occupational safety and wellness, etc. It is simple. It is safe, strong worker protection across wages, social security, working conditions, and dispute resolution support. Affordability, because it balances the compliance costs, which are predominantly borne heavily by small and medium enterprises that actually in the past have discouraged formal hiring, and therefore, tilting the balance more towards contract labor hiring. And now that is restored to a better balance and should encourage formal hiring and discourage informalization in terms of reducing compliance costs, because it is the micro, small, and medium enterprises that do the bulk of job creation in any developing economy. Now, there is a mandatory appointment letters have to be issued to all workers. Return proof will ensure transparency, job security, and fixed employment. Social security coverage, all workers, including gig and platform workers, will receive social security coverage, including provident fund insurance and other benefits. All workers to receive a statutory minimum wage payment, preventive health care, employers to provide all workers above the age of 40 years with a free annual health checkup. And it is mandatory for employers to provide timely wages, ensuring financial stability, reducing work stress, and boosting the overall morale of the workers. Women workforce participation, women permitted to work at night and in all job types with equal opportunities to earn higher incomes in high-paying roles. Because one of the reasons behind the low women labor force participation rate in the Indian economy was that several states had restrictions on the occupations that women could actually work in, which was becoming increasingly anachronistic. And those will be now removed, and women will be able to work in all job types and all occupations. Employee State Insurance Corporation coverage and benefits available nationwide. Voluntary for establishment with fewer than 10 workers, and mandatory for those with one or more employees in hazardous processes. In terms of compliance burden, single registration, Pan-India single license and single return, simplified processes and reduction in compliance burden.
welcome to another episode of IPO KYC. We've got Meesho with us, the hottest IPO perhaps of 2025. 1 in 6 Indians shop on Meesho. Let that number sink in. It's become the largest e-commerce platform in terms of orders placed, annual transacting users, 1.83 billion orders placed last year, and the annual transacting users stand at 234 million. Joining us today on IPO KYC on CNBC-TV18 is Vidit Atre, Sanjeev Agarwal. Both of them are the founders. We also have Diresh Mansal, CFO of the company. Thank you very much for joining in. I'm Reema. With me is Mangalam. So let's start by understanding the business model. We know that you pioneered the zero commission model. You don't charge anything from sellers. So how do you make money?
So we actually make money from the services we offer to our merchants. Like number one is logistics. Over time, we've basically built the most efficient, lowest cost logistics in e-commerce in India. And because of that, we're able to make a margin there. And we also make money on advertising. So our sellers now have like ad products to basically promote their listings across the platform. And when they use those ad products, we get paid. So these are the primary ways of how we make money.
And what's the split between fulfillment versus advertising to your top
So
line?
we don't share that split. We haven't disclosed that in the RHP.
But broadly, it would be more fulfillment, logistics?
Yes, definitely. It's
More than
more
50%.
fulfillment, yes.
Right, guys, welcome to the stock markets. Now, everyone will be asking you the more important number, which is beneath the top line. It's the operational profit and the net profits. Yes, you guys are contribution positive. Your business is growing fairly well at a 28% clip year on year. When do you turn profitable on an operational basis and the net profit basis?
I think in terms of profitability, the most important metric that we optimize for is free cash flow. Like if you look at any company, it's actually valued at the net present values of the free cash flow generates over the long term. So instead of any other operating profit metric, the most important thing for us is free cash flow. If you look at the last 2 years, we've been free cash flow positive. And I think that will continue to be a focus area even going forward. We always take a very long-term view of our business. We believe we can keep growing our business at the right pace while being free cash flow positive. We'll kind of generate the right value for our shareholders in the long run. So that's our big focus area.
I was just trying to understand. So over the next, say, 3 to 5 years, at what rate will your free cash flow increase or grow?
Again, we don't make those projections here, but we believe as the business keeps growing because of our asset light, capital efficient model, it's not that we have to invest a lot of money in capital investments or in working capital. We believe it should keep growing as the business keeps growing.
Your adjusted EBITDA in H1 is 551 crore as a loss, which is more than double of the whole of last year. Can you explain what led to the widening of the losses?
I think a big focus area for us this year was we saw our value proposition becoming much, much better. And because of that, we saw our payback periods were quite attractive for a lot more customers. So you would see for the first 6 months of this year, we grew at a very fast pace.
Much more than what you've done earlier in the last 2 years as well. What caused that?
I think over the last 2 years, our value proposition became much better. With Valmo scaling up, our costs went down.
And you had the IPO on your mind as well?
Actually, it's not that we do anything for an IPO. If you see, just for the last 2 years, our FY25 growth was faster than our FY24 growth, and then 6 months are faster than the last year. So it's a consistent story for now about 24 months. And if we feel like the payback periods continue to be attractive, we will push the pedal and want to grow to a long-term steady state annual transacting user base sooner than later. So I think that...
How has your customer acquisition cost moved over the last few years? And how has your customer payback period come down over the last few years?
So if you look at 3 years ago versus where we are today, the cost of acquiring a customer for us has come down quite significantly. Most businesses, if you look at it, cost of acquiring customers only increases as time passes because it becomes harder to go deeper and deeper into the customer base. But like Vidit mentioned, we have been kind of making our value proposition for these customers better, improving the affordability of the products that we are selling. And that is leading to the cost of acquiring customers coming down, payback periods kind of reducing.
Sanjeev, will you all continue to push the pedal on growth? Because H1 growth is higher than the growth of last year. And I was just reading from the RHP, the spend to convert a new consumer declined between FY23 to FY25 by about 27%. But in the first half of the year, it increased by 52%, which means you're making a very conscious effort to get more customers. Your cost of acquisition seems to have gone up, and even from the fresh issue, more than 1,000 crore is on marketing and advertising. So clearly, as you said, there is an intentional push to drive growth, which we saw in first half. How long will that continue?
I think as we continue to make our value prop stronger and as we continue to innovate across different cost headers in the business, right? We continue to make the business model more efficient across logistics cost, other types of cost. We continue to invest in AI as well extensively as we continue to go deeper in India, right? Like it's also important to make the shopping experience extremely simple. And as we continue to just make the platform better, I believe that's the right thing to do for the business. As long as your customer acquisition costs are within the expected range, it's always good to get as many customers as you can sooner than later.
I just wanted to understand from your standpoint, how opposed are you all to actually introducing something like a platform fee? Because just mathematically speaking, you guys, last year did what? Close to around 183 crore orders that were placed. This year, first half, you've done nearly 125. You annualize that closer to 280 thereabouts. Even if you charge a 1 rupee platform fee, that's straight 280 crores to the EBITDA. Why are you morally opposed to that? Or are you?
I think we are actually, and I would say we've been a very, very customer-focused company from the beginning. And we believe it takes a lot of effort to earn the trust of your customers. And anything which basically goes against some of those principles, we will not do. There could be many ways of making a lot of money in the short term, but if it trades off with some of our principles, we actually don't want to take that.
But you're not profiteering out of them. It's a platform that you're providing them, and it's a legit service that you're providing them.
I think, again, that's the thing, right? Like if you introduce something at the end to a customer and they come onto your platform, they look at a particular price and they suddenly get a surprise at the end, it can that's the thing, right? Like it's the trust. You can't put a number to the trust. Like at what number do you break the trust and at what number do you not break the trust? I think some of this comes less from A/B experiments. It comes a lot from principles, right? Like that you believe in. For the longest time, we've been very, very, people always believe for the longest time that at some point in time we will get rid of zero commission. They said, hey, why don't you make some, X percentage? And we never did it, right? And same thing holds true here. I think it takes a lot of effort to earn the trust of your ecosystem, and we want to make sure that trust stays, right? Because that's the only way you will create value in the long term.
So then that brings me to the next couple of questions, which is the Horizon 2 that you're talking about. Over the last couple of years, your content creation business has zoomed. Your share of logistics coming in from Valmo, 65%, that surged as well. But you guys are working on some more products as well. What are these beyond Horizon 2, say 2-3 years from now, products which you all are betting on will be as successful as the last two?
So I think let me talk about one of them, which is around financial services. So if you look at overall, India in general is quite underserved in terms of financial services products. A lot of people are trying to serve the top 20, 30, 50 million people, but beyond, I don't think it's a big focus area for a lot of people. Now we have a lot of data for consumers as well as businesses beyond that segment. So we are trying to kind of create a platform where consumers as well as sellers can get access to these products from regulated entities. We see very, very good early results so far, but again, it's still in the early stage with H2. Sanjeev, want to talk about some of our investment in AI?
continues to be a big focus area for us as part of Horizon 2 initiative. And specifically, if you look at e-commerce experience, the shopping experience, it hasn't largely changed over the last 2 decades. It's a list of static product images, some short videos now through content commerce, but it's broadly that. Versus if you look at offline shopping experience, it's a lot more engaging. So we have already built capabilities in the core business where we have automated large part of our customer support chats, decent part of our customer support voice calls as well. We plan to use the same technology, make it better, and help new users navigate through the app and make the shopping experience a lot more conversational in nature. So that continues to be a big focus area for us. Along with this, we also want to kind of continue to upgrade our ranking and recommendation models. It's extremely important for us. 75% of the orders today comes from ranking and recommendation feeds. So we continue to upgrade it to state-of-the-art models and continue to innovate there to make, again, experience much better for our users.
Just in that itself, you are earmarking around 480 crores to be invested into employee expenses for your AI and ML tools. What kind of math have you done here on increased productivity, increased revenue, and more targeted sales or reduced customer acquisition costs because of your investments in artificial intelligence? Do you have any data so far?
No, see, I think we see AI helping us improve efficiency across the board. So if you look at customer acquisition cost, like when you get a customer on board, you want that customer to find the best products as soon as possible so that you can get that customer to transact quickly and then create that delight and that good consumer experience, right? So we're going to invest in AI to improve this entire funnel. On the productivity side of our employees itself, on the engineers, for data scientists, for AI engineers that we have, like everywhere you now see.
Give us some proof of concept, any anecdote that, this is what has happened because of our investment in AI?
So if you look at Indian addresses, specifically in small towns, like they're not very structured. So they don't have a flat number, they don't have a street name in many cases. It's a relative way of describing address. 300 meter. Exactly, you understand that. So we have built a Geo India LLM, which understands this and converts it to a location on a map, which then means that as we continue to acquire more users in deeper parts of the country, we are able to deliver to them where nobody else is able to.
Do you have a target revenue mix? How much comes in from marketplace? How much comes in from new initiatives? Because right now, nearly everything comes in from marketplace.
So what happens is whenever a Horizon 2 initiative graduates to become, let's say, something scaled, like for instance, content commerce or Valmo, then it moves into the marketplace overall numbers, right? Horizon 2 is to kind of describe that, hey, these are the parts of the businesses where we are continuing to invest behind. And then as soon as we feel that now they've reached and the proof of concept is kind of established, then we move that into the core marketplace.
So what's the metric to decide that? Is there a number?
So it depends on different kinds of businesses. Like financial services, for example, will have something around risk rates, adoption, retention. AI will have different metrics.
So is that ARR, stay for fintech?
So I think revenue tends to be just one thing, but as Dhiresh said, you want to look at everything else, right? Like you want to look at, are the consumers liking it? Is the retention very good? And once we feel comfortable with all those metrics, then it graduates into the marketplace bucket.
And in your opinion, how long will it take for fintech to, just as an example, to graduate from Horizon 2 to 1?
Again, it's hard to predict. Like we obviously would want it to happen as soon as possible. But like we have also seen, if you try to be impatient, you tend to kind of scale things in the wrong way.
sense on, how much efficiency Valmo has got to you? Because from practically nothing a few years ago, it's now 65% of your overall business. That's unfortunate for another listed company like Delivery, but great for people like you guys. How has that impacted your cost of operations? How has that improved your business? And how much further do you expect this to go?
So if you look at the trajectory of the cost of doing business for our sellers over the last 3 years, in FY23, it was about 51 rupees kind of variable cost that we attribute for a placed order, which had come down to about 43 rupees last year. So there has been clearly a reduction, large part kind of driven by what has happened with Valmo and the optimizations that we have been kind of be able to do there, build it into a marketplace format, which no one else has done in India before. So I think we'll continue to be on that journey where we find more efficiencies, optimize. There's still a lot more to do. We've also described it in our RHP, like India's cost today of logistics is still much, much higher than any of the other emerging markets, and there's a lot more to do, which we are trying to do with Valmo.
Okay, so profitability will continue to scale up as Valmo's contribution goes up from 65 to say 85-90%. The other Horizon one is now content commerce, and that's about 1,200 crore in terms of the annualized run rate. What's the headroom that you see here, and what are the kind of margins you enjoy on this?
I think that business is still the newest part of our business and hence growing very, very fast. If you look at today, the problem that it solves is India had lots of influencers who had big following, lots of views, but they did not know how to monetize that following. Yeah. And on the other side, we had a lot of these merchants and sellers who said, hey, I can never participate in the influencer economy because why would they create content for me? I have no access to them. Big brands have access to them. We basically platformized it. And now more than 50,000 influencers are able to make consistent income through our platform. And a lot of our sellers are able to get their products promoted through them. So I think it's just the beginning. Like 50,000 influencers from an overall ecosystem perspective is still quite small.
And you don't take a cut from that?
Yes, so basically it's built as a platform. So every merchant decides what they're willing to pay to an influencer to get their product promoted. Influencers that come and see on the marketplace, hey, for this product, the seller is willing to pay me X, for this product, someone else willing to pay me Y, and they then choose which product they want to promote. So it's built purely as a marketplace.
At what point does the average order value, which is now 265, 270, hit a trough? It can't keep going lower. So what's in your assessment?
So I think, like Vidit mentioned, first of all, on all of our orders, be it low-priced orders or high-priced orders, we actually make positive contribution margin, roughly similar contribution margin. So for us, it's a lot more about how to mimic the behavior that consumers have offline. If you look at India, most consumers transact very frequently in small amounts because that's how their own sort of cash flows are, and that's how they have been consuming in the offline world as well. So as we make more and more price points affordable by reducing the logistics cost, this number might come down, but we will still be profitably serving those orders. And it should mimic how India consumes in some sense. We don't have a specific forecast on that.
So what are your contribution margin levers? Because the first half of this year it's been about 3.8%, the last year was around 5%. How do you grow from here on the contribution margins?
So I think the philosophy there would be that the ad revenues, which are still much lower for us in relation to how the overall sort of emerging market base is, those will continue to grow. If you look at most other emerging market e-commerce platforms like Apindyodo or many others, they have seen much higher growth of ad revenues, and a lot of those ad revenue growth comes when the platform is much larger, the annual transacting user base.
You are already the largest, come on. You have to increase that a lot more.
Yeah, but I think the scope that we have from a headroom perspective is also quite large. So I think on that, we will continue to have larger ad revenues, which will be the key driver.
How much is it as a proportion of your overall revenue right now?
So if you look at the global benchmarks, this will be somewhere around 5% of GMV levels, right? So
yours is lower.
Ours is lower.
What are the steady state contribution margins you're aspiring for?
So I think it should be closer to where the global benchmarks are.
That
I
is?
think
mid-single digits?
Global benchmarks tend to be about 8 to 10% of kind of NMV. So it should be in those lines.
And what value have you left on the table for people? I have to ask you this because it's 5x sales. Yes, you would say, okay, Eternal is 13x, you have Swiggy, which is 6x, Nykaa is about 10x. all the others are around 9x, you are closer to DMart, but then you're nowhere closer to DMart's profits as well, right? So at 5x sales, how much value do you think you've left on the table?
So I think our objective has been to, first of all, get the right quality of investors as part of the IPO. We have been a private company. Now when we are turning public, I think the foremost objective that, let's say, with it, Sanjeev, the board had was that how do we get the most high quality long-term shareholders into the mix, be it domestic investors, foreign investors, sovereign wealth funds, etc. And at what value are they, attracted to the offering? And that's been the defining function. So when our bankers kind of presented to our board saying at this valuation level, most people are comfortable, and then the board kind of took that on as advice and agreed on this valuation. So we believe it's an attractive one, and we'll see it play out.
You're closer to 10,000 crores. The rate at which you're growing by 2029, you should be 20,000 crores on the top line. Would you be EBITDA profitable by then on a reported basis?
Again, we don't share forecasts.
But are we thinking in the right direction?
Again, I'm saying I don't think I'm going to give you anything there, but as I said, directionally, we will continue to kind of grow very fast. Our focus is to kind of keep expanding our free cash flows. That will continue to be our focus.
If you had to double one metric overnight, which one would it be?
I would not be able to take. I
Sanjeev,
think
you want to?
No, I think it's the same answer, of course.
He would probably say ad revenue.
I think all metrics are important for the business, right? It's a platform business. So unless you optimize for all the metrics, it's just not possible to move the platform in the right direction.
Sure.
What's your immediate job post-listing?
I think a big focus for the next 12 to, I would say, 24 months would be to earn the trust of our new shareholders, right? Like we want to make sure that we have always created value for our existing investors. That's why you see that they've stayed with the company for a long term. And we want the same thing for our new shareholders once we go public. How do we communicate well, we set the right expectations, meet them, and do it consistently over the next 12, 24 months. I think that's a big focus area. If people trust us, they will let us do the right thing for the long term, and that's the right thing for the business.
What's the one tier 3 behavior that surprised you recently?
I think, for example, one of the things that we see, and which is why we also started to focus on financial services, a lot of people believe that cash on delivery is a payment product. But for some people, it is a debt product. They are actually trying to manage their cash flows. Hey, if the product takes a few days to come to me, I want to use the cash of that day to buy the product that day, right? So indirectly, they're using it to manage their cash flows. They have access to the UPI app, but they're still using it this way because that's a typical Indian behavior. Buy in small amounts every single day with the income you make that day. Which is why we realized a big focus for us has to basically solve this problem for them. And we started to work on our BNPL product, working with our partners, helping these users manage their cash flows, and we've seen very good results so far. So I think you discover all these problems as you go deeper and deeper into the country.
If a larger player had to today start Meesho, or a business similar to that with the infinite funds that a lot of these people would have, what is it that they would have had to do to get to where you are right now?
Again, I think as a company, we do not take any decision basis competition landscape. As a company, you will see we have defined our own journey. Everything that we have done from day one, it's not like someone else had done it before us. We have just stayed very focused to our mission statement. Our mission is to democratize e-commerce for all consumers and businesses and logistics partners. And that actually tells us what to do, what not to do. It has never been what someone else in the ecosystem is doing. And you will see our entire journey has been a big example of that, starting with helping consumers come online using WhatsApp in the early days, building Valmo now in the content commerce platform now. You will not find these things happening anywhere else, zero commission. When we did all of these things, the first time in the ecosystem, people questioned us for some time, and then they realized the benefit that it has on the ecosystem. So I would say for us, the North Star has always been our mission statement. And we will continue to kind of make the decisions based on our mission.
The street would have liked the promoter stake to be a lot higher. That isn't the case to be for a lot of these new age companies because of the capital that they've raised through their journey of listing. But what it also does, it leaves a lot of the institutional investors with a lot of stake to sell over the period of their life. And that causes a lot of supply side pressure on the stock itself. How do you navigate that?
So I think just factually, the overall stake percentage that will change is from 19% to about 18%. So very small portion actually coming down from the promoter side. And I think even as part of the IPO, when we actually went back to a lot of our shareholders and said that, look, we are looking to do an IPO and would you like to sell? A majority of them did not want to sell. And that's why you see the OFS portion to be quite small in the business. A lot of them continue to believe in us and the long-term vision with which we are kind of executing. So we'll of course kind of, they will have opportunities to kind of sell their stock in the future. But at the same time, we have also seen a lot of enthusiasm from incoming investors who want to buy more of the company. So hopefully that should kind of balance out over a period of time.
So if you hadn't named the company Meesho, what would it be?
It's a tough question. Because figuring out the name of Meesho also took a long time. We wanted to pick something that everyone can say without kind of creating a short form. You see a lot of companies create a name and people have to create a short form eventually because the name is too long. So we want to pick something which is easy to say.
People ask you what the full form of Meesho is?
It was Meri Shop put together into one thing, because when we started, our aspiration was very simple. We want to give a shop to each and every person in the country, for each and every business who wants to come online, right? Like that was a focus, continues to be the same thing. So it's quite simple. I think it's not like we put a lot behind that.
Wonderful. Thank you so much for joining us.
Thank you so much.
Great chatting with you. All the best. Thank you
so much.
Thank you so much.
Hello and welcome back to this very special edition of Startup Street. I'm Shruti Mishra. An Indian trio is betting big on one of the world's fastest growing spirits categories, tequila. Founded by entrepreneur Harsha Vadlamuri in partnership with actor Rana Daggubati and music composer Anirudh Ravichandar, Loca Loca claims it blends Indian entrepreneurial vision with Mexico's centuries-old tequila craft. After launching in the US and entering duty-free in India, the company is now gearing up for a major multi-city rollout backed by a fresh $12.5 million fundraise and ambitions to capture 5% of the domestic tequila market within the first year. Joining me now to break down the global playbook and India strategy are the founders of Loca Loca, Harsha, Rana and Anirudh. Welcome to Startup Street. Three very different worlds coming together. You know, we've got entrepreneurship, cinema, and then music. What sparked the idea of a tequila brand to launch this brand? And the aha moment, you know, that convinced all three of you to go all in? And who came up with the name?
Well, I think this idea really started when Harsha walked into me with this crazy idea saying, okay, let's build our own tequila. We've always been, we had an interest in alcohol in some manner, we just didn't know how to go about it. I think the interest started first in that gin phase where, okay, could we invest in some kind of gin, see what's going on, and then suddenly the market got super crowded.
Yeah.
And we're like, okay, now let's find something that we can create that we like, which is not easily replicable in some manner. I think that's where the thought really started. We were all, I can speak for all of us, we were all tequila fans in some ways. We were always consumers of it. And the first, almost in that first to second discussion, we were like, okay, there's no other way to communicate this to an Indian audience but with music.
Yeah.
And
that's
when he came in, and then I thought, then this was pretty much the set. It was the business, some kind of a narrative and music that was coming together. And I think from there it was really Harsha's perseverance where he started going to Mexico pretty much every couple of months, finding the right family to be able to make this right blend. So we have Willie, and it's like a third generation family that's been making tequila. And started bringing like small pallets of it back to India, testing it, getting like focus groups. I think that was pretty much what, a year and a half journey of finding what that right spirit is. What that aha moment really was I think when we found that taste. No, to me, it was the taste and texture of the reposado.
Okay.
That's when the aha moment for me happened. That okay, we have like a really fine spirit, and I think that was the first set of the journey.
And who came up with the name?
Who came up with the name? I think
I don't remember now.
It's almost 2.5
Too much tequila in the conversation.
No, I think, see, we were very clear from day one that we wanted a story or a narrative where any of the other brands have not perceived it till date.
Yeah.
So that's where the fusion of two cultures was something which was never happened in any of the alcobev brand. Either you stick to one country, one story, or one stuff.
Yeah.
There was never a fusion of two cultures. So when we got we were very clear with the agencies whom we were working with, or with people whom we were working with. There were multiple people from Mexico, from USA, from India who were working on this job. So I would say the name came out from the agency from Bangalore, who was perfect to the core. They came out with 3 or 4 other options, but for me, the aha moment was the name.
Also, it means something cool because loca in Mexican, I mean, obviously,
Spanish.
in Spanish, it means crazy. And loca in Sanskrit means world.
Oh,
so that's why it's
a crazy word.
L-O-K-A. So it's a crazy world. So that was the idea.
But why focus exclusively on tequila? You know, you could have launched with a broader spirits portfolio.
I think that's because world over, I think the fastest growing spirit is tequila, and also India's just at the start point where it's going to take off. So after a lot of data study, and obviously as fans of the product, I thought we all thought that this should be the right time for us to. This is probably the first Indian founded but global
Yes.
tequila.
Like I mentioned earlier, you launched in the US. You've entered duty-free in India, and now you're planning a multi-city rollout in the next 6 to 12 months. What's the distribution strategy really going to be?
So no, I think in all the countries, it's not only America. America is also like India. We got like 50 states, and there are big 15 states, 15, and we are good distribution partners in each and every state. So every state has its own compliance, its own challenges,
Yes.
its own distribution partners and stuff. So in Singapore, in Philippines, it's the same story everywhere.
So you've seen that. Now you're going to replicate the same model to India?
It's the same model to India.
Every state has a different regulatory challenge in India.
Yes. And predominantly the northern markets are more privately distributed, the southern markets are government controlled again. So we have been in that challenge from past decades, so we understand the markets pretty well on how to get them done. So
And which cities are you eyeing?
there is a 6-month rollout. So this month we are doing Mumbai and Delhi. Next month is Goa. Jan we will be doing Bangalore. Feb we will be doing Hyderabad, and so on.
And what's the impact that you've created in the US market? What's the kind of demand that you're seeing? What have you heard from consumers?
I was just telling them, I think we hit the highest number in November.
Okay.
It's a big season there, holiday season, your Thanksgiving weekend, and a lot of stuff happening. OND is always big in all the markets. So even in America, it's a very good season. So October, November, we have a full-fledged team who has been into the markets from almost 8 months now. So yeah, USA is pretty good. Philippines just started. So this weekend it's actually like a global takeover. Yesterday night we had a bar takeover in Philippines, Manila, which was happening. Then yesterday we had a Delhi stuff.
Yes.
And in America there are 3 events happening with Loca, New York and Texas.
All right.
So it was too much for yesterday. It was too much overwhelming at some point.
It's truly loca at this point in time.
Yesterday was the true local.
The India tequila segment is fast growing. What gives you the confidence to capture 5% of the market here within year 1 of operations? That's what you're aiming to do. And how do you plan to stand out against these global brands that are already present in India?
I think the product, firstly, because as Rana mentioned, Harsha took multiple trips, dozens of trips to make sure that we got the right profile of the spirit. And whoever's had it till now, I think Touchwood has really liked the product. So, and we are competing with, a lot of legacy products. So a lot of legacy products already exist, and those are our competitors. So obviously our drink has to be that good. So I think finally we arrived on something. As Rana said, his Loca moment was when he tasted the final product. So I think as long as people like the product, I think as long as we got a good product, then everything else falls in place. So I think the first thing we've cracked. So moving forward, obviously we're going to take step by step.
So 5% is doable, Rana?
See, what was fun was we started competing in the American market before we got anywhere. Right?
Correct.
And that's such a mature tequila market. And within all of the awards that kind of went in, whether it's San Francisco, whether it's in Miami or New York, we kept winning gold and silver in each of them. And this was competing against big legacy brands that have been there for years. So, we made a spirit that's superior in some manner. We made that spirit affordable in every way. And the fact that we were able to set foot in a global stand, and then we're coming to India gives us a very large confidence that we have a product that's superior and we'll be able to distribute it in India better than the others. The brand itself is fun. You don't see any other tequila bottle that is so much fun like ours.
Okay.
It's got energy. It communicates with the younger generation. Like Harsha spoke a little bit about it, where we were trying to set cultural fusions in some ways. I think today everyone is about fusion in some manner. You want to experience a new culture, you want to be part of a new culture. And what we kept discovering between India and Mexico and those type of storytelling was both are so similar, both are ancient cultures in some manner. They're very celebratory. So I think that kind of spirit in terms of whether we communicate it on social media, whether it's the music that Ani is creating, whether it's the TVCs and the other content that we'll start putting together, will be pretty much focused in that direction.
All right. Let's talk about pricing now. You've got 3 variants as of now till date. how do they sit in the Indian market? How have you priced them? And also if you can talk about some of the Indian partnerships that you've built as you plan this multi-city rollout.
So right now we have the price point. Coming firstly to the price point, we are in a premium category. In US we sit at $40 and $45 for Blanco and Reposado. Añejo is just out into the New York and Texas markets, which is retailing at $69.99. So that's the price point in America. But in India, I think we are pretty competitive because we are the manufacturers, we are the importers, we are the distributors.
Yes.
So there are a lot of layers which has been gone. This I want to specify because the pricing is friendly because of business acumens and stuff which we have built from past decade. So that's where the price point is very sweet for the younger generation. But the product is pretty premium.
Okay, and where will where will Loka Loka be available at? What are the partnerships that you have currently for India?
So in there are a lot of on-premises which have been already been rolling out from past week. So the product is here only last week.
It was there in the duty-free seconds. Now where will it be available?
So now in Mumbai and Delhi markets, we have been speaking with all the on-premises. So everybody are getting it on. I think in the next 32 to 45 days, will be available in all the retail outlets and also the on-premises.
Well, on that note, it's time for us to head into a short break, but don't go anywhere as we continue our conversation with the founders of Loka Loka. Stay tuned. Welcome back to Startup Street. We're in conversation with the founders of Loka Loka. You recently raised $12.5 million from a Singapore family office. What are the top 3 priorities for deploying this capital?
The top one is to kind of land in the Indian market in an interesting manner.
Yeah.
It's we've started out as a global brand in some ways. It's creating an extension in the places that we haven't. And also I think see we're an artisanal brand. We're new. We're young. We're not in the large competing space like the legacy brands have. So I think it'll be pretty much focused on brand building and making sure that the product reaches the final customer. Like Harsha said, if we get into a state, we'll make sure whether it's on ground, whether it's in restaurants, whether it's on premise, we make sure that distribution is set till the last mile. And the advantage that we have is there's no middleman in this. We've built the product ourselves. We've landed it in India, and we're going straight out into the distribution. So So yeah, that's where our cycle is going to be spent most on.
Yes, you're global from day one. You know, you're incorporated in Singapore, manufacturing is in Mexico, and it's founded by 3 Indian entrepreneurs. And of course, now you're in the Indian market.
We're more global than we thought.
So what strategic advantage
That's nice to hear.
does
Nice to hear this.
Yeah, so what strategic advantage does this structure really give you? You know, because tequila is projected to hit what, $43 billion by 2033.
Yeah.
So what's the strategic advantage that you feel? What's the biggest challenge and the big advantage?
The biggest challenge which we are facing right now is handling the global team, because I personally lost track of time.
Yes.
We don't know when. Because all our timings are odd. I don't know, he sleeps less.
Yeah.
He works in a different time zone.
So for me, the US time works best.
Actually, the whole company is working on Anil's time zone.
So the biggest challenge is handling the teams, but I'm 100% sure that our global team is being built pretty strong. Our US head is from Southern Glaciers, which is the biggest distribution company in America right now. He joined us recently, a couple of 6 months back. So I think every region we are trying to build an individual team now.
Yeah, that's what I was coming to, because it's a pretty lean team at this point in time. So you'll be hiring a lot of hiring in the Indian market as you.
Yes, Indian market is already done. Already we have a pretty good team in Delhi, Mumbai circuits, and in South India we just started hiring people up. So India, like as told, region-wise, we are trying to bifurcate the company.
The big question is that are Indian consumers really ready to take up premium tequila? Do you also believe you need to sort of educate the market, especially here in India?
I think globally, it has already become a trend where everybody shifted to tequila, and especially to white spirits. I think the generation now is also a little more health conscious than what probably we were before. So that way tequila has already taken over most of the world. The fad, has already hit. I think the fad is hitting India, and it's already getting there. For example, even if you take a small sample size, like say even a circle of my social circle or my friends, a lot of people have shifted to tequila over the past couple of years. So I think we're just here it's being here at the right time, and I think now is the best time, because I think it's just going to take off now. So about educating the people, I think already the youngsters are pretty educated.
But you bring me to a point where a lot of the Gen Zs are now looking at more healthier options. There are these parties that are looking at. So in the near-term future, or perhaps have you given it a thought of expanding? When you expand your portfolio right now, it's just tequila, you've got 3 variants. Will you be looking at a broader portfolio also?
There are a lot of plans in action.
What can you give us?
It's a bit too early right now. Too early. We just want to land our first products right
So it'll be tequila for a while?
Yes. And if you talk about health, I mean, this is the healthiest of the spirits of the lot you can have. This is 100% additive free, so there you go.
So to add on to Rana's point, I think, artisanal stuff has never been big in India yet.
Yeah.
So we are that small batch artisanal stuff brand which we wanted to keep the premium quality with an affordable pricing availability for the next generations.
And what kind of manufacturing capabilities are we talking about right now?
So we invested pretty well in, I think Willie is also here for the India tour, but he's not in this interview. But he would be the right person to talk about the capacity of production and stuff. But we are good for next 3 to 4 years.
What's going to be your long-term playbook? What are the targets that you've set for yourself? If you could take us through some of those.
But the interesting part is we've been beating targets, so I think that's the fun part.
Okay. So give us, what did you think and how have you beaten targets?
Well, I think the first cycle was, we wanted to land it at least in 2 or 3 different countries, and by the time we get to India, now we're in 5. I think that was, there have been surprise markets like Philippines and others that took to the brand much faster than we expected. I think also the India launch had been a little delayed because of the consumption that's happened in the Philippines. So I think that pieces like that kind of surprise us. The American markets have been behaving really well with it. Like pretty much November has been the top month in some manner.
Are you closing in on profitability? What's in terms of revenues? Where do you stand currently?
So I think globally, I don't think we have we filed yet because this is our first year.
So you're yet to,
but in case-wise depletions, I think we are as per our target. We wanted to deplete around 20,000 cases, and I think we are there.
All right, we'll definitely keep a track of the company on Startup Street. But before we wrap up, let's do some fun questions. It's for all three of you. Whoever likes to answer this first. So my first question is, who among the three of you has the sharpest palate for tequila tasting, and who's the easiest to please?
I think
sharpest palate.
Who's more critical about the
sharpest palate is him. No, because I mean, we used to get a lot of profiles. Still, we are getting a lot of profiles because a lot of R&D which is happening. So he can easily taste
differentiate,
and differentiate, and he can easily tell that.
Who's the easiest?
Well, I've been a consumer for a while.
Clearly.
Probably I was the easiest to please.
Okay, all right. My next question. What's the most loca, wild, funny, or totally unexpected moment in building the brand so far? Any fun story that you have?
I think the time when we actually went to Mexico.
So I was thinking the same. That
was a crazy experience.
Take us through.
I mean, both of them they had no idea what they were getting into.
Okay.
See, it is always Harsha. I've been to Mexico, here you go, this is what I bought. So all we see is a batch of plastic pallets or just glass pallets that have small pallets that have, right? And then now we're finally going to the factory, to where it's built, to the processing plant, to the agave fields.
Yeah.
And man, I think the second we landed there, we knew, okay, now this was something really special. We always knew about the artisanal thing in terms of theory, but once we went there, we kind of understood.
Yeah.
It's actually, I think Willie's father will be it's a third generation family that's doing this. So they've been doing this forever. The passion that they have, like every single agave plant that's sold like 7 years ahead is actually coming now.
We met the farmers.
We met the farmers. So I think that was really special.
Yeah. Okay.
Then I think we need to add on the music bit here.
Oh, yeah.
Because until we went there, there was a pretty interesting thing which happened. So fermentation happens with live yeast.
Yeah.
They have their own personalized strain for our profile, and there was a lot of music playing there. We never knew. I mean, I knew. They never knew that the yeast reacts to the music.
To the music.
So last all the profiles which you are drinking now, the yeast has been reacted to Anis music, and the
So that was crazy. He sent me a video. Obviously, we went and saw the yeast reacting, but they were playing something.
Something else when we went.
Then he sent me a video a while back saying, look at this, we're playing your music and the yeast is reacting. And then you can see
that's incredible.
So I think we have something like pretty phenomenal.
So that's how deep artisanal you can get.
Absolutely.
I don't think any other brand, like let it be a product or a brand, also can claim that we have made the liquid also in a very peculiar manner, because it can't be copied.
Absolutely,
His music can't be copied.
So that brings me to my next question. If Loca Loca were a song, which one would it be?
It's going to come out today.
He just made a song.
Can we just hear a line? Probably just a line or two.
Tequila loca loca lo, blanco loca loca lo, recostado loca loca lo, agave loca lo loca.
That's a hit. Yeah, good one. Well done. Thank you.
This is me trying to be as Mexican as
All right. Now, with three strong creative personalities that we've got here on the table, what's the one decision that sparked the most debate, and that the kind that probably needed a tequila to settle?
The size of the label.
The size.
Really?
We actually had a argument and fight also.
It's like, no, this bottle looks too big. The label is like, and it's also everything is like handcrafted. So we need to be like that perfect to do it.
Yeah.
But I think finally we got something awesome.
He's not compromisable on the communication stuff or branding stuff.
Yeah.
So see, as told, everybody are so emotionally invested into the brand also, because step by step when it was taking shape, everybody wants the best out of it. That's what kept us going till date.
Okay. One tequila myth you want to bust for Indian consumers?
Well, it's not a shot no more. It's the coolest thing that you can sip.
Oh, well done.
Yes.
One final question for our viewers. What's the right way to enjoy a glass of 100% agave tequila?
was just-
Three of us have different ways of
Let's
drinking.
go. So Harsha, let's start with you. Go ahead.
I think I like it. I like it. So there is in Texas, ranch water is a pretty good drink. It's like just your reposado, Topo Chico, slice of orange or lime.
All right. Okay.
It's ice cubes.
That's Harsha style, Rana.
Reposado ice and a slice of orange, yes.
Anirudh.
For me, it's just the Blanco, nothing else.
All right. On that note, it's time for me to wrap up this really fun and candid interview.
Thank you very much. It was a lot
Thank
of
you
fun.
so much, Harsha, Rana, Anirudh, for being here on Startup Street, and wish you the very best with all your aggressive growth plans. And with that, it's a wrap from Startup Street. Goodbye, and many thanks for watching. Stay tuned to CNBC-TV18 for more news and updates.
It is a privilege and an honor to be back here at the FICCI Annual General Meeting. I've always had the privilege of being able to host a show with the whole of government, all the secretaries representing the government of India, and it is an honor to be back here to do exactly the same. I won't go through the introductions again because you already know who I'm going to be speaking to. As was articulated at the start of the program, the idea really is to delve into each sector, to ask each secretary what the year has shaped up to be, but more importantly, what the outlook is as we look at 2026 and beyond. If I were to do a dipstick survey here in the room, I think the number one question that everybody wants an answer to is, when will the India-US BTA happen? And I know all fingers on this panel will point in one direction towards Mr. Rajesh Agarwal, Commerce Secretary. That's just one of the issues that we intend to talk about here this afternoon. We've got an eminent set of guests. So without further ado, ladies and gentlemen, because there's plenty to talk about, let's get started. Ms. Agarwal, the very first question to you, as I said, the number one question that everyone's asking today is, the expectation was that by the end of November, by fall, we would have an inking, a signing of the India-US BTA. Where are things currently on that front, Ms. Agarwal?
Yeah, thank you. Thank you, Shreen. I think there was a commitment to see that the first tranche of India-US BTA is completed by fall of this 2025. However, things have changed and moved a lot from 13th February onwards. When we got into a BTA negotiations, we were on the path to deliver a good aspirational first tranche by the fall of 2025. But in between, we have found a lot of changes in the global trade landscape. One of the key has been in the US landscape, where we came out with reciprocal tariffs which were imposed on all the trading partners in order to see that the trade deficit with the trading partners can be evened out, and also maybe overall create a revenue stream for the government of United States. So with that new change in the overall landscape, the BTA has also gone through some articulation, some changes, wherein right now we are engaged with not only negotiating a bilateral trade agreement, which definitely with a country like United States will take a lot of time, because trade agreements are very wide-ranging agreements these days with a lot of issues, not only market access issues, which are negotiated under the umbrella. But at the same time, we are also engaged in a protracted negotiations on a framework trade deal, which will try to address the reciprocal tariff challenge that the Indian exporters today face. So these are two separate parallel negotiations going on, but one will feed into the other. What needs to come first is the framework trade deal, which is able to address the reciprocal tariffs. We have engaged on it for last few months very deeply with the US teams. And I think all I can say that we are close. We have tried to iron out most of the issues. Now it is only matter of time when this decision has to be taken, that when the two countries have to find the right landing zone to announce the deal. So that is where we stand as of now. Thank you.
Some clarity, sir, on where things currently stand as far as the negotiations with the US are concerned. And it's important that you've highlighted for us that there are two parallel negotiations underway. One, of course, is for the bilateral trade agreement, and the other is to deal with the reciprocal tariffs, the framework that you spoke of. Is the hope that the framework to address the reciprocal tariffs will perhaps be done in this calendar year, sir? Is that the expectation? Is that the hope that you're working with? And have the outstanding issues, especially when it comes to market access, when it comes to the US's concerns on India buying from Russia and so on and so forth, does the US now feel that India has addressed some of those concerns that they raised?
I think our expectations, we are very optimistic and very hopeful that we should find a solution within this calendar year. But as you know, with any trade negotiations, the final deadlines cannot be, because even if there is one sticking point or one sticking issue which is in the mind of even one of the partners, the trade deal may not meet that deadline. Having said that, I think the overall position is well set to deliver it in next few weeks or months as soon as we can. But let's see, it's a call that will have to be taken at multiple levels. At the levels of negotiator, I think we are in a zone where we can say it is something that we can achieve in a very short while of time. There's not much to negotiate. There are very few issues, and that can be taken. The political call needs to be taken on some of them. And having said that, also as a country, we have always stood for our own sensitivities and our own uniqueness. So there are areas which are non-negotiables from our perspective. And that I think people, the countries which have negotiated deals with us are very clear that what are the things that India is not open to negotiate or not able to commit or bring to the table because of our unique nature of our economy, the way we are poised and the sensitivities that we do have in our economy. So those remain negotiable, whether it is any agreement, including the one with United States. Thank you.
You know, Commerce Secretary, I know that we cannot speculate beyond a point on the timing itself, but I just want to understand on the framework per se. As and when there is an understanding on both sides to go through with it, would that automatically mean that there would be a reversal of the 50% tariffs that have been imposed on India?
The assumption is that a trade deal will be beneficial for Indian exports only when there will be addressal of both 25% tariffs, not only the one which is a trade tariff which has been imposed on trade in lieu of the lack of trade deal, but also the other 25% tariff which have been imposed for some other geopolitical reasons. Until unless both are addressed together, it will not mean a meaningful deal for India. So we understand whenever the deal is finalized and signed and agreed to by the both sides, I think both these 25% will stand.
Are stocks still on, sir, or have talks concluded?
The stocks are still on, and it is because these are two negotiations also. There's a larger one also which is going on. So talks are on. Our teams are engaging virtually on a regular basis. There are virtual sessions every week on some issue or other. So there is.
Are you going to be visiting the US anytime soon, or are they going to be visiting us anytime soon?
Let's wait for some time. You may see the visits can happen either way. Whether we visit them or they visit us. They were in pretty lockdown for some time, 45 days or so. Now they are out of lockdown. So we expect some visits from their side also in the near future.
So on the BTA, sir, and I don't want to make this just about the US, but one final question on this before I get the other secretaries back, and then I'll come back to you. But on the BTA, are negotiations done and negotiations still underway, even as far as the BTA is concerned? And what's the broad timeline for the BTA? Because this is separate from the BTA.
I think BTA will take some time. It's quite an expansive. BTA is like a free trade agreement, and it will take a lot of time. And especially with the change dynamics, where you have got reciprocal tariffs in the play, which are beyond the MFN tariffs that each country do have. I think we'll need to find pathway for complete elimination of reciprocal tariff in our process of doing BTA. So I think that will take a bit of time, and we'll not hurry up those. We are working on various aspects of BTA, but let the first one come first, and then we'll see what are the timelines that we put for the BTA. Thank you.
Okay, that's a very, very clear comment coming in from the Commerce Secretary. BTA is likely to take longer. What the government is hoping for is to get the framework in place, a package, so to speak, to address the issue of reciprocal tariffs. And the hope is that you'll get that done in a second. But Agriculture Secretary, let me come to you, sir. And of course, part of that non-negotiable list that he's dealing with also involves the agriculture sector. But let's talk about what the year has shaped up to be for the sector. We've had rains, we've had floods, and that has impacted both yield as well as crop productivity. The year gone by, but more importantly, the year ahead. What's your sense on agri growth?
So, as you must have read in the newspapers that the 24-25 final estimates were released. And the special feature of those release was that there's a bumper harvest of food grains, bumper harvest of oil seeds, and bumper harvest of horticulture in 24-25, which was obviously supported by a good monsoon, but also because of the fact that a lot of research has gone to the land in terms of better seeds, better infrastructure, availability of inputs. In 25-26, of course, overall the monsoon was very good. It was above normal. There were very few areas of deficit, but there were some areas of excess rainfall and also floods. And we know that there were many states where the floods were quite devastating to some areas. So that has sort of reduced the quality of produced and also productivity in those particular areas. But overall, the coverage has been okay. And what we expect is, because of the fact that now the reservoirs are full, there is a good moisture in the soil because of heavy rains. the Rabi is progressing very satisfactorily, and whatever little bit dip which would have caused because of floods and other sorts of disasters in Kharif or the monsoon season will be more than offset in Rabi, and we will have good crop overall in the country, and that is also being reflected in the way inflation is moving, especially the food inflation, which is now more or less stable, very stable, and at times it becomes negative also.
Yes, we have seen that happen. So you don't anticipate any spike as far as food inflation is concerned?
Not at least in the next 6 months we can predict that.
Not over the next 6 months, and that's good to hear. You know, we've got the budget coming up, sir, and I think everybody's sending in their wish list to the finance ministry and to the finance minister. What is yours?
See, I can only say that one of the biggest wish list of the agriculture ministry and the stakeholders of agriculture was the GST, which was not, of course, part of the budget, but it was a part of the reform process. And the way the GST reforms which were announced and implemented last 2 months ago, they have really changed the way agriculture is now, inputs are being now procured by farmers. The reduction has been, the good thing was that this reduction in GST in micro irrigation mechanization has been passed on to the consumer. And therefore, we are seeing a boost in the demand for mechanization and for other products, and which will help the agriculture sector in the long run.
So growth estimates for the agriculture?
Yes, we can say the growth of these sectors will be high because of increased consumption, led by of course, the general prosperity, the surplus incomes which will be available, and also the reduction in prices of these commodities or these implements and equipments.
but let me get the Defense Secretary into the conversation. Sir, thanks very much for joining us. While we're dealing with the US, we're also having to deal with Russia, and that's part, I would imagine, of the dialogue and discussion that you're going to have next week. President Putin is going to be here. The expectation is, will India further deepen its bilateral arrangement in the defense sector with Russia? Let me start by addressing that issue with you. Should we expect any announcements, any deals between India and Russia on the defense side?
Even if there were, I'm not going to announce them here. So nice try. But as you know, Shireen, we have a lot of legacy equipment from the Russians, and maintenance and support. And even there are also some orders like the S-400s where they've been delivered partly. So obviously all of that will be on the table. In terms of new announcements, I will not be able to sort of mention those, but our defense cooperation with Russia is of long standing. They've been our friends through both fair and foul weather, and we are not going to sort of stop our defense cooperation with them anytime soon. But I do want to stress that India follows a policy of strategic autonomy. Items that we need from the Russians, we will, of course, buy, and to the extent possible, not only buy, but also make in India. From the Americans also, there are certain specific types of equipment that we need. And over the last 10 years or so, we've done almost $30 billion worth of purchases from the US as well. So we are diversifying our equipment suppliers. But more than anything else, we are trying to ensure that we increasingly do our spend the bulk of our money within the country. Last year, out of 2 lakh crores of contract signings that we did, 1.33 lakh crores, almost 88% was with domestic suppliers, both PSUs and private. That trend will continue. It will never go below 75%. Big global buys will be there, but they will be exceptions rather than the norm.
Well, several things there that I want to pick up on and get specifics from you. Let me start with the indigenization program, because as you pointed out, it will continue to be something that you prioritize and will be part of the government's efforts going forward as well. When can we expect the next list as far as indigenization is concerned, sir?
So the positive indigenization list that we currently have on has about 509 odd items, out of which about 50% of those are already have been indigenized. The next one will be out shortly from the Department of Military Affairs. In general, the intent is to, depending on the TRL level, you try to do entirely within India, the production and the design. In certain cases, you will rely on technology transfers and then make in India. And there will be some rare cases where you will do either imports or you do a small chunk of purchase from outside, as we did for the C-295s, and at least assemble or produce the rest of them in India. These are the three broad categories on which we'll work. But as I said, 3/4, 75% of that will be almost entirely make in India.
So since we're talking about make in India, and I want to understand from you whether we should expect joint manufacturing, especially in the context of the India-US defense partnership, in terms of that partnership deepening. Is that an expectation that we should have, that there could be joint manufacturing? That's an expectation on some, for instance, for the S-400, even when we talk about Russia. Are these realistic expectations to have?
So far, the bulk of our production in the past has been what we call licensed production, which is largely from Russian OEMs. Most recently, we've got one production ongoing where the final assembly line of the C-295 military transport aircraft is being done within the country, Airbus and Tata's together. With the Americans, largely we've relied on imports. In certain cases, for example, for the light combat aircraft, we've taken the engines from the General Electric. With the Americans, I would imagine the chances are of initially getting them in through MROs and then thereafter perhaps moving into production. In other areas, we will probably do with other suppliers like the French and the Russians. I see more chances of doing co-production, joint ventures, etc. But in general, as I said, foreign OEMs will have to get used to the fact that most of our money will be spent within the country, and if they want to get a share of that pie, they will have to do joint ventures here and co-produce here.
And co-produce here, but unlikely to be the case when we talk about the US specifically. I'll come to you, sir, in just a second, but I want to come back to the Commerce Secretary just to pick up on what we heard there from the Defense Secretary. Sir, you know, defense and the kind of arrangement, agreement, deals that are likely to happen between India and the US, how much are all of these aspects weighing on this framework that you're currently negotiating? How much of what is happening in the oil ministry by way of that CNG contract, which is a historic first between India and the US, weighing on this framework to address the reciprocal tariff?
I think...
Go ahead, sir.
Hello. Yeah, I think India-US relationship, if you look at over last 2 decades, it has only gone strength by strength. So our relationship is across in all economic sectors, whether it's defense, energy, trade. We are there, people to people connect, the diaspora. I think the overall strength that this relationship has got over last 2 decades is all going to weigh in this relationship. And that's why you will find that in spite of the fact that India and US has not been able to strike a deal, which was expected early on, till now.
Which is expected to be the first deal.
Yeah, but still, you will see the trade between the 2 countries have not gone down. Still, if you look at our trade, our exports to US, we are still, this calendar year, $10 billion up than last year. So we're still doing better. I think there's a lot of positivity between our businesses on both sides. Still there, you're seeing a lot of positive movements on all other aspects of economic engagement. Because there is a lot of synergy, there's a lot of positive energy in this relationship. The deal has not happened, that's a fact. But outside that, I think a lot of things are happening, which will all weigh down on this relationship, because any relationship or any aspect or any work need not be seen in an isolation, but they whole form a part of the entire relationship that India and US form. So whatever we are doing together, I think this will all be part of the entire relationship that we see 20 years down the line. That is how we look at it. Deal may not have those aspects as such. They will not be negotiated as a part of the framework deal. But these all things, I think, goes on to say that this is one deal that world needs, India, US need to have together.
Yes, so directionally and intentionally, you're making India's position clear in terms of where we could perhaps move forward. Let's understand what's happening as the food processing side, sir. One of the successful PLI schemes under your ministry. What's the expectation now, given the experience that you've had with the PLI scheme? Should we expect another incentive scheme? Is that necessary or warranted today?
Thank you very much. So far as PLI, you have asked, food processing sector has done fairly well in the PLI on any account, whether we see the investment or the growth or the export or the employment. So on all the fronts, we have done very well, and we will be very happy. In fact, we are working on it, whether we can have, the next round of PLI for the food processing at least, or for the sectors where we have done well in the PLI.
So that's a demand that you would like to put forward, that you believe that there is a need, a requirement for a second PLI scheme?
I feel that there is a demand, because if we see the first round of PLI, we could not cover the, different sectors. So there are few sectors which are left out. There are few, companies or few verticals which were left out. So we feel that there is a need, and we will articulate our demand and put it across.
Okay, so expectation of a second PLI scheme. Of course, the Ministry of Finance will have to sign off on that. But let me now start to collate what I am hearing from each one of you and try and glue together this conversation. And let me start by asking each one of you as far as the export outlook is concerned. And Commerce Secretary, I'll start by asking you. You spoke about the number as far as the US is concerned. But what's the outlook now from an export point of view? Do you believe that the measures and steps that have already been taken to mitigate some of the impact of the reciprocal tariffs on exporters will help offset some of the pain? And what next and what more should we expect as far as export promotion is concerned?
Thank you. I think from our perspective, I think though we have a slight stress in this trade ecosystem because of multiple other developments globally, I think this is also a huge opportunity for our industry. And Indian industry has responded to it very bravely and very strongly. If you look at the numbers for the first 7 months, what has happened in our export arena, on merchandise trade, we are still much ahead. We are ahead of last year. And overall, our exports in first 7 months have been $491 billion as compared to 469 last year. So we have been doing well. Industry has shown resilience. Two, if you look at where this trade is all coming from, you will see there has been a slowdown in US market, especially in sectors where tariffs have come, especially in month of September and October. But you will find those same sectors have found some growth in some new quarters, new areas. We are exporting more marine products to EU now as compared to past. We are doing 60% higher this year. And overall marine exports, which had 30% dependence on US market, today is still 15% higher than last year. So that is the strength that Indian industry is showing out. So we are very confident that in spite of all these challenges that we face in the global trade ecosystem, Indian industry will perform well. We'll be able to seek new opportunities, find new ground, and may be able to diversify our trade, make our export supply chains more resilient so that we are in good stead in future. Thank you.
Speaking of finding new grounds, sir, and the US is not the only trade agreement that we're currently working on. There's a whole host of other agreements, including, of course, the big one with the EU. Is the expectation now that the negotiations with the EU are picking up further pace? What is the expectation in terms of timelines? I know the India-EU summit is going to happen in January next year, but on the back of the negotiations that have already taken place, how confident do you feel about the India-EU FTA getting done?
Thank you. I think India-EU FTA is one of the most difficult and big FTA that we are into negotiations. But over last 3 years, a lot of work has been done. And I can say we are in the last phase of negotiations, which normally are the most arduous and most difficult. So this last phase, to my mind, has started 2-3 months back. But the engagement at all levels, including my negotiating teams at my personal level and also my minister's level, is on a regular basis for this FTA. And there's energy on both sides trying to work out a deal as soon as possible. We are in good zone. We are trying to do it in next few months, but we'll not put a hard deadline to it, because we know at the end of it, it is the quality of the deal that will matter and not the timing of the deal. So we'll go for the quality, still work on the timing, and let's see where we land.
So what's the broad timing that you leave us with, sir? First half of next year?
Definitely. I think not even first half. We'll try to go for what you indicated, hinted at, but if not possible, we'll try to finish it first
quarter. So January. So you're saying that along with the India-EU summit, you may want to close it.
So that will always be, see, whenever you have got a good opportunity to close the deal, announce the deal, you'll try to do that. But that's not something will define the deal, because the deal has to be done on its own merits. So both sides are engaged, and that's why the time effort that is being given by negotiators on both sides is tremendous, and a lot of engagements are going on. As I speak here today, just now, after 1.5 hours, our discussions start again at my level. I'll be back in my office doing this. So that's the time of work we are doing, but we'll not put a deadline. And we are very hopeful we should get a deal sooner than later. We are closest in these negotiations as we could have been, as compared to what we were 10 years, 15 years back.
Yes, absolutely. It's taken more than a decade in the making, and you're giving us hope and confidence that we are in the last lap, so to speak, as far as negotiations are concerned. And the hope is that you will be able to do it early next year. Defense Secretary, let me understand from you the export outlook as well. We've had a low base. You've done very well on that low base. What the expectation is from here? For instance, for the BrahMos, I know that negotiations are on with countries like Indonesia. What should we expect on that front?
So as you noted, from a low base, we've grown almost 30x over the last 11 years to 23,000 odd crores in the last financial year. A lot of that contribution actually is from the private sector, because although our overall domestic production in India is dominated by the public sector, about 75% break up and 25% with the private sector. When it comes to exports, it is the reverse. 60% of our exports are done by the private sector, which is wonderful. Our target is to reach 50,000 crores by 29-30. I think we'll do it easily. My view is that we'll exceed that target quite easily. We'll probably achieve it in 2 to 3 years, the way things are going. And coming to you, the specific question about BrahMos, after its validation during Operation Sindoor, there are lots of inquiries, and 2 in particular, Vietnam and Indonesia are fairly advanced, and we expect them to conclude fairly soon. Again, no timelines, but they are on the anvil, and we expect similar momentum in many other, with many other platforms as well.
Well, that does deserve a round of applause there. Not just being able to meet the target, but meet the target and advance the timeline. That's quite something there for a sector that has been mired in delays. And addressing that issue, Defense Secretary, because this has been a big concern, procurement delays, execution delays, delivery delays, etc. What do you do now to prioritize timely execution of the milestones that you've put in place?
So the first part about procurement delays, my job is to ensure that contracts are signed on time, and the industry across the board, right down from the OEM to the tier 2, tier 3 vendors, have visibility in terms of contracts. Last year, as I mentioned earlier, we've done 2 lakh crores of contracts. This year, we've done 3 quarters, and I've already reached about 1.5 lakh crores of contract signings. So, I mean, what we can do is give you visibility in terms of orders. Industry, of course, has to deliver in terms of milestones. There have been delays, both by domestic and foreign vendors, in certain cases because of specific supply chain issues linked to geopolitical conflicts in places like Israel and Russia. Nonetheless, we intend to sort of keep the faith with our our domestic industry in particular. And over time, we'll have to accept greater accountability, which is why in the current round of emergency procurements, for example, which we've announced after Operation Sindoor, we have basically a deadline of 1 year for delivery. So those who don't deliver on time, we will simply foreclose all of those contracts. So, I mean, as we do more contract signings, there will be a greater demand for accountability from my side in terms of speedier procurement decision-making, from the industry side in terms of ensuring that the milestones are met as promised.
So foreclosure if they don't meet the deadline of 1 year. That's clear. Okay. Let me get the Food Processing Secretary into the conversation, sir, since we're talking about the outlook for the year ahead. Foreign direct investment, and I know that Mr. Agarwal and Mr. Singh and everybody here on this panel is going to be focused on that as well. But FDI, a crucial aspect for your sector. What's the level of interest? What's the level of engagement at this point in time with foreign players who are looking at the Indian market?
For food processing, like we have 100% FDI permitted through direct route. And we have been receiving a lot of, interests and queries from the investors abroad that they are willing to invest in India, particularly looking at the, the changed environment in the food processing sector, number 1. Number 2, about the, labor cost differential. That is the biggest differential and the advantage which India has. If we see even our, processed food export, in last 10 years or so, like we were contributing around 10% of the total agri exports. Now it has gone to almost 22%. And in next 4 years, we are very sure that we will cross the 30% cap for the processed food in the total agri basket.
Okay, that's good to hear, sir. What about your perspective? Exports, FDI, the outlook.
So, as mentioned by Joshi ji, that when we have to produce appropriately, then only food processing industry will be able to expand. So there is a good partnership going on, and in fact, the whole the research ecosystem of the country is also looking into the fact that while we are there for having food grains for our self-sufficiency, for ensuring that everybody gets the required food grains and all seeds and etc. But the process varieties of various, especially the horticulture produce, are also, that technology is also given to the farmers, because it is that process varieties which ultimately goes to the food processing industry and which ultimately helps in better realization of farmers, prices to the farmers, and also reducing the losses. And that leads to further exports. So the vision of 2047, which was for Viksit Bharat, which Honorable Prime Minister is leading. So the two pillars in agriculture sector in that vision is, first of all, we should become food basket of the world, and our exports should be 10% of the world agriculture exports. And second is to have Atmanirbharta, or self-sufficiency in the key food items, which is the oilseed pulses and the food grains. And a third, of course, is to increase the non-farm income of the agriculture households, which is, of course, through the food processing industry and other allied activities in rural area. So that is the broad vision in which agriculture is also working. And our whole ecosystem is to ensure that good inputs are there. We also have to ensure, as it is very important for our exports as well as for the consumers, that the MRR levels which are defined with the global standards which we have also adopted, those MRR levels have to be taken care of by not just by the industry but also by the producer of that food items. And therefore, there is some sort of backward integration with the industry to ensure that there is a responsible use of pesticides, chemical fertilizers, and so that our products don't fall into any sort of disadvantage when it comes to quality. So that is an aspect which we are working with the state governments, and the ICR system of Krishi Vigyan Kendra is also working with the farmers to ensure that both responsible use of chemical and pesticides and fertilizer takes place. So that is another priority area which we are taking care of.
Well, that is certainly, as consumers, that's certainly good to hear. But, Commerce Secretary, on the issue of FDI, it is a complex and a fairly volatile landscape that we're dealing with. But what can you do to try and draw in more foreign direct investment at this point in time? Are there any specific tangible next steps that the government is looking at taking? I know that there are high-level committees that are looking at the ease of doing business, one headed by Rajiv Gauba. Recommendations have been made to try and do away with licenses and so on and so forth. What is the input from your ministry on that front to try and draw in more FDI, sir?
Two things I think I'll just like to focus upon. FDI is also key to trade and investment they are both, I think, two sides of the same coin. So you need to have investment to actually do good trade also. But one of the key aspects in a global trade, which is now being captured by GVCs, and the global value chains are the ones which are doing 70% of trade are through GVCs. I think it is necessary that we integrate well with the markets which are consuming market, big markets. Our economy gets well integrated. I think the bouquet of FTAs that we are negotiating are in that direction. If you look at the FTA that we did with Australia, UAE, EFTA, UK, and now we are trying to do with EU, trying to do with New Zealand, Chile, Peru, all these are in the context where we are trying to see that the tariffs on both sides give enough predictability to investors globally to invest in Indian market. Because when an investor looks at Indian market and in Indian demography itself is a good, attractive incentive for them to invest in India. But that coupled with a supply chain ecosystem where you can export, import freely with multiple other markets in the world, a clear predictability is a good enough incentive for investors to look into. So that is something that we feel with increasing network of FTA, this will something that will drive FDI in India. Two, we think as part of our FTA negotiations also, we are trying to nudge developed economies with which we are doing FTA to see if they can bring out certain commitments around FDI. FDI is going to be a natural outcome as a part of those FTAs, but we are trying to lock that in as part of FTA also, so that there is commitment on their side also, and there is a clear driver that we create as a part of FTA, which can work on both sides to create this investment pipeline.
Which FTAs are you baking this mandatory FDI requirement into?
So if you look at EFTA, the FTA which we did, one of the key commitments there is the 100 billion FDI over a period of time. And that is something which is serious commitment that we are looking at. In other FTAs also we are negotiating, and which will be coming to fore in next calendar year. You will find many of them will have this provision wherein FDI is something which will be committed by our partner country.
Where do you feel most confident, sir, of FDI coming in? The hope is that it will come into the manufacturing sector. What we have seen, though, is that it's coming into the digital infrastructure sector, data centers and so on and so forth. Google's $15 billion into Andhra Pradesh. Where do you feel most confident of FDI coming in at this point in time?
Fair comment in the sense that FDI in India has largely come in services sector. It has come, but services also remain one of our strength. Our demography is our key strength, and services sector FDI is also good for the country. Two, if you look at even merchandise trade, there is increasing servification of merchandise trade. Today it is said 30% of your goods trade also is technically services. So if that is happening, I think FDI in services also in India trying to provide services to merchandise being traded globally is also a good idea, because in every trade that you say maybe between Europe and US, there's some amount of India which is also being traded. So that's not a bad deal to my mind. So services will remain so. In addition, India being a very aspirational and growing market, rising middle class, and we are one of the fastest growing major economy. I think it will create enough demand for consumption also. We are a consumption-based society. So you will see a lot of FDI in manufacturing also, because this demand also needs to be made and met by producing indigenously. All this demand cannot be met only through imports. So that is also because predictability of meeting this demand can only come through producing in India. And that also, I think, the global investors are aware of, and they will be looking at India as an investment market.
As a specific next step, sir, because one of the aspects being talked about perhaps to draw in more FDI is a review of Press Note 3, which deals with investments coming in from our neighboring countries. The big one, of course, is China. We understand that perhaps a review is underway. Do you believe that a review at this point in time would aid for more foreign direct investment?
I think that is something my colleague, Mr. Bhatia, Amardeep Bhatia, is not here. He would have been able to throw more light on. But my sense is many of these policy regimes are for various other regions, because we can't see the policy making, public policy making is not that simple that you see it completely 2+2. So with that perspective, I think if they are looking at reviewing it, that is for something that they need to decide upon. But having said that, I think with or without review, India as a market has arrived, it's growing, and there is a demand which is coming up. If somebody will come to fill it up.
Somebody will come to fill it up. You know, a lot of people here would also like to hear your thoughts and your views as far as the rupee is concerned, the currency is concerned. We've seen a fair degree of volatility. We touched a record low as far as the rupee is concerned. We have seen some stability over the last few days. What's the view on the rupee? And what's the view, more importantly, also on the trade deficit? Do you have any concerns there, sir?
See, on the rupee part, I'll leave it to my colleagues in economic affairs to comment on it. From an export perspective, if you look at when the rupee devalues, the exporter in the room does not feel bad. So that's not a problem. But on the trade deficit bit, definitely trade deficit was high in the month of October. But if you look deep down, one of the key drivers for trade deficit in October was our precious metal import. There was a pent-up demand for import of gold and silver. If you look at first 6 months data, our imports were 75% lower than as compared to last year. This year, that pent-up demand, I think, has all been met in October, and that has led to increase in deficit. Two, though we have had low energy prices or comparatively lower energy prices impacting the trade deficit on the positive side, there's been very high precious metal prices, which are also impacting the trade deficit on the higher side. So trade deficit seen with the mix of imports that we are doing, I don't think we are in the worrying zone. But definitely trade deficit as a overall number does have its impact on the economy.
Let me start to get summations from all of you. And Defence Secretary, I'll start by asking you. We've got, of course, the budget around the corner. And the expectation is that there will be a significant demand being made by your department to the Finance Ministry, sir, given the current context that we're dealing with. Your thoughts on the budgetary allocation that is necessary, especially in the context of our need and our ambition to be self-reliant?
So, we've been comfortably getting a 10% increase in our modernization or capex budget every year. Next year, we'll probably, given the geopolitical turmoil that you see around the world, most countries around the world, Europe, even the ASEAN countries that never had any major geopolitical issues at their borders, they're all rearming. And of course, we are in a particularly tough neighborhood in many ways. So yes, we will be asking for a bit more than the normal 10% increase that we get, probably something closer to the 20% mark. My personal view is that we'll have to keep it to that level, 20% year on year for the next few years. That will be sufficient to meet all of our capability plans that we have that are currently ongoing. Overall, as a share of the GDP, our defense expenditure has been shrinking. It is now below 2%. So my view is that we can comfortably sustain higher CAGR, and we need to, given the geopolitical situation. And I don't see any difficulties in getting that kind of an allocation from the Ministry of Finance.
But do you believe expenditure will need to be enhanced, sir, given the requirements at this point in time?
That's what I said, that we will probably... We've been spending whatever was allocated. We exhausted our budget last year. We'll ask for a bit more for the next year. It will be something like 20% increase. We are comfortable that given the growing diversified industrial base that this country has in the defense space, we will be able to, we have the absorptive capacity to, to utilize those additional resources that we are seeking.
Thank you very much. The Commerce Secretary has to leave. Given the timing at this point in time, I would imagine that you're jumping onto a call with the EU and not with the US. It'll be a bit early in the day as far as the US is concerned. So let me end by asking you to give us a broad overview of what we should look forward to in 26. Of course, you gave us some indication of the trade deals, but outside of the trade deals, the priorities that you're going to be focused on, and also if you could leave us with the risks and the challenges that you believe we need to be prepared for.
Yeah, I think one, on the trade front, we are doing well, and I think our resilience in industry, we are very positive that 26 will also be a good year to go. The trade deals that we are negotiating, successful conclusion